When we start the show, we have to look at what's happening domestically, but we also have to track what US President Trump would have said overnight or in the last few hours before we start the show. He gets very active towards the close of the day in America. So let's start with the markets. Winning day for US markets. All eyes are now on inflation data. The PCE will be out later today. Apple results were in focus. Revenues were in line, but iPhone sales have declined. In fact, you know, in China, Apple iPhone sales have declined about 11%. The company, though, has given a strong March forecast, which is why you saw in futures Apple numbers, the Apple stock go up about 3%. The US Q4 GDP grew lower than expected at 2.3%. Estimates were 2.5%. That was a bit of a downer as far as the watch on the economy goes. Treasury yields moved lower on those weak GDP numbers. The 10-year is at 4.52%. Meanwhile, the European Central Bank has also cut rates. In fact, European markets closed up in the green all round because of that 25 basis point rate cut by the ECB. It's the fifth cut since last June, even as the Fed has gone for pause. Oil prices have risen ahead of the OPEC plus meet on the 3rd of Feb. The Brent is at $77. But remember, I think oil will also be determined by what we see in terms of tariffs, if any, and that will determine the kind of global demand that comes in. Japan has opened in the green after inflation data has come in line, so pretty much flat right now. I want to quickly look at the India implied before we get to the rest of the big stories, at least globally. 13 points down, so set for a flat kind of a day after yesterday's ride that we saw in the Indian markets. On the Trump tracker today, I suppose the big question is, in the next 24 hours, will he impose 25% tariffs on Mexico and Canada on Feb 1st? President Trump has said that there will be these tariffs coming into place on the 1st of Feb. The White House has reiterated it. It's important to see if that actually happens. Trump has also now threatened BRICS nations with 100% tariffs in a post on Truth Social. He says the idea that BRICS countries are trying to move away from the dollar while we stand by and watch is over in caps. We are going to require a commitment from these seemingly hostile countries that will neither create a new BRICS currency nor back any other currency to replace the mighty dollar, or they will face 100% tariffs and should expect to say goodbye to selling into the wonderful US economy. They can go and find another sucker nation. There is no chance that BRICS will replace the US dollar. And of course, he goes on and on about that. So just all of that talk in tariffs is something we need to watch out for today as well. In fact, I want to take that point to our first guest today. Edward Yardeni is joining us, President of Yardeni Research. Mr. Yardeni, thank you so much for speaking with us here at NDTV Profit. It's always a pleasure. And
my pleasure.
I think let's start off with the latest post from President Trump. Of course, we have a soundbite of him also talking about tariffs in Mexico and Canada. For the last few days, the question has been, how real are these threats of tariffs? What's your take?
I think they are real, but I think they're also still negotiating sticks. I don't think they're going to be permanent. I think there will be a response by both Mexico and Canada. The issue isn't just trade, it's also about illegal immigration, and it's also about drugs. So there's a number of issues that need to be discussed, and I think this will certainly bring everybody to the table and have another sit down. I mean, let's remember in Trump 1.0, there was a very similar move by the administration, then the Trump administration, to negotiate a new North American free trade agreement, and it was that actually occurred, and that was kind of the end of it. So I suspect it may take a few months here, but all in all, I think there will be some pain here for Mexico and Canada, but they will respond, and I don't think we're going to get a trade war out of it.
There's a very, very old statement that goes, an eye for an eye make the whole world blind. And when you're talking about tariffs, I suppose a tariff for a tariff is not something that will go very far. And right. I'm just wondering whether this is sustainable, whether it can be used, as you say, as a negotiating stick.
Yeah. Well, look, the honest truth, of course, is nobody knows. I don't know for sure. But I don't think this is going to be a serious trade war situation, simply because a lot of countries do a lot of their business in the United States. The U.S. is the world's biggest trade, has the world's biggest trade deficit. So the rest of the world has a very large trade surplus with the United States. And so Trump is using that economic power of if you want to do business in the United States, you've got to comply with the administration's demands for some leveling of the playing field. If you don't, then you're going to be slapped with a tariff. And I think the U.S. has a more negative impact by slapping in tariffs than other countries do.
Dr. Yardeni, the global macro backdrop, of course, is broadly more supportive. Save for the Fed,
Sure.
Every other bank is sounding or acting dovish. But the Fed
Right.
hasn't, and its comments were unequivocally on all the three counts or all the three planks of either labor market, economy, or inflation, sounded hawkish to me. I know you are bullish on the US markets for the rest of
Yes.
the year. My question to you really is, if the Fed doesn't move and the Trump tariff uncertainty remains, can the US markets in such a scenario head northwards?
Well, I think for the next few weeks, maybe the next few months, there's going to be a lot of uncertainty about all those issues. They're all known unknowns, and we're going to know more about how this all plays out. But what I do know is that the U.S. economy is doing extremely well. Real GDP was up 2.3%, but the reality is that consumer spending was up over 4%. Final demand in the U.S. was extremely strong. And so I think that'll continue to be the case. In addition, inflation's come down. Look, I would characterize what the Fed has done as a dovish pause. They've said that they're in no rush to lower interest rates, but that's the point. They said they're no rush to lower interest rates. That's what they're talking about, lowering interest rates. But I don't really think the U.S. economy needs lower interest rates, and I think the earnings picture is going to remain strong enough to drive the stock market higher. As a matter of fact, I think that's a healthier approach this year to the market than to see valuation multiples continue to move higher.
Dr. Yardeni, it's interesting to hear you say that, because a lot of people saw Chair Powell's statements as hawkish, but you're saying it's not really hawkish in your view.
I call it a dovish pause. I mean, he definitely said they're not going to be cutting again anytime soon.
Yeah.
But he did say that he still believes that interest rates are restrictive and they need to be lowered. So I don't really view that as hawkish at all.
Sure. My question, though, is on the emerging markets play. And there's so much conversation out there about tariffs on China. Today, Trump has spoken about tariffs on BRICS. We don't know what will pan out in what way. How would you look at the emerging market situation in terms of an attractive destination for global funds, and India specifically?
Yeah, well, India specifically, I think, stands out as a country that is seeing solid growth, a lot of infrastructure spending. The government seems to be quite stable. And those are all pluses compared to a lot of other emerging economies that aren't quite in the same position. And of course, as you said, there's going to be a lot of geopolitical issues on the economic front with tariffs and possible retaliation. But India seems to be sort of separate from all this at this time. The United States certainly isn't calling out India and isn't threatening India with any sorts of tariffs, because there's no reason for that to happen. India might actually benefit if commodity prices stay relatively flat, particularly oil prices, in a world that might be somewhat slowed down by all this tariff commotion.
Okay. Dr. Yardeni, sometime next week, we'll talk to you, of course, of the key budget takeaways as well, and what did you make of that? Because I know you look at India also, or the emerging markets pretty closely, so it'll be lovely to talk about that. But thank you for your insights today.
Thank you.
That's and viewers, I mean, they put out some interesting stuff. Yardeni Research does, so might be, in case people are interested in global media. I found that page to be pretty helpful a lot of times. But interesting. I mean, I don't know if I completely agree with Dr. Yardeni. He tracks the Dow and the Fed a lot more, but it didn't sound dovish at all to me.
Yeah, so, I know that, which is why I wanted to ask him. He's saying it's a dovish pause.
But I think he's focused on the second statement, which a lot of people did not focus on, which is that interest rates have not reached the level where they become net neutral. which is you're not spurring the economy and you're not causing a deceleration either. So that statement, I guess, a lot of people did not focus on when they saw the statement.
But the thing is, if you look at all the list of statements from the Fed chair, you can pick anything
Yeah.
and you'll always, find the narrative that you want, because all things are said.
Actually, that has usually been the case with central bankers. I think the last central bank governor here in the Reserve Bank of India was pretty clear in the statements that he made. And I think to a large extent, a lot of investors, a lot of viewers of monetary policy liked that. Gone are the days when you try to gauge the direction of monetary policy by looking at facial tics or expressions and saying,
Thank God for that.
Yeah, thank God for that, because you need clarity. But let's talk about yesterday's trade, because it was another interesting day of trade. Once again, you have foreign institutions that sold close to 4,600 crore rupees worth of equity on a net basis. Domestic institutions buying to the extent of 2,166 crore or thereabouts. Once again, a very a wild swing intraday, both for the benchmark as well as for the broader markets. In fact, the Nifty 50 gyrated between a low of 23,139 and 23,322 on the upside. It ended just about 0.4% higher. The broader markets, in fact, underperforming. Mid-cap index gaining only about 0.2%. The small-cap index ending lower by about that much. The market breadth, however, favored the advances, and that is despite the broader market muted performance. It's almost guaranteed now that Nifty 50 is going to end lower for a fourth straight month unless a miracle happens today. And remember, the last time that happened was in 2002. I also pulled out a few stocks that have seen a very high amount of delivery in trade yesterday. Suzlon, of course, has been trading at upper circuit for the last 3 days post its earnings. P&G was another with significant delivery taking place. Tube Investment, GSK Pharma, and Godrej Consumer. Of course, the filter that I put in was over 30,000 crore of market capitalization. Neeraj. So, but these looked interesting to me.
Very much so. I mean, we've spoken about this, the texture of the market the last 2 or 3 days looking slightly different, right? Because the market is rewarding some good moves too. But I think the standout feature for me at the end of yesterday's expiry was how the rolls behaved, right? And the Nifty and the Nifty Bank rollover was higher versus the last 3 months. And we know that while the last 4 months the indices have come off, the template in the last 3 days, even for the Nifty Bank in particular, post the RBI putting in that liquidity measures, has been different. So do these higher rollovers mean that the market is going into a key month, which is ahead of the budget and ahead of the MPC policy, a lot more bullish on what financials could do? That's the key thing. So watch out for that. The rolls were certainly higher. But for the very short term, I know we all said that the Feb 7 is very, very important, but ahead of the big budget day as well, very unlikely that there will be very large table thumping bets on the derivative side ahead of the budget. The market will keep an keen eye out for a few key announcements, and we'll talk about them tomorrow, of course. So that's the thing. But a pocket that stood out for me, guys, I don't know how you guys thought about it. Agrochem, Jubilant Ingravia, Atul, Aarti, SRF, Naveen, Ami Organics. I think that the delivery, the commentary within the AgChem space, or that specifically Agrochem verticals, seem to be pretty decent. Is it turning a corner remains to be seen, but the market is liking the sound bites that are coming in, or the things that are written in the PPT. So maybe that's a sector which has been now really dogged down for so many quarters at length, maybe turning around. Let's see.
There was a statement that one of our guests has made that for a long time now we've been saying that it is turning the corner, but it's been a straight corridor. Hopefully now we finally rise.
But Naveen Fluorine numbers stand out.
Yeah,
Ami
it's on my
Organic,
list.
SRF, yeah. So you have all of those. But before we get to specific stocks, and we've been mentioning about this Jeffries statement, so let's just go through it, quickly in a little bit of detail of what they've said. I thought this was interesting, their India strategy. They are saying that the long-awaited market correction is now underway for the last 126 days, making it the second longest of the 10 corrections in the last 10 years. At 15%, the current correction is in line with the average corrections. That's also what Jeffrey says. This is the Nifty should bottom out before the 7th of Feb, assuming no tax surprise in the budget and a pro-growth RBI. That's important as well. They also say rate sensitives should do well in the expected near-term rally. A 12-month outlook depends on FPI flows as strong equity supply offsets domestic flows. There you have some of those points that we were making now flashing on your screen. I think out of this, the FPI flows question is a bit of a pain point, because if that is a requirement for sort of a reversal, that's going to be a bit difficult from the Jefferies point of view. But let's get to stocks. It is so much of corporate focus on the show today. A whole host of numbers have come in. I'm choosing Larsen & Toubro first as one of my 3 stocks. Thumbs up for it. Revenues are in line. Margins and net profits have missed estimates. But the 9-month order inflow is higher and than the 10% growth guidance. Now, you have to keep in mind that you would have seen some hit on the numbers because government capex was slower in the last 9 months thanks to general elections and state elections, etc. But the varied and diversity of order inflows for the company is something that I see as a positive. The management is confident of meeting the 3.3 lakh crore guidance. International revenue increased to 51% versus 44% in Q3. Some interesting orders there, including in Gulf countries, which have come in. The order prospect pipeline declined versus last year. Margins fell on revenue mix and lower operating leverage in IT and tech services. What they're also expecting in their commentary, and the key numbers there on your screen right now, with the revenue is up 17%, but what they're also saying in their commentary is that they're expecting government spends to come back. So FY26 then becomes important as well. I'll take you through what Jefferies is saying. They've maintained a buy, but they've cut the target price mildly from 4,600 to 4,500. They say the Q3 EBITDA is lower than estimates by 10% on companies' IT and finance subsidiaries. E&C margins have hit by a revenue recognition in hydrocarbon. Commentary highlights bottoming of macro indicators, and double-digit revenue and EBITDA growth visibility should drive upside. Goldman Sachs has also maintained a buy, but has also mildly cut its target price to 3,920. They're saying strong order inflow, margins remain muted to deliver healthy double-digit revenue growth over the medium term. As execution mix shifts towards domestic, margins should improve. So L&T, if you look at just the pure numbers and the margins, maybe a negative. Commentary is positive. Overall, we've given it a thumbs up this morning. Bharat Electronics, though, there is no doubt this is a strong set of numbers. Straight thumbs up there. And the stock was up yesterday as well, about 4.5%. Revenues, margins, net profits are all a beat. On estimates, order inflows stood at 11,000 crores. The FY25 guidance of 25,000 crores is what you should keep in mind. Gross margins are in the range of 44.5%. So they've maintained that range of 42 to 44%. They have a positive outlook on order pipeline for FY26, and they've kept their FY25 guidance unchanged as well. So BEL is one to watch. Their numbers, just let's take a quick look at the numbers as well, which came out yesterday after market close. Revenues up 38%, nearly 39%. EBITDA up 56%. Margins at close to 29%, and net profit above 52% for this quarter. Nomura maintains a buy, says target of 363 rupees, and says it's a significant operational beat in Q3. So BEL is another one to look at. Kalyan Jewelers is the third that I've picked. Thumbs up here on the numbers. Now, this is a stock that has been in the news for so many reasons, and not just their business. We're going to be speaking with the management exclusively in a short while from now, so stay tuned for that. But just to look at their earnings, their same-store sales growth is at 24%. The PAT has included a one-time adjustment of custom duty. And PAT growth excluding custom duty is about 44%. So that's what you should look at as well when you see the numbers. There's no more impact of custom duty going forward. All accounted for this quarter is what the management has said. Now let's take a look at the numbers. Revenues up about 39%, EBITDA up 18%, and you've seen net profit up 21% for them. So Kalyan Jewelers want to watch out for as well.
Well, and an interesting set of stocks. I've got an interesting set, if I say so myself. I do want to point out that the Naveen Fluorine, what you were talking about, very interesting about the space. SRF, we were talking about it yesterday at the start, and you pointed out Concall is something to watch out for. It did pick up steam towards the end of the session. It ended over 5% higher. So
yeah, but today brokerages are saying that, hey, SRF is overvalued.
Yeah, a little bit. Yeah, but Naveen Fluorine, very, very clear thumbs up based on the numbers, right? You had a beat on the revenue. You had a beat on the EBITDA. Margins have come in very, very strong, 24.3% or thereabouts versus a 21.6% estimate, and compared with 15.1% in the comparable quarter. The net profit is coming ahead of estimates as well. What led to the growth? On the revenue side, you had a strong contribution from the high performance product business and also high capacity utilization in the specialty chemical space. The margin is expanded on account of strong pricing as well as improved utilization. But more so, you have the CDMO vertical, which has seen a strong order book position for the calendar year 2025. So very clearly, the outlook is looking better for this company. The operational metrics are also looking much better, and you should expect there to be a positive response today. Let's talk about Tata Consumer, because this is a thumbs down primarily on account of the margin picture, which was a disappointment for a lot of people that looked at the stock. There is pressure that has come through on account of inflation in the tea space. The margin has come in at 12.7% versus 15%, and the net profit is flat at 279 crore rupees. Do note that the profit includes an exceptional loss of 6.1 crore in this quarter gone by, and the versus quarter, as in the year ago quarter, had a loss of 91.5 crore, and that's something that you need to bear in mind. The EBITDA and margins were impacted, as I said, by the inflation in the tea costs in India, but the international business has actually done better, and so to a certain extent, some of the impact on the margins has been mitigated by an improvement in profitability there. What I thought was interesting is commentary by the management. And of course, this is another instance of whether you see the glass half full or empty. And I guess to a certain extent, the beauty is in the eye of the beholder. Here's what Chief Executive Officer Sunil D'Souza said. And I'm only pointing this out because it's so very different from what everybody is saying in the same space. He says, and I quote, "I am probably seeing a different picture than everyone else. If you don't count modern trade and e-commerce and only count general trade, my urban growth is in the low single digits. Rural growth is close to double digits. And if I add back modern trade, which is primarily urban, and e-commerce, including quick commerce, which is primarily urban, then my urban growth is also in double digits." Take that as you will. Certainly, brokerages have seen this as positive. For one, Morgan Stanley has said that the commentary was strong on business outlook, even as the company manages margin headwinds on account of the tea inflation. And Jefferies has also said that it delivered on growth but missed on margins. It has cut its EPS forecast by 4 to 8% and says that the stock should trade weak today following the miss. Praj Industries, third stock on the list. It is a thumbs down on the back of earnings, and the revenue is up just about 3%, but very sharp deceleration in EBITDA. It's come in significantly below expectations as well, which had pegged it at 115 crore rupees. It is only slotted in EBITDA at 72.6 crore rupees. Execution seems to have been a bit of an issue for the quarter gone by. I have a brokerage note, but I'm not going to quote that. Margin is coming at 8.5% versus 11.8%, an estimate that pegged it at 12.1%, as a result of which the PAT has declined by 42%, Neeraj.
Yeah, Tata Consumer though, the tea business headwinds likely to continue for the next few quarters.
Yes.
I don't know if the commentary helps the stock today.
Which is why I was saying it's a thumbs down. And on the earnings front, you can't deny that.
Yeah, so that's the thing. Now, Waaree Energies, I mean, a lot of, and we'll talk to the management, of course, first up on NDTV Profit, so keep that in mind a bit later on today. But the numbers, I mean, if you want a company to deliver numbers because it's an expensive stock, Waaree's done that. 3,457 crores versus 1,596. EBITDA margin at 20.9 versus 10.7. A lot of concerns about whether Waaree's numbers come off on the margin front. Waaree's saying, hey, I'm doubling my margins in a quarter. Sure, it's just a quarter. We'll try and figure it out. But this is exceptional margin performance, as a result of which the net profit 493 crores versus 125 crores. What a strong set of numbers. Really, you can't find a fault with this. Shree Cement, very quickly, revenues were down 4,573 crores, but the margins 21.1 versus estimated 17.9, and the net profit was of course down to 193, or it's marginally below estimates. It was a better quarter while the volume growth was missing, but the point being the EBITDA number has been very, very strong, and the company's got a very aggressive depreciation policy, as a result of which I think the bottom line number looks the way it does. So keep that in mind. That's the second one. And Greenlam is the third one. Very quickly, margins at 10.6 versus 12.6. The estimates were 12.2. Net profit down 50%. I don't know if the approval of the bonus issue helps the stock or no, but otherwise it should get hammered in trade.
Okay. All right. So that is the sum of the stocks that we've selected. Of course, there are so many more, and we will discuss a few of them before the start of trade today. But let's go to an NDTV Profit exclusive first. Have you ever heard of a finance company relying on money lenders, loan sharks? That is allegedly what happened at Aviom India Housing Finance, which is currently facing insolvency proceedings by the Reserve Bank of India. My colleague Vishwanath Nair is joining us in studio to tell you about that fascinating story, Vishy.
Yeah, Alex, at some point in time, you think you've heard everything, and then something like this pops up. But basically, it's a housing finance company, Aviom. It focuses on women and women entrepreneurs and provides home loans to them. The RBI earlier this week had superseded the management, the board, and appointed an administrator to run the company because they found serious lapses. And now what our sources are telling us is that apparently, of the 1,800 crore loan book, a significant chunk was given to fictitious accounts. So that money is never coming back. And to maintain the money flow, this company has gone out and taken money from money lenders at 40-50% interest and then used that to pay back lenders. Now, this cycle obviously came to light once the investigation started. Now, of course, there's an insolvency proceeding against Aviom at the Delhi NCLT bench. And there's an audit process to figure out how much exactly has been borrowed from these money lenders, because all of that money is going to go nowhere. But the lenders responsible are going to be a lot of soup.
But, I mean, it
Not
sounds...
just MFIs.
I'm just wondering how long was this going on and how did it go on?
The company is about 7 years old. 2018 is when it was set up. Now the key part here is most of your big lenders, HDFC Bank, Kotak Mahindra Bank, Poonawalla FinCorp, you've got Northern Arc Capital, all of them have loans extended to this company. Apart from that, you've got international institutions like the US International Development Center, the DFC. They have actually given them ECB loans. The Japanese ASEAN Women Empowerment Scheme has given them ECB loans. All of them are involved in this entire case.
Wow, bring this to light. More on this, by the way, we'll follow it through the day. But we need to really slip into a short break. Back with the management that everybody wants to hear. Kalyan Jewelers. Stay tuned.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to
Kalyan Jewelers in focus, and they've had a strong quarter. Revenues up nearly 40%, 39.5% this quarter. EBITDA up 18.7%, slight drop in margins, and net profit up 21.2%. Ramesh Kalyana Raman, Executive Director of Kalyan Jewelers, joining us on the show right now. Ramesh, very good morning to you, and thank you so much for speaking with us. First and exclusive right here on NDTV Profit. We appreciate it. Let's start by getting your recap on your numbers this quarter. Top line looks good. Margins have been hit a bit.
No, so yes, the revenue growth has been 40%, console India 42%. And you should see by negating the metal loss due to customs duty. And if you negate that, the PAT grew by around 44% console and 54% India. So that is the way to look at it, because we had a customs duty impact in the last budget. They had reduced the customs duty, and you can see that as a metal loss. And that is why you see the PBT margins in this level.
No, absolutely. Post excluding of the custom duty, which was a one-time hit, you are back at 44% PAT. So this impact is now behind you, Ramesh? This does not flow in?
Yeah, so now there is no more impact to come regarding that.
Okay, so then let's come to the kind of demand and growth that you've seen, because your same store sales growth has been good. What has the demand been like? Because this is a good quarter, right? Seasonally as well, weddings and festive, etc.
Yeah, Q3 festive wedding demand, everything was strong, and SSGs, as you rightly mentioned, 24%, and it has been across south, non-south, across all the stores, and it has been good. And wedding, the number of Shraddh days were lesser in Q3 this year when compared to last year.
Okay, Ramesh, hi, Alex joining in, and if my memory serves me well, I think about 8 months to a year back we were speaking. You were talking about the impact of the FOCO model on your business, and you were saying that over a period of time the glide path for EBITDA margins is going to be that it will be lower because of that mix.
Yeah.
Has that completely occurred, or is there more on the cards, and to what extent can you expect a contraction?
Yeah, so you rightly said, because our EBITDA margins for franchisee stores are in the range of 5% versus 8% plus in our own store. And our expansion is completely on FOCO model now. And that is why you see the EBITDA margins degrowing. This will be, again, further EBITDA margins can come down till 2027, wherein we will still be expanding through our FOCO model. And because we are using our excess cash to repay our debts, and once that debt reduction is complete, then we go into the COCO model again, partially from 2027, from which you will see the EBITDA margins growing again.
For those people that are wondering about that abbreviation, let me spell it out. It's franchise-owned, company-operated, and company-owned, company-operated. And Ramesh, this strategy that you say, so 27, help me understand the first quarter next year, because we're talking about ultimately, if you're saying that the customs issue is over and now it's business as normal, help me understand the range that you're expecting in the next few quarters and heading into FY26.
Again, you should look at it in two ways. If you are looking at PBT margins, even the first 9 months this year versus the 9 months last year, if you negate the metal loss, PBT margins have grown by around 0.2, 0.3%. Okay. And the way we should look at Kalyan Jewelers is PBT margins again, rather than EBITDA margins, because I told you EBITDA margins will degrow. Because if you look at, now we are at 40% franchisee revenue versus 60% owned store. If you look at 50-50 in the next year, then EBITDA margins will be only in the range of 6.5, right? So it will again degrow from where we are today. So you should look at the PBT margins. PBT margins are growing. If you negate the metal loss, PBT margins have grown in this year also. And for FOCO model, you know that the PBT margins are higher than our COCO model.
Ramesh, good morning, Neeraj here. One is the P&L and how it is looking. Two is the internals, right? I would love to know how is the situation with regards to cash flows? How is the situation with regards to gold inventory? How much of it might be mortgage currently? Can you give some details thereof?
What mortgage are you talking about? Gold inventory?
Yes, please.
Yeah, so gold inventory, meaning the expansion is going on FOCO model. and the inventory lies in the books of the franchisee, not with us. And this year so far, we have reduced around 150 crore debt. And last year, we reduced around 350 crore debt. And nothing major in terms of what you call mortgage of inventory and etc. We will still repay 150 crore more in this financial year.
Okay, you would. Okay.
And you have seen, cash flows are very strong, right? And that's why majority cash flows used for debt reduction and dividend. That's how we will take it forward for the next year also. We paid around 120 crore dividend, 3 months before.
Okay. And so obviously I don't want to talk about rumors here, Ramesh, but some of the things that have happened, right? So your stock price has come off. We'll come to the other details later on. But just wondering, one of the things that managements do think of when they have cash on the books, are confident of the growth story, but due to factors, the stock price may have come off, is considered a buyback. Would you consider that? Because your stock, with the promise of the growth story, has come off from 770 odd or whatever it was a month ago, right? To about 440 currently, right? Is a buyback on the cards then, if you as management are very confident of the growth story going ahead?
Yeah, you're right. So we have already had announced a debt repayment. We don't want to change any strategy for the company because of stock price. And once that debt repayment is over, you are right, we will have excess cash wherein we can either open cocoa stores or we can even go for a buyback, which cannot be decided right now. Now our focus is to keep track on our strategy, wherein we will reduce further debt. We have certain collaterals in the books which can be liquidated if we reduce our debt, and that will be our primary focus. And we will not change strategy because of the current stock price, etc. Because the strategy is laid because of certain reasons.
Sure, but I understand that, Ramesh. Sorry, just one more question there. But I mean, it's also nothing is cast in stone, right? Sometimes it's just prudence because as you've stated on various con calls, right, that there was a lot of factors are rumors, right? And because of the rumors, if there is such a dramatic fall, then why not take advantage of that? But I get your point. So just follow up on the point that you mentioned. When would these decisions be taken? Part one. And part two, just because you mentioned that, right, that you reduce debt, so some of the collaterals come off. How much of the stock is currently as used up as collateral as of the last release date, or whatever the last number that you have readily available with you? What percentage of the stock would be currently pledged?
No, it's not the stock which we are trying to we have a lot of land parcels which have been given as collaterals to banks, which is non-core for the business. So it makes our balance sheet very heavy. So our intention is to repay the debt so that the land parcels come out and we can liquidate and bring it back to the system.
Got it. Okay, I stand corrected. I stand corrected. But is there any stock which is pledged as well, Ramesh, and which you need to kind of bring back, if not at the company level, then at the promoter level? What is the quantum thereof?
No, I will tell you that the promoter pledge is only done for increasing the stake, which we did 3 months before. Nothing related to business. Okay.
Right.
Promoter pledge was only for that. Of course, inventory, certain collaterals, that is a part of our debt structure, wherein we will have to pledge inventory, we will have to pledge our collaterals, which is owned by the company, for getting exposure with the banks.
Yeah.
That is where we are working hard to get certain collaterals which is of non-core, so that it can be liquidated.
I got it. I differentiate the two, but since I mixed the two, I'm just trying to untangle my earlier question, Ramesh. So you explained very well the land collateral. Since I asked you about that, I'm just wrapping up this piece of my question to you. The promoter pledges, you would have pledged it for various reasons. Because of the stock price fall. Only one reason. Let's put it that way, only one reason. But because of the stock price fall, those collaterals either might have gotten invoked or you might have to pledge more, right? So what's the quantum of promoter shareholding that would be pledged currently?
So now we are at approximately 25% of our shares are pledged. But we bought the shares because we saw growth. We know about the company and it's a long-term decision, not a short-term decision. We have adequate cash with us in such a way that the pledge will not increase further.
How will that happen, Ramesh? Just in terms of what is the plan in releasing this collateral, and two parts of it. Some of them are shares pledged by promoters, others is land parcels, etc. What is the plan and intent there?
Again, you should divide it into two.
Yes.
Company, promoter.
Yes.
Company, debt repayment is happening. The only objective of debt repayment is to get back certain land parcels which are there in the banks, which is 3 to 6 months, away from us, where we will be able to give a clarity of how much land has been received from the banks, what is happening and stuff. Our focus now is to repay the debt so that we are in a position to go to the banks and ask for the collaterals back. That is about the company. About the promoter, yes, there is a 25% pledge as we speak. The only reason for pledge was to acquire more shares of Kalyan Jewelers, and you will not see further pledge because we have adequate liquidity to manage any further situation if it occurs.
Okay, clear enough. Let's come back to the outlook where, you've said by FY27 you hope to be repaying all your debt, you will have cash in hand. What is that FY27 pictures looking like in terms of company-owned stores, going back to the COCO model as Alex has described, and what is the margin picture thereon?
No, like what I said, the next year, if you look at COCO revenue mix, if it is approximately 50-50, then your EBITDA margins will be at 6.5. From 2027, if we start doing COCO showrooms with the excess cash because the debt repayment would have been over, then you will see EBITDA margins grow from that 6.5 onwards.
So what is the target there is what I'm trying to understand.
So again, incremental EBITDA for a COCO showroom are in mid-teens. So the incremental EBITDA growth because of a COCO showroom will also be very, very visible. So if you look at a target of 2027, like once we complete the debt repayment, then we will come with a strategy of what we are going to do with the excess cash. It can be a COCO, it can be buyback, it can be certain other things, right? So we will give you a clarity of 2027 when we move towards it.
Okay,
when we're closer to that date, I guess. In the interim, I think a lot of people are focusing on the implications of studded jewelry in the mix for the industry as a whole. Kalyan, of course, has traditional products, as I understand it. Correct me if I'm wrong. What is the implication of that? And are you planning to change the mix at all? Are you planning to introduce certain amount of studded to change the offerings that you have?
The studded mix is very strong at Kalyan now. Okay. We are at the 30% studded mix, if you have noticed. And it has been growing from what last year it was around 28, now it is at 30. So because two major reasons. One major lever of studded growth is because our expansion is non-south. Non-south organically comes with more studded ratio. Okay, that is the primary reason. Second reason, within our south stores also we do promotions, etc. We do marketing stuff for increasing our studded revenue. Both put together, the studded ratio is in the range of 30% now, and it should be in that range way forward, because now the additional stores which we are opening in the non-south are also in tier 2, tier 3 markets where studded ratio might not be as good as a metro.
So I remember last time when we spoke, which was quite a while back, Ramesh, you were also speaking about expansion outside of India's shores, international expansion. And has that gotten a little have you put that on the back burner, or is it still on the way?
No, so again, like what I usually say, our primary objective is India. The biggest market for us is India. India will be our primary focus. But yes, international expansion is also on the cards. We opened our first showroom in the US a couple of months before, and it has been good as we speak. And we have plans for international expansion for the next financial year. We will open maybe 6 to 7 showrooms in the international space in the next financial year.
Ramesh, 2 or 3 more questions. We would also have a question on what are your budget expectations. But I have one more non-business related question, if you allow me, Ramesh.
Sure.
And which is that you told me that the promoter stake is pledged to the tune of 25%, etc., right? If there were, and you did it presumably because you wouldn't have the liquidity to increase the stake itself, so you had to pledge. So I'm trying to understand, in such a scenario, why is it that the promoter decided to buy a small percentage of the Warburg Pincus stake? You could have just, because there were liquidity concerns, right? Or liquidity issues, why go out and use up that liquidity for that?
So again, Warburg, they holded more than 25% plus in Kalyan Jewelers, and they had diluted in stages, phase by phase, over the past 18-20 months. Okay, so we wanted to increase our stake at all levels, but at that point in time, our focus is to bring in new investors on the company, and then we bought the shares in the last block of Warburg Pincus. And again, it is a long-term view, right? Our own company, we wanted to increase the stake, and when you look at the risk versus the objective, we thought objective is better.
So just one candid question, right? I mean, you explain the what's happening in the quarter, duties, etc., long-term plans beautifully. I understand that anything about the buyback you cannot mention right now because it's in the future. At that point of time, whatever is the best option, you will take that. The street, in its wisdom, Ramesh, has punished the stock for a variety of reasons. Some rumor, some may be apparent to the street on the valuation front or what have you. What, according to you, Ramesh, has gone wrong for the street to soar so much on what was a really fancied stock until 1 month ago, that in 1 month the price has been hammered so badly? What has gone wrong? You would have had a chat with investors, some investors would have called you, you would have had all of these conversations, right? You've done a couple of con calls as well with regards to this. What's gone wrong?
Yeah. No, so according to me, as a promoter, as an executive director of the company, we as a team, the only thing which we can assure is our operations, our P&L, our balance sheet, our expansion plan, strategy, communication, which we are sure that we have not gone wrong anywhere. The other things I will not be able to comment. I am also only 2.5 years in capital market, right? You are better people to comment on it. But the focus for us is strategy, communication, and again, implementation of what we have decided, and execution is the primary focus, and we will keep on focusing on that. You see what we have done over the past 18-24 months. Look at the cash flow, look at the revenue growth, look at the store expansion network, franchisee model. Everything is in place, and we will be focusing only on that.
I think veterans of promoters who are dealing with stock markets for years will say what you're saying is the exact right thing to do. Put your head down, keep your company going, and stock markets will recognize it over time. Just one last question, and again, thank you for your time and answering all of our questions. But I must ask you what you're thinking and hoping for from the budget, because clearly decisions made in the last budget is something that has been haunting your balance sheet till even now, like we discussed. So what are you expecting from the budget this time?
So actually what the government had done in the last budget was good for the sector. You don't look at the temporary 1 or 2 quarters P&L hit, but on a long term, on a mid-term, the unorganized to organized shift, actually it helps when the duty difference is minimum. Right. So even in this budget, if there's again a duty cut, it is good for the sector again. It will make the sector very transparent. And again, the shift from unorganized to organized will further accelerate. And it is good for the country and the sector.
Okay. Well, Ramesh, thank you for taking the time out. As Tamanna said, much appreciate you taking all this time to answer all the questions that we had. Please understand, it's something that the street wants to know, and I'm sure more to come as well. So appreciate that you took the time out and answered all of that. Really appreciate it. All the best.
Plus. Thank you.
That's Kalyan Jewelers. Well, let's see if the 1 month chart is looking tough. I mean, if I were to ask Kushbur about how the chart is looking, I'm sure he's going to say that it's looking tough, but be that as it may, before we get to that, on the profit watch list, let's tell you viewers what's there on the mind. I mean, Kalyan Jewelers was top of mind for every investor and trader for the last 1 month, but for today, Paradeep Phosphates should be one that should be on your mind. A 4,000 crore MOU with the government of Odisha, so watch out for that. Waaree Energies, growth across all metrics, splendid growth on the margins and bottom line should please the street. BEL has maintained the FY25 order inflow guidance of 25,000 crore rupees. Larsen & Toubro, the Q3 order inflows are up 53% and they've maintained their FY25 guidance. And Navin Fluorine has beaten estimates, much like its peer sets, and maybe the stock sees a further pullback.
And on the other side of the spectrum, the ones that have disappointed, you have Tata Consumer, which we've already spoken about, a sharp decline in margin, and that's on account of inflation, the tea in India, in fact, that you've seen. Biocon has also missed estimates, it's a thumbs down. There's quite a bit in those numbers though, so look at the fine print. There are one-offs in that quarter, so you need to understand why the numbers have missed so badly. In the power space, in fact, you have, actually Jindal Steel, you have the EBITDA per ton that is down about 27%. That's something that is looked at as negative. And Praj was on my list. It has missed estimates across the board.
All right, Kush Bora joining us this morning in the studios. Dharmesh Kant, Head Equity Research, Chola Securities with us, Kush of kushbora.com. Good morning to you, Kush, and Dharmesh, good morning to you as well. Kush, just today is the day, right? If you want to position yourself for a Feb 1st play, what would be your strategy today?
First up, a very good morning, guys. I don't know if this is a TGIF, but let's just go with that.
No, it's not feeling like a Friday at all. We have a big weekend coming up, but yes.
A big one. That's what I said. It doesn't feel like, a TGIF kind of a feel. But let me answer that question in two parts. One as a technician and two as a trader. Technically speaking, the Nifty looks beautifully poised. The falling trend line resistance, the 20-day moving average, the Nifty's just moved up to that level. Neeraj will remember on the last couple of closing shows, this is exactly what we've been talking about, that the Nifty could come back, but till the levels of 23,300 for all technical reasons that we've discussed in the past as well. A breakout above this level could push the Nifty higher to 23,500, 23,800 kind of levels. So that's from the technical analyst angle. As a trader, how would I position myself? If I don't have a long position just yet, I wouldn't want to go too heavy into this, right? I don't know what the expectations on the street are, but I don't think they are too high, going into the budget. But if there's any kind of disappointment, then you would actually see a retest of the 22,800 kind of lows that we've recently witnessed. So I wouldn't go too heavy. Yes, given the kind of up move that we've seen, given the risk reward ratio, you might want to position yourself on the long side on the Nifty. But again, because of the nature of the event and the expected impact, you might want to stay light or have proper risk management systems in place. So a view from both the angles, from a technical analyst perspective and a trader as well.
Okay, but you do have a couple of picks for us this morning. Kush, you want to talk about this?
And as a prudent trader, I have a mix of a long and a short. I'm going with that hedged kind of a position, right? On the long side, I've got Swaraj Engines. The move on this one has been rather beautiful. We've seen volatility, quite a bit of it, but I think that is largely on account of the kind of moves that the market have seen. The stock has broadly respected the 50 and the 20-day moving averages. The averages are also on the way up. So you're looking at near-term targets at 34.40, 35.50, and 32.20 being the stop loss. On the short side, I've got Crompton. The stock did see a bit of a revival, but that has also been sold into in the last two sessions. Yesterday also, when the markets were up, the stocks sold off with a fair degree of high volumes. So on the short side, Crompton, 341, 337 are the targets. 349 is where you place that stop loss, and you could obviously use the Feb futures to go ahead and initiate this position.
Okay, we've also got Dharmesh Kant, Head of Equity Research at Chola Securities, joining us. Dharmesh, good morning to you. And I am wondering if you heard the conversation that we had with the management of Kalyan, and what did you make of it, if at all? And you saw the numbers, I would assume. What's your take?
Yeah, good morning, Alex. Good morning to all our viewers and panelists. Good morning, Kush. I did hear the conversation of Kalyan Jewelers, and see, they are clarifying the things and putting things in perspective, and that's the right way to go about it. Business-wise, they have done pretty well. I mean, the numbers, though the margins were a bit suppressed, but that is the scenario with most of the jewelers this time around. But if you ask me a call, I won't be buying Kalyan Jewelers. Let the cloud clear and let the numbers be more firmer. Just on the valuation metrics, they are still very expensive. If you look at Senco Gold or P&D Gadgil Jewelers, so they are pretty much more cheap compared to Kalyan Jewelers with a better return ratios and the growth. So the segment is seeing a growth. But P&D Gadgil and Senco Gold would be a preferred pick out there, and won't be venturing into Kalyan Jewelers as of now.
Okay. So that's the view on the jewelry stocks, but so many numbers in focus today. Dharmesh, wondering what you're thinking of L&T, BEL, some of the key numbers that have come overnight. Anything that you've been tracking and you've liked? I think a little better news, even a Waaree, little better news on the numbers front.
Yeah, I mean, Tamanna, good morning. Waaree has a very good set of numbers they have come out with. And this is the segment where the traction and most of the action will be there in, couple of years to come through. After listing, the stock has corrected quite significantly. And now I think it's a time to get it into your portfolio. And the renewable energy segment is one area where we are very bullish on. So renewable energy, railway infra, some of the defense companies and public sector banks. These are the 4 sectors which we are focusing on for the next 6 months. As far as overall numbers are concerned, it's been a really mixed bag. There has not been a very good pleasant surprise so far. And just to give you a picture on the number front, we did study 240 companies' earnings which have been reported selectively. And out of that 240, around 95 companies reported negative earnings growth, and it was only 38 which reported 0 to 8% kind of earning growth. So it's very, 50-50 kind of a thing, which this kind of a negative growth which has come around this time around does put into question mark Q4 earnings as well. So Q4, the base was very higher. So it's a bottoms up market. You have to be very stock specific and a bit of a sector specific, the sectors we spoke about. But Waaree definitely has come out with a good set of numbers along with BEL one can add into the portfolio.
Okay, so BEL, Waaree, good set of numbers. Another set of numbers which we need to analyze is Dabur. Came during market hours yesterday, but a whole host of brokerage notes on it this morning. What are they saying, Mahima?
So brokerages have generally maintained their neutral stance on Dabur, but JP Morgan and GS both have differentiated in their target prices. While JP Morgan has cut its target price, Goldman Sachs has hiked the target price by a tad bit. I'll start with what JP Morgan has to say. It's maintained neutral and cut the target price to 550 from 580. They're saying that Q3 was in line, but healthcare and beverages business is something where the challenge stays. Gradual volume and margin uptake ahead is expected. FY26 will see margin expansion, and for FY25 to 27 EPS estimates they've cut by 3 to 4%, and this is on the back of lower revenue. Goldman Sachs has maintained neutral but hiked the target price to 550 from 540. So both the target prices in both of these cases remain same. Dabur has delivered an inline performance in Q3 is what Goldman Sachs is also saying, and the growth is similar to FMCG peers, but driven by the home and personal care. Strong outperformance in oral care has resumed for Dabur now, and beverages, many actions are initiated to which has kind of led to the revenue decline. And lastly, EBITDA margins are expected to remain flat YOY is what the brokerage is expecting. So at Dabur, we did see an uptick yesterday in the stock, but brokerages have maintained the neutral stance.
Okay, well, certainly FMCG would be under pressure, and just watch out for Tata Consumer as well, specifically in the session today, simply because while we look at a lot of what FMCG other names have done, Tata Consumer's tea business leaves it a bit, badly hit, if you will. So, Tamesh Kant, would the takeaways from Tata Consumer numbers spell slightly tough times for other tea companies as well? Not too many out there really, which are very highly traded, but still.
Yeah, looks like it, Neeraj. I mean, not only tea companies. If you look at FMCG as a pack, the numbers have been quite, submissive with a very low volume growth, hardly any blended price realization kind of a growth, and that's the way things are shaping up. Though in this market, because of the market volatility and so much negativity prevailing around the market, people are opting for FMCG stocks. But this kind of earnings growth trajectory which they have shown, I think next 2 quarters would also be difficult for them to come out with any better earnings growth. So it's more of a trade, day, 2 days, 3 days kind of a trade, but not a drifting or traction buying. So better to avoid the entire pack.
Okay, avoid the entire pack, and let's see if that continues to be the statement you're making, Dharmesh, after tomorrow's presentation of the union budget, as is widely expected to be the case, that something will bolster consumption. I hope that comes through, because that would probably mean, guys, a little bit less tax paid, a little bit more money in the bank account. At least for me, I don't know about you, but Kush, do you like anything in the FMCG space?
Continue to like Britannia. We did see a good up move on this one on a couple of days ago. Came into a bit of a profit booking, but then yesterday again, you saw that revival. We also like Dabur. As we discussed yesterday, a couple of days ago, we discussed Dabur for targets of 535, 545. Yesterday, after the result move, 535 was hit. If anyone's got a position, you could continue holding on to that one for 545 kind of levels and higher. And if you don't, you could still initiate that, but with a tighter stop loss close to the 525 mark. So Britannia, Dabur, I like Colgate as well with the kind of setup that is gearing up, but it hasn't really turned into a call yet because of the missing momentum on that one. So for now, stick to Britannia and Dabur in this space.
Okay, other stocks that we should focus on this morning, and just the first rates in the pre-open flashing in, all of those will stabilize, but I think look at an L&T. Naveen Fluorine, PB, FinTech, all on the back of numbers and good set of numbers over there. And this might be a bit misleading, all 10% up, but this will stabilize. Directionally, these might be stocks that you should look at. On the downside, I want to see what's happening to a Kalyan Jewelers. We had an extensive conversation with them. Biocon, set of numbers. Yes, there were one times, which is why the number was looking weak, but even then, miss on estimates. Biocon, they're stabilizing right now. A Whirlpool, second day in a row, seems maybe set for some amount of pain. Tata Consumer, Kalyan Jewelers, let's look at a few of those as well. Whirlpool, again, because of the drawdown or the decision that the company is making to, in a sense, exit India, seeing a bit of pain in Tata Consumer as well, in a bit of pain. Kush, any of these that are on your radar? And let me just come to L&T and BEL, because that's something that we spoke about. Even a Hitachi Energy looking interesting this morning.
BEL most certainly is. We've been speaking about this for a while, that the stock has actually not lost as much ground. But frankly speaking, again, this is me speaking as a trader more than a technician. Was that before an event, I'm a little skeptical about the defense space, also a little skeptical about the railway space, because while we've seen a spark which could have culminated into a pre-budget rally, the follow-through is missing, and a lot of them have given away those gains. Now, while it could seem like this is creating room on the upside, if there is any disappointment, these stocks could actually hit further lower levels. So I am a little skeptical on this. But if you look past the event, then I think from the entire space, BEL looks like one stock that you should have in your portfolio. You should keep adding at regular declines, because this has seen quite a bit of stability, especially when you compare to the rest of the pack. Yeah, Larsen was showing promise a couple of weeks ago, but that's been given into. So I would not trade Larsen just yet. 3,400 being the key level. If that is given out, then the stock could hit further lower levels. So Larsen is an avoid. BEL is an accumulate. Now even on declines.
The one stock, and we'll have to see if it actually pans out, but Suzlon, if it's another day of upper circuit, I want to know whether at any point
it is.
But when it opens, let's see if that pans out. But there's lots of stocks that we should focus on at the start, and we've mentioned a few, of course, the likes of PB Fintech, Bank of Baroda, Praj Industries, all on the back of earnings. Phoenix Mills also in focus. We've got Rucha joining in to tell you about what stood out on these numbers. Rucha, over to you.
Okay, thank you. Good morning. So I'll start with PB Fintech. Well, mixed set of numbers over here. Revenue up about 11%. Margin came in at 2.1%. Missed estimates of 3.8% over there. Net profit up about 41%. Now, in terms of other data, the total insurance premium is about 6,100 crore, which implies a growth of about 44% on a year-on-year basis. Lending disbursal grew 52%. Core online insurance new premium, which is an important factor, grew 44%. Meanwhile, health and life insurance new premium grew 47%. So growth largely healthy over here, but in terms of numbers, it's mixed with respect to estimates. Moving on to Bank of Baroda, well, net interest income up 3%. Provisions is actually up 62% to at about 1,082 crore rupees. The gross NPA, that is non-performing asset ratio, down just 7 basis points, so largely flattish over here. And net NPA ratio also again largely flattish at 0.59%. Praj Industries is a thumbs down as it missed estimates. Revenue up 3% at 853 crore versus an estimated number of 950 crore. In terms of margin, 8.5% 22% versus estimated number of 12%. Net profit down 40% to 41 crore versus an estimated number of 78 crores. So missed estimates on all the three fronts. And lastly, Phoenix Mills revenue down 1.1%, margin at 56.7 in line with estimates, and net profit down 5.2% to 265 crore rupees versus an estimate of 279. So over here again missed estimates, hence a thumbs down over here.
Okay. Thanks for that. Not quite starting off all that badly, but could be interesting what happens to some of these stocks as well. I dare say the other eye will be on Tata Motors, right? And what is Tata Motors doing? Is this, today's CLSA note says that this fall is an opportunity to buy. Kushbora, is it near supports?
It is. In fact, I think yesterday also was it on the closing show that we discussed that there could be some more near-term pressure, but if you've got a view anywhere from 12 months and beyond, this fall could actually very well turn out to be a buying opportunity. If you see on multiple time frames, the stock could now approach the oversold zones, oversold territories, thus making a very interesting, very favorable risk-reward ratio. So I wouldn't say, jump in and bet the house on it, but if you were to start accumulating, this would be a good point.
Okay. That's the view on Tata Motors. The stock got beaten down in trade yesterday. It's up and about. But let's talk about Navin Fluorine, because this is something that was on my list. I think that it's going to be a good start for this stock. Indeed it is. And let's see if that pans out. But interestingly, Citi has maintained a buy with an upside potential on their target price of as much as 15% from the current market price. And Harsh is joining in to tell you what they made of the numbers. Is this a first cut? And what are they saying?
It isn't. In fact, they've hiked their target price quite sharply, and what they've essentially done here is they've highlighted how the numbers have been a very, very strong beat. So 120 crore was the anticipated expected EBITDA. It's coming 20+% higher at 147 crore. Even consensus was at 126 crore. So the beat was quite strong across the board. What's led the beat? One, higher specialty chemicals, and two, domestic ref gas sales. Both of those have aided the numbers. And I want to just delve a little bit into specialty chemicals. Revenues were up 26% YOY, 40% QOQ. Higher capacity utilization at Dahej and Surat plants pushed the numbers higher on this vertical. And when you're looking at what the management is indicating, very strong visibility for Q4, FY25 and FY26. Two new molecules are scheduled to be launched in Q4 and Q1 FY26. And some of that will likely start to get priced in already. CDMO also was strong, 8% up YOY, 16% QOQ. And management is indicating a strong order book position with regard to European CDMO supplies. So that will also push numbers higher. What this has done is they've hiked their expectations. FY25 EBITDA expectations by 1%, FY26 by 18%, this is Citi estimates, and 17% for FY27 as well. And therefore they've hiked their target price from roughly 3,800 rupees to 4,500, which is a sizable increase even in terms of target price. So quite bullish on this one, Citi.
Thanks for that, Harsh. What Alex was meant to asking was that is this an actual full-blown report or is it a first cut of the results? So,
it's a full-blown report. It's a full-blown report. That's what I meant to say, because management commentary has also come through, Neeraj, on this one.
Got it, Harsh. Thanks so much for that. So, the stock starting off well. Dharmesh Kant, fluorochemical companies, agrochem companies, or spec chem at large seems to be turning the corner, at least in terms of price movement, if not actual delivery by all companies. Is there any chemical, agro, specialty chemical name whose results have stood out for you? It could be Navin, it could be something else.
Yeah, Navin Fluorine result was definitely a surprise to us. And we were expecting a better results, but not to the extent the numbers they have delivered. And that was primarily because of refrigerant gases, because of the winter season picking up in Europe and US. So, but they have done good across the verticals. The only thing to be answered here is the continuity of this momentum which is here, because the larger part of the market is Europe, and Europe as an economy is not doing that great. And there are reports that this time winter has not been that harsh as per the expectation. So let's see whether continuity of this numbers is being carried out in Q4 as well. But overall, I do think with the kind of suppressed prices most of these companies are sitting on. So UPL and Navin Fluorine is where we are keeping a tight eye on. We are playing trading bets out there, but as an investment buy for a cyclical play, we are still holding our bets till Q4 numbers are out. My personal sense is there would be a tough scenario for them going by the way the European economy is panning out. On the specialty chemical side, agrochemical is one play which may offer a better opportunity.
I wanted to ask you about Suzlon because there's no point talking about whether you should buy it on the charts or not. I'm just wondering if it's actually not at upper circuit, or let's see how it opens actually once everything opens up. But would you buy, Dharmesh, based on the numbers that you saw? I guess if at all, today will be the first opportunity for people to do so if they don't have it.
Yeah, it's a complete turnaround story and the numbers have been panning out quite well. And the entire segment looks very promising. So be it Suzlon, be it Waaree, and the others in the very ancillary pack of this entire renewable energy segment. So you just have to be a bit careful about the valuations on a long-term horizon because short-term everything is very expensive. But if you are having say 5 or 6 year kind of horizon, there you have to do the cherry picking. So Suzlon does merit a buy out there, and they have been very consistent in their numbers as well.
I wonder if, can you pull up the stock price of Wockhardt once and just see what's happened? And the other one, of course, is Whirlpool, the two Ws. So Wockhardt, 9.81% higher. At the other end is Whirlpool, down another 14% after the 20% slam dunk yesterday. There's no telling as to what prices Whirlpool can go to, frankly, because if the promoter entry is going to sell such a large stake, there's no rationale to this. I mean, it may sell the stake at a 6-month average, the 6-month average may be lower, etc., what have you. So this is past templates playing out. But Wockhardt, interesting. Kush, for a stock that is now started to become a classic buy the dips, right? Every single point of time there is a dip. Either there's a, I mean, I'm not saying the management releases the announcement because there is a dip, but there's a flurry of announcements that's happening in Wockhardt, which is giving this serious support to the stock. Would you buy it or would you say that it's overheated?
No, not at all. Not at all overheated. In fact, you're right. This stock has had, a stepwise kind of an up move, right? If you see, the stock's actually a multi-bagger and not too far back. We're talking mid 2023 when the stock was close to 150 levels. So, more than a 10x kind of an up move and then some profit booking. So, I think this is a good opportunity to start accumulating. The stock typically has a tendency to respect the 50-day moving average, not the 20, the 50-day moving average. It's come off those levels also, but that is in line with what the markets have been doing, right? Other than that, I think there is a strong buying around the 1250, 1275 mark, that we've seen for the last week or so. So I think this is a good opportunity to accumulate a stock which has done phenomenally well in in a market which is actually probably perhaps seen quite a bit of correction, but the stock really hasn't. So if you want to look at it from a 6 to 12 month kind of a period, then this is a good buying opportunity on Wockhardt. Positional stop comes in at about 1150 odd levels.
I'm not that good with these things per se, but Tamanna, Alex, what they have said in the release is that Zenix, which is WCK 5222, that big blockbuster truck for them, has achieved the highest ever efficacy in a global pivotal registrant enabling phase 3 study, achieving 96.8% clinical cure rate.
Yeah, and this is in complicated urinary tract infections. So an important drug, and which is why you're seeing perhaps Wockhardt in focus this morning. But your pre-open rates have settled, and we need to talk about some movers that you might see. Coach, in fact, let me come to you and ask you if you're doing any spotting this morning, which seems interesting. JSW Energy, Torrent Power, two which come to mind as well.
So the one stock that's been on my radar for some time now, KVB, Karur Vysya Bank, we've given this out as a call as well. 231, 235 are the targets, very close to the second target now, but the kind of move that you're seeing, not a bad idea to start accumulating this one. Again, a multi-bagger, for the last couple of years has done rather well. Agnostic of what the market and even the bank nifty is doing. So this kind of profit booking is a good opportunity to get into something like a KVB. So that's the one that I have on my radar. When you mention JSW Energy, you are seeing a bit of an uptick, but this is after the stock hitting the oversold territory. So more of a dead cat bounce. I wouldn't read too much into it just yet.
Okay, Kush, sorry, can I push you? 20-second answer, your top call for the morning based on the pre-open rates.
Karur Vysya Bank targets, 240.
That's what you said. Okay, great. Sorry, I missed it. But so KVB, watch out for that one. 240 is the target. I'm presuming the stop loss would be slightly around 230 or thereabouts. But yeah, we'll revisit this, by the way, viewers. But watch out for KVB if it doesn't really start off with a bang. That's a call from Kush Bora. But here's how the markets are starting off the penultimate day to the budget. Well, in case you didn't know yet, tomorrow is working. Here's the first ticks. Marginally in the green, if you will, despite the bank nifty not doing well. This is now becoming a template. Banks aren't participating and yet the indices seem to be doing okay. Is it IT again, which is playing ball? Let's see, 0.5% higher for IT yet again. Smashed one day because of DeepSeek and recovering very, very well. Mid caps and small caps, 0.25%. This is very interesting. Markets are holding out despite the bank nifty not participating. Let's see if the bank nifty participates in the second half. Bring up the heat map and show you what's moving and what's not. Clearly the mid caps and the small caps also out there doing well. What's doing well? Let's start with that. Larsen & Toubro reacting to numbers. Surprise, surprise. I was wrong maybe. Tata Consumer 2.5%. The street paying heed to the commentary and not the tea business weakness. But 3% higher for that one. I'm really surprised, but yep, Mr. Market knows it's best. Titan up 2%, and then IT, Titan, Infi, Tech Mahindra, all of them. Tata Motors claws back a little bit, about 1%, not too much, and BEL. So by the way, the top 10 have a lot of newsmakers in L&T, Tata Consumer, Bharat Electricals, and then of course, what's happening to the IT pack by and large. But the red is clawing its way back. Coal India is down 2.5%. FinServ corrects a little bit, Airtel corrects a bit, Adani Enterprises corrects a bit, NTPC, BPCL, and some of the metal names. So metals on one side, IT on other side, but Tata Consumer, Tamanna, I was dead wrong. I really thought that the numbers left and the tea business weakness would be something that the street will not like.
Yeah.
But massive uptick given, a big thumbs up. And of course, the standout because of the market cap is Larsen & Toubro.
Yeah, no, Larsen & Toubro on our list, and we called it as a positive because of their commentary. But Tata Consumer, yeah, seems to be shining, as does Titan this morning. But let's take a look at what the broader markets are doing right at the get-go. One day before the big event on the budget, pretty quiet right at start. Range bound and at least in an upward direction, but completely flat on the Nifty small cap 250 as well. Let's pull up the sectoral heat map to give you a sense of what's moving this morning. India VIX right at top, but not really with any major moves. A bit of a range there if you see consumer durables, some IT stocks buzzing, nothing major. On the downside, but Nifty metal, this could be because of JSPL, and we'll have to wait and see what the results impact has been, because numbers were poor. Nifty reality also under some pressure. Again, a Prestige might be pulling that down. So those could be some indicators there. Let's get to the stock specific picture this morning as we take you through what really has worked as well. Navin Fluorine, Clean Science, BEL. I'm just looking at some of those which had numbers and look like good numbers. So Navin Fluorine could be the stock of the morning, perhaps, was on Alex's watch list, about 8% up right now. Clean Science, BEL as well. I want to look at L&T. We've picked that up on the Nifty read up as well as Kalyan Jewelers, who we've had an extensive conversation with. And let's see if we can pull that up for you as well. So all of these reacting to their results this morning. On the other hand, you have Biocon, Praj, and Prestige also seeing some pain. Kalyan Jewelers, they're about 3% up. Biocon, Praj, Prestige, another set of stocks with numbers. Biocon 3% up. Now, optically, those numbers looked problematic, but if you take out the one-time hit, that stock doing well this morning because profits were actually up. Praj Industries about 4% down. Prestige also feeling the heat, about 5% down. Whirlpool in a whirlpool of pain, perhaps, because promoters want to exit, 4% down again. Wockhardt, their drug Xenic has achieved a high efficacy. That exchange filing coming in this morning. Stock is reacting 5.5% up. Let's look at JSPL. Numbers were not great on JSPL. There was some pain there. That stock 10% down this morning because of earnings impact. So a lot of earnings impact, some news over there, but the broader markets are fairly quiet.
Well, I'm glad to say when I'm right, but I should also point out when I'm not. And I was clearly not right on Tata Consumer because that really stood out to me among all of the movers. Even if you say that Navin Fluorine is up over 7%. Tata Consumer is being looked at very positively. And to a certain extent, I did highlight that commentary that came through from the management, and I guess that's what the street is focused on. Dharmesh, the question is, does this sustain? And seemingly that international business, which has mitigated some of the impact of the India inflation on tea and has contributed to the margins, that is being looked at positively by the street as well. Do you like Tata Consumer at this point? Would you buy?
Yeah, Alex, is a surprise to me as well. The price action which Tata Consumer is doing. So there may be pockets of, investors which may be liking the idea, and they may have maybe having a conviction to go ahead with the investment trade. And the other part is, there were no sellers in Tata Consumer. So one is, because of bad news, you have people who want to exit the trade. So that bracket was not there today, and that's the reason why I think this pop-up is seeing the trade. But to my mind, it will be difficult to maintain this drifting trajectory going forward. So from 1,000 to 1,100 journey, I don't think it will be easy for Tata Consumer to make before the next set of earnings.
Okay. Kush, you want to come in on that? We're seeing a pop today, and Dharmesh is trying to explain, and he's being very kind to me. But the street clearly likes what I thought was not very good. What do you think on the charts, though?
There is a breakout. There is a breakout above this 1,000 mark. What I need to see is that whether this sustains for the next half an hour or an hour or so, because this is very well what you call an emotional reaction to the numbers that have just come in, right? So let the dust settle on this one. If this does indeed hold above the 1,000 mark, for the day, in fact, then there is a gap around the 1,070 mark, which could very well come in to get filled. Also, there is the 200-day moving average, which the stock could go on and test. So I wouldn't create a fresh long position, but if I had it, I would certainly ride it with a stop loss around the 985 mark and keep trailing my stop loss higher as the stock goes up. So just be on the lookout if the stock indeed does sustain above this 1,000 mark. Also, there is the call option base that comes in as a bit of a resistance around this mark.
Dharmesh, in terms of what we are seeing both on Navin Fluorine, and let's pull up some others in that space as well. Let's pull up an SRF as well. We had this conversation earlier on, whether this is a turnaround for that space. When we started off the show, would be keen to get your view. Do you think that for the agri-chem space, now that pivot has come in when you're seeing some of their numbers?
Not really, but I'm not very convinced as far as the pivot point is concerned. And couple of days before the budget, you have all kind of action playing to the general economy theme. So be it agri-chemical, defense, infra, all this chemical space, maybe there's some incentive coming for the manufacturing sector or the chemical sector, because they have seen so many bad seasons before. So, the trades are there on the space, but fundamentally, as far as our conversation and checks are concerned, a turnaround doesn't look likely. At best, there can be a stable set of numbers going forward. No further deterioration in the margins and the profitability.
Talking about Tata Consumer Titan this morning, and just you spoke about the budget play, Dharmesh. So I want to ask you a follow-up on that. There is a very strong sense that moves to boost consumption will play out in this budget. Obviously, there's no magic wand that something can be announced and suddenly consumption will go up. But the fact is, urban consumption has been lagging. All indicators are showing that. Is that a short-term strategy that could be looked at, some of your pure consumption plays?
Tavanna, I would be very skeptical on this, because boost can come in the form of some tax relief, and at best, I think 20,000-25,000 for a person who is earning say 15 to 20 lakh income bracket. That is a tax relief can come in a form of some slab, reduction rates kind of a thing. So how much that is going to help the consumption, I doubt. The other play can be the GST thing, but GST is out of the budget purview, so they do it outside the budget. So very difficult to judge as to the quantum of benefit which can come through the budget, which will boost the profitability of all this FMCG and the consumption play. So, but sentimentally, people go with a hope and a positive hope trade, and that is what is being playing out right now.
Let's pull up the weekly chart of Hitachi Energy. It posted its results earlier in the week, and it was a very good set of numbers. And I think people are also focused on the order book, which stands at 18,000 crore rupees. A lot of visibility on that front. Dharmesh, very quickly on this one, would you go out and buy right now, or is it now too expensive? And I'm talking about a move that is just about three days old.
Yeah, Alexei, we had an initiating coverage on Hitachi a year back. That was 4,500, the stock price was. And we were building in a 3-year kind of a story, how this HVDC theme is going to play out. And they are the pioneers in that in the India. And that's basically a game changer for Hitachi Energy. And they have been getting orders to that. But this market surprises us on the price action. So as a fundamental analyst, we have a limitation of justifying the valuation. To my mind, the best price for say FY28 earnings projection was around 12,000 for Hitachi Energy. So it's already trading much above that. But it's a unique play, and you get a premium for such plays around. So if somebody is holding on, they may continue to hold so. But fundamentally, I think all the earnings till FY28 has already been discounted in the price fairly.
Okay. The JSPL is down 10% as well, and the large capex announcement, I don't know if that plus the results combined is leading to this stock really getting pummeled in trade. Look at that cut that has come in onto JSPL. Metals buys by and large are lower, but JSPL particularly looking very, very weak here. What targets can somebody think of? Let's say somebody got lucky and went short, Kush. Let's say you went short in the morning. Would you cover or would you stay short? What levels?
Since Kush, you described yourself as a trader thrice this morning, that question was going to come.
I'd probably take a couple of days off, fall sick, fall sick.
Before Feb 1st.
Oh yeah, absolutely. I mean, this kind of a move, why not?
Think about it.
No. So the first thing is I would partly cover my short positions. One, because obviously this is a very big move on the downside that you've got, and probably slightly on the unexpected lines. Secondly, on the daily charts, this is now hitting oversold territory, so a dead cat bounce cannot be ruled out. But given the kind of nature of the overall move that you've been seeing over the last month or so, I would actually continue holding on the rest of my short positions for target of 715, 710 thereabouts. That's where the medium term support comes in. So the first thing would be to, yes, book it partially. The second is to hold the rest of the position for levels of 710.
This is so reflective of the market as it stands right now, isn't it, Neeraj? You have a long-term story that you bet on just maybe a month back, and then suddenly an update comes and the rug is completely pulled out from under your feet. And how do you react to that, right? And I'm not talking about a trader. I'm talking about an investor that looked at the story and said, I'm going to bet on this company.
No, I think a deeper analysis of what key companies, especially in the infrastructure space, have reported this quarter is required in terms of what they're reporting, because there's some rough surprises there as well that we have seen. But all right, Kush, let's talk about some great opportunities if you're spotting any right now. And we asked Dharmesh what is his pre-budget trade. He said he's not convinced of any. But do you have any in mind for tomorrow that you would look at? Would you look at a defense play? Would you look at a rail play? Even a Jupiter Wagon's not doing too badly this morning.
So, Tamanna, I think more than anything else, I would focus on the agri theme. I'm not sure how much, some of the other sectors are going to get a boost, but perhaps this is going to get a mention, for sure. How big a boost is perhaps only the question here. So, my theme will revolve around, the agri play. Jain Irrigation is a stock which has seen fair degree of volatility, but it's respected its 200-day moving average for the most part. So, with a stop loss and with a very tight stop loss around the 67 mark, that's one stock that I'll consider for levels of 77, perhaps even 82. Coromandel, this is one stock which we've discussed in the past, has seen a bit of profit booking, maybe a fair bit, of profit booking already. But then yesterday we saw a good move. Today we are seeing a bit of a follow through on this. So Coromandel is something that I've got on my radar with targets of about 1900, 1980 odd, support near the 1745 mark. So more on the agri theme. As far as the other consumer space, plays go, I think, a Britannia, Dabur, and as I said, a Colgate is something that I have on my radar. Maybe a bit more move and a bit more push, and might just convert into a call as well. So some of these themes from the budget play.
Okay, speaking of the consumption space, we've been speaking about it quite a bit this morning. Morgan Stanley is bullish on Titan as well as Jubilant Food. Why, you might be asking? And Mahima is joining in to tell you just that. Mahima?
Right, so they've upgraded Titan to overweight from equal weight and hiked the target price to 3876 from 3532. For Jubilant Foodworks, they've upgraded it to overweight from equal weight and hiked the target price from 620 to 781. What they're saying is that consumption trends remain weak and volatile, but businesses that are building growth visibility and are showing efforts will thrive going ahead. They're now of the view that Titan and Jubilant are well positioned in terms of premium and mass discretionary play, and there are three reasons as to why they have upgraded both of these stocks. The first one being these businesses are building customer captivity against a weak consumption backdrop. Second one is strengthening their cores, and third one is steady market share gains is happening in both of these companies. So this is the overall view of the note and why they are bullish on both Titan as well as Jubilant Foodworks.
Okay, thank you for that, Mahima. And consumption definitely in focus, whether you call it a budget play or not, or you look at the premium consumption play, is both ways of looking at. Morgan Stanley definitely looking at the premium consumption side of it, and Titan and Jubilant on track with them. Meanwhile, Kush and Dharmesh, thank you so much for speaking to us today on this. We have a slew of companies that we're speaking to over the next 1 hour, so stay tuned for that. We're starting off with Waaree Energies in focus. Amit Paithankar, whole-time director and CEO, with us this morning. Mr. Paithankar, thank you so much for your time here on NDTV Profit. Let's start by looking at your quarter, and a strong one. The order book has zoomed, your revenues are up 2x, EBITDA up 4.2 times, margins have pretty much doubled. What has really worked in this quarter? And of course, I'm looking at it year on year.
Oh, Tamanna, thank you very much for having us on the show here. Yes, it's been a good quarter for us. What has worked out in our favor, of course, is a very, very strong order book. The order book continues to be very strong. As you might have seen from our press release, we are at 50 crores of order book, which is pretty much a record for us. And this is a record quarter for us from the perspective of revenues, EBITDA, PAT, and all of that. What has worked is a very, very strong execution machinery that we have, which has delivered to customers on time, and a strong order book is being realized.
On this 50,000 crore order book, Mr. Paithankar, what is the execution timeline? Because you just talked about how execution has been core, right, and contributed to this quarter. What is the timeline that you're seeing on this?
Well, it's a great question. So we have about, I would say, about 45% of the orders coming from India and the rest from the rest of the world. The gestation period of orders varies from something like literally a month and a half for retail orders, to all the way 18 months, 24 months, even beyond for some of the export orders. Some of the export orders that we have are actually for 2028. So 3 years out. So there's a big spread. But I would say if you were to plot a median, it will be somewhere in the region of, I would say, 9 to 12 months.
Wow. No, sorry, wait a minute. Are you saying you will execute this whole, let me get this correct, Amit. Good morning, Neeraj here.
Hi, Neeraj.
What is the, very well, thank you. What is the executable timeline you said for 50,000 crores of the order book?
So it's a spread, right? Like
exactly.
I said, the median will be somewhere around 9 to 12 months. But the spread is quite wide, all the way from 1 month, 2 months for the retail orders. So our business comprises of retail, it comprises of large utility orders from India, it comprises of export orders, right? In retail, the velocity of the business is very high. And so you will obviously see those businesses, booking and shipping happening very, very in close quarters, right? But for large utility scale orders, it needs a little more planning. So it takes about, I would say, anywhere between 9 to 12 months. And some of our export orders, especially in the US, are a little more long term. I mean, these are typically 1 year in advance. These are booked 1 year in advance, and therefore the gestation period is a little longer.
Got it. Okay. But since 45% is from India, so it includes those orders for sure. I was just trying to preempt or back calculate what's the kind of execution that you do in the next 12 months. But maybe I'll ask you that formally. What surprised me though, and maybe positively, I don't know if you see that as a surprise, but I don't think too many people were penciling in such strong margin upticks and so soon, right? It was believed that it will come in gradually, if at all. In fact, there was fears of whether the margins will come off because of all that's happening in the US on the cost front, etc., or the pricing front. What's led to this, and is this a new normal, Amit? What you've done in Q3?
Great question. Well, in terms of jump quarter on quarter, we are seeing a very, very healthy jump. That jump, whether it will be consistent over a large period of time, is something that we will have to keep observing. But the profitability levels that we are looking at, we pretty much be at this level or maybe even better as we move forward. And so, and let me deconstruct that a little bit. And you talked about US and a lot of discussions around US order book and so on and so forth. Number one, the US order book is extremely strong for us. There is no change in the past 1 month after the change in dispensation in the US as well. So that's an important factor to consider. And because of the gestation period, what happens is that our sales profile doesn't really mimic our orders profile, right? So that's, if you see our sales profile, about 18 to 20% comes from the US market, and the rest is largely from the Indian marketplace. And so therefore we have many levers that we can play with for profitability. And that's something which we continuously discuss within the organization to ensure that our execution is on the dot, our profitability numbers are on the dot. It's all about executing, and it's all about keeping an eye on all these numbers as we move forward.
We want to welcome to the conversation Sonal Srivastav as well, CFO of Waaree Energies, as we take this forward. Thank you for joining us, Sonal. Mr. Bhattankar, I just want to follow up on your point. You're saying no difference from the US orders in the last month of the new dispensation taking over. Is it early days? What is the size of your US revenues or contribution of US revenues? Or US business to revenues, and when you have the new dispensation and President Trump saying make in America, tariffs on everything, how does that impact you?
The great question again, Tamanna. So once again, revenue contribution up until now for this entire fiscal 9 months has been in the region of 15 to 20% from the US business for us. We are uniquely placed, Tamanna, because we have a manufacturing facility in the US as well. So depending on the way in which US decides, if it's make in America, we do have a factory which is already up and running. We declared commercial operations on the 22nd of January of this year. And so we can play we have several levers in our hand to actually play this game well.
Sonal Srivastava is with us as well, as we said, and Sonal, I mean, I was asking the same question to Amit as well about the really strong uptick in margins. Now he's given his view that this is not necessarily a one-off, etc. I would love to know. One is, of course, what business factors bring in. Other is what cost controls bring in, pricing brings in, etc. What's your sense about this performance and the outlook ahead?
No, thank you very much for having me, and a very good morning to all your viewers.
Thank you.
Our business is all about margin management. So, we look at all our sourcings very closely with our order book. So as soon as we have our order book, firm, we look at what all raw materials we can tie up quickly and therefore secure our margins. And this continues. And you will see in this quarter, we've almost got a 5% fillip on our raw material margins. So it's a constant endeavor. As far as cost control and other aspect is concerned, which is the manufacturing and other overheads, you will see they've grown because we are straddling growth. So year on year growth, 35% on the manufacturing side for the quarter, a big jump on other costs, but it's all growth planning, and it's kind of comes in line with the revenue top line growth as well. So we want to keep that momentum going into the coming months as well.
We are slightly pressed for time, so I'll ask one last question to Sonal here. But my request would be that because it's earnings season, it's a bunched up set of conversations. Sometime during the month of February or March, we would love to have the two of you again to try and understand in great detail what 2025 could hold in store. So I please take that request on board. But one last question, Sonal, to you, and that is around the fact that because you have a large global business or export business, and the dollar and the rupee equation, or the dollar and the global currency and rupee and global currency equation is the talk of town, right? How difficult is that situation to balance out? Is that something that could maybe become a point of concern at some point of time in the future?
So as far as this hedging strategy and how we look at managing our dollars, it's very closely followed. What we do is we plan that on a month-on-month basis. We have a natural hedge with our export orders as well, and the profitability that goes with it. We also receive advances as we book new export orders. So I don't see that as a problem. Plus, we also have some orders which are dollar-linked. We tie in some prices which are a fixed basis. So all in all, it's a very much part of our cost strategy and managed on a live basis.
Okay. Like I said, listen, we would have loved to talk for another 15 minutes, to be very honest. There's just so much to talk about, Waaree, but slightly pressed for time today. Thank you so much, both of you. Congratulations on a fabulous quarter, and all the best for the quarters ahead.
Thank you so much.
Thank you very much, Tamanna and Neeraj.
Well, the pleasure was entirely ours to have you. As is our pleasure to welcome in Suresh Sethi, MD and CEO of Protean eGov Technologies. They came out with a quarter wherein the revenues were down 8%. Margins came off a little bit as well. Let's get him in on the screen when we ask him the first question about his quarterly numbers. And Mr. Sethi, the question is, while the street is used to fairly strong performance in the previous quarters, what went wrong this quarter? Why the margin downtick on a quarter-on-quarter basis?
Yeah, Neeraj, good morning. Thanks for having me here. So Neeraj, very quickly on the overall revenue.
Sure,
the revenues
let's start with
down.
that.
Yeah, the revenues are down this quarter primarily because of the PAN numbers, the taxation business, where we have seen there has been a compression in the market overall. Largely, it was led by the fact that last year there were some, significant scheme launches and Aadhaar PAN linkage deadlines, which haven't, come about this year. So while we clearly believe there's a strong story, as we've always said, that the PAN penetration in the country is not more than 35%, but due to some of these trigger events, the numbers last year were higher, and that is where we see a year-on-year reduction. And that has been a contributor. But the good story from our part is while the overall market shrunk, we've increased our market share. And that in a result has arrested some of the low numbers which we've seen at a market level. And that is where we see it now. So it's reasonably flat as we look at year on year.
So, Mr. Sethi, good morning. Tamanna here.
Good morning.
In terms of these events that you're talking about, are you referring to Aadhaar PAN linkage, which pushed up numbers last year?
That is right. So last year, Tamanna, let me put it, maybe elaborate more on it. Last year, the numbers had a spike to it. So when we do a year-on-year comparison, the numbers look lower, but the headroom clearly is there. And that is what I meant by saying that PAN penetration in the country is around 35%. And therefore, definitely this continues. But what we saw was the fact that last year, there were some spiked volumes because of some scheme issuances, which is DBT schemes, where PAN in some cases is mandated to be provided for availing the benefits. And likewise, in case of Aadhaar PAN linkage, we did see a spurt as there was a deadline approaching in this quarter last year.
No, so that was my point, Mr. Sethi, and I agree that PAN penetration in the country is far from optimum. Having said that, though, the two big triggers have now ended, right? Those timelines have expired. DBT schemes, of course, will require more onboarding, but the Aadhaar PAN linkage is expired. So what does that mean for an earnings trajectory going ahead? When I see your margins that have dropped here to 10.3%, is this now the new normal, and the 14% that we saw as a comparative was excessive?
No. So, let me first clarify on the first point with regard to the PAN issuance. Now, the PAN issuance is today being linked to multiple things. We've recently seen a new development where IUs have been, or the utility companies have been asked to now allow PAN as a validation mechanism for identification of the stakeholders over there. Similarly, PAN today is used in multiple places. Any new schemes which get introduced. So I'm just picking up one part on government benefit schemes, which could be by the central or the state government. All of these require PAN as a validation. So any beneficiary who's eligible and does not have a PAN needs to therefore apply for a PAN card. That is what I meant. And new schemes are coming in, we see as we go by. Clearly, PAN is today very much a core instrument as part of the regulatory guidelines for account opening. It is used for property transactions. So clearly, there is a thrust for this line of business to continue to grow. So that should not be something that we see. This is just a momentary quarterly comparison year on year. So that addresses the PAN part. And when we look at the overall performance, I think this again has been a blip compared to last year. But otherwise, we always call out two parts. There have been investments into new businesses, and that is where the margin profile has come down. But we clearly see a trajectory where the new businesses are now contributing. And these are largely SaaS and annuity business, as we've been calling out earlier, whether it is our data stack business or the work we are doing in ODEs. And as these gain traction, we will clearly see a move towards a better margin profile.
Got it. Mr. Sethi, so clearly, I mean, the clutch of people who invested in your business during the latest stock sale that happened as well are all very confident about what happens, not just right now, but let's say over the next 5 years. I would love to understand, sir, as we stand at the start of 2025, how do you view either the next 12 months, because I think 3 years is too long a time in the current scenario, but if you have some visibility there, just leave us with that maybe. I mean, what do you see the next 3-year CAGR performance likely to look like, if you will? On whichever metrics, sir.
So Neeraj, I'm not going to specifically
not a number.
Looking number.
Yeah, not a number. I don't want a number, sir.
Let me do a sort of a quick breakup of the businesses. So core businesses remain strong, and I will take less time and talk more about new businesses because that is clearly where we see the new growth momentum coming in. So PAN, pension, and ID. These are the core businesses we have been involved in. And these do contribute over 95% of our top line today. And these we've already spoken about. PAN definitely strong because there is the overall, thrust over there of the utilization of the tax ID in various schemes and various transactions that we do. Pension, a huge thrust again, as we've seen that, the pension remains a core business. We are one of the dominant players with almost a 97% plus market share and strong thrust because as a pension society, we have a 6% penetration, but a pension penetration, whereas in developed countries, the US today maybe is around 70% plus. So again, a good headroom over there, and we see a momentum this year also. We are 12% up compared to last year in terms of our revenues. ID very strongly linked with the core digitization of the country. Now, let me quickly swing into the new businesses. So when we look at ID, we are building a data stack on top of it, which is a value-added service, whether it is a documentation suite like eSign Pro, APIs, and that is what I meant. These are annuity businesses. So there is a consumption pattern, which is there with B2B market. And we have early, sort of penetration into the market now. And whatever we secure as a revenue in 1 month, the same carries on for the next month, and then new customers come in. So it's annuity in nature, SaaS driven. Open digital ecosystems is a big thrust. We see work in agri, we see work in ONDC, and it's a market play because as the network grows, we see our SaaS businesses picking up over there.
Sure.
And last but not least is what we are looking at doing in the international markets, where we take the same stack overseas into different geographies and try to multiply it from there. So we do see the new businesses coming in. And our confidence lies in the fact that these are annuity in nature. So whatever we see as the green shoots this year, they will definitely become strong and go month on month next year.
Okay, thank you so much, Mr. Sethi, for your time and answering all of our questions this morning. We are on a roll today on India Market Open. We're speaking to a whole lineup of companies this morning on their numbers, and our next conversation is with Mr. H.M. Bangur, Chairman of Shree Cement. Mr. Bangur, a very warm welcome to you to NDTV Profit, and thank you so much for speaking with us on your numbers. I'll quickly go through what the key metrics have been. Revenue down about 12%. The EBITDA has also been down about 23.7%. Margins have come off a little, and net profit has come down as well. But this is, in terms of estimates, exactly what was expected. In fact, the EBITDA is a beat and profits in line. Let me get this commentary from you, Mr. Bangur. The problem has been muted demand growth, isn't it?
Demand growth is one part, but it is basically the base effect. Last year, the December quarter was by far the best in the company history. But when we see sequentially, the volume growth is highest in the industry. So far, the results which have been published, about 16%. The profits are also healthy. But last year, this quarter was very, very exceptionally good. Good power demand was there. Good margins were there. We had low priced coal with us. But now that is there. But going forward, our cost control is, you can see, is much better. It is about 9% lower cost. So going forward, we expect margins to be still better.
So let's look at that outlook. You are expanding capacity quite aggressively. Are you looking at demand matching up? Because you talked about the base effect, and that's understood. I'm just trying to understand what the demand picture is as per you.
Demand will be growing in India by about 8% or so. Normally, in the past, we have seen the demand growth is 1.3 times the GDP. Even by conservative estimate, if I see that GDP grows by 6%, then also demand will be growing by 8%. So demand growth is very healthy.
Where is that growth coming from? Are you, because I'm also speaking to you ahead of the budget, are you hoping for more government capex to come and push it? What is the private demand looking like?
Government capex will be definitely coming in. Because again, here the base effect, this year the government spending was quite low compared to all other years. New projects startup was low. All the pent-up demand should be coming in the coming year. Secondly, when we see the profile of the individual house builders, whatever money was being made by the time he was 45 and thinking of making a house, now that he is able to earn that much, and younger people of around 35 are making the houses. House buildings is much faster in the personal sector. Everybody now is able to afford a house, so it seems.
Well, which is actually good news, even though the income growth is not looking that strong per se. Household debt has actually gone up too. But Mr. Bangur, good morning to you. I heard your comments about the unit EBITDA so well, but that's not a surprise, right? You've done this all through and through your entire life cycle. How do you see these shaping up in the quarters to come? Is what you've delivered in quarter 3, is that a sign of what you could do in calendar year 25, or could it be better if pricing improves, sir?
If the pricing improves, everyone will be much better off. And prices are expected to improve, as if we see in the last 10 years, cement prices have only grown by 1% CAGR. 12% increase or so in last 10 years. So cement price increase in the building construction material industry is much lower compared to even bricks or steel or anything. So the price rise, maybe next year, maybe after 2 years, but the price rise has to be there. The cement industry's margins have come down over the years, and the margins are maintained because those who are able to cut costs, improve efficiency, are able to do better.
Okay. Sir, where, I think Tamanna asked this to you earlier, but where within the regions do you foresee the strongest probability of demand growth? Because we know this quarter north pricing helped you, but where in terms of demand would the likely strongest growth be according to you?
Maximum growth can be and should be in East India, as the base, again, the per capita consumption of East India is by far the lowest. But the price can be good only in Central and North India, and there is not enough capacity in Central and North. East has still overhang of some capacity, but the growth will be much better here. That is what we expect.
Sir, what was your EBITDA per ton this quarter?
It is around 1,080 rupees.
1080.
Yes.
And what is the outlook for it when you close out the year? The financial year?
Close out the year, total EBITDA I will not be saying, but next quarter should be better than this quarter in the terms of quarter EBITDA. That's all we can right now say. After all, it is a commodity, the markets can change overnight.
Of course, of course. So that I assume from that statement that Q4 so far has been an improvement over Q3.
Of course, with a lot of confidence I am saying this.
Okay, that's important. Thank you so much, Mr. Bangur, for speaking with us, Chairman of Shree Cement. We've had a busy morning here on India Market Open, but a lot more on the other side. We're taking a short break and we're coming back with so much more on the markets. Stay tuned.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks the impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's of course the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be lesser compared to the previous budget.
The pattern in the last 3 days is different for the market. We are up 0.5%, with small caps up 0.74%. More importantly, strong results are being rewarded. Hitachi Energy is up 11.5% after being up 20% yesterday. This is not a cheap stock, but getting rewarded. Kalyan Jewelers 10% up now. Am I getting it wrong? No, I'm not. Pull up Kalyan Jewelers after getting pummeled out of shape. 10% higher. The management spoke to us first today. We'll make you hear what they said. Naveen Fluorine up 9%, and Suzlon is up another 5%. Not to forget that Larsen and Toubro, the big boy, is up 4.4%. Some serious moves there. Maybe it's missing in autos though, because the January sales numbers are just round the corner. Let's try and figure out what's the kind of numbers anticipated. Rucha joins in this time for that. Rucha, good morning. What are these numbers?
Good morning. So, according to Nomura, Jan 25 registration data mostly reflects the kind of discount that were, given in December, and therefore they expect discount to rise going ahead as January had low inventory. Now, in terms of what Jefferies believes, that it believes that registration data for Jan shows strong growth, and therefore they prefer M&M, Eicher Motors, and TVS. Now, in terms of estimates based on the total wholesales volume, Maruti Suzuki expected to report around 7% growth according to Nomura and 5% growth according to Jefferies over here. Moving on to Bajaj Auto, both largely expect around 5 to 6% of growth over here. Hero MotoCorp again 4 to 5% lastly, but M&M is expected to report a strong growth at 11% for both these brokerage houses. Lastly, muted growth expected in Tata Motors and Hyundai Motor India around 0 to 2%, and TVS Motors also expected to report strong growth at about 16% according to Nomura and 11% according to Jefferies. So strong growth expected largely in M&M and TVS Motors, and muted expected in Hyundai and Tata Motors as well. So this is what we have on auto sales preview for January.
Thanks a lot for that. Thanks a lot for that, Rucha. Now, well, it's a delight to speak to Shishir Joshipura. It's always a delight to talk to him. And while we talk about Q3 numbers, which are well below estimates for sure, and I'll ask him about that. I would love to know about how does he see what is the picture in India with regards to all forms of new energy for 2025 and beyond. Mr. Joshipura, it's been a really long time. So good talking to you today. Thanks so much for taking the time out and speaking to us.
Good morning, and good morning to all your viewers as well. It's always a pleasure to speak with you.
Thank you so much. Mr. Joshipura, what happened in the quarter? I mean, the statistics that roll out, because clearly there's a big hit, right? Margins at 8-quarter lows, etc. Profit after tax at 10-quarter lows. I mean, are there one-offs that that impacted the quarter 3?
Well, actually, if you go to look at the quarter, it was a very different kind of a quarter, yes, from what has been the norm so far. And what's important to understand is the resilience that this quarter has shown, and let me break that down for you. First of all, our order booking is actually ticked up. For the last 3 quarters, we are continuously improving our order booking, so which is good for our business as we move forward. It allows us to get the growth back into the business. That's number one. Number two, we have said that our strategy is to move to a 50-50 international and domestic split starting at 1882. And I'm very glad that this quarter we saw a 40% order book coming from international business and 60 from India. So, and this is a gradual movement that happened from 25 to 30 to now 40. And we don't see a let up on that. We see that will continue to build. So strategically speaking, a higher value accretive business, the growth dimensions there is moving in the right direction. On the other hand, we have had a bit of a challenge on this particular quarter because the order mix was slightly different compared to what we have done in previous times. But if you look at 9 months results, our margins are 500 basis points up comparatively speaking. So it's just a quarter thing for the business. And I don't think that there is any reason for us to believe that any vector of the story has changed. It still remains intact. It's very much there. I will also talk about our engineering business, where we have started to build a very state-of-the-art facility in Mangalore that we have talked about in Praj Industries, where we have started to invest, and that's a facility which will start to show revenue. Although this year is all expenses, next year onwards it will start to show revenue, and then that will start to change. So if you really look for it, almost 75 crores worth of expenses are now sitting in the 9-month results, for which there is no corresponding revenue. And if you then normalize the results, suddenly things will start to look exactly what we've been saying. So, one, two, the overall story on green energy, on push for bioenergy that we have talked about, nothing has changed. It's still very much there. And very present in all the markets that we are serving, and it is continuing to moving and develop in a very positive way.
Okay, so Mr. Joshipura, good to know that a lot of the factors that impacted Q3 were Q3 specific issues and not necessarily something that will last over a long period of time. I would love to know how do you see the completion of plants and policies with regards to, I mean, there was some meeting around ethanol pricing as well, but be that as it may, on all forms of bioenergy, including CBG, and that coupled with the new plant coming in, what's the outlook for 2025?
Yes, so as I said, that we expect the growth to return back to the numbers as well, what we've been talking about.
You think?
And I absolutely no doubt. Sorry, I'm saying I expect the growth to return back to the company. I have absolutely no doubt about it. Our order book is a clear foreteller of fortune in that sense that it is increasing quarter on quarter for the last 3 quarters. And the most important part is it is increasing from what we have targeted as business strategy. It's not a happenstance growth. It's something that is strategically built, and absolutely no doubt in my head that we will go back on the growth path. This was an unusual quarter where some order mix change, the way it happened before and what had happened in third quarter was different. And that is the result. Also, as I mentioned to you, the engineering business is now developing. It has come to a stage where I can come show the facility to our customers, which is an important requirement. They have to audit and improve it and approve it. They have now approved, at least 4 customers have approved, the large customers. So we'll start to see action and revenue emanating from that facility next financial year onwards.
Got it. This new facility that comes up that you spoke about, Mr. Joshipura, does it come in the second half of the of the financial year 26 or earlier on? And typically, yes. I mean, what's the kind of capacity utilization ramp up that happens in a facility like this?
So the way this works is the contracts that come to that facility typically are a little long-term execution cycles. They are not short-term execution cycle. So they would typically weigh between 12 to 16, 18 months kind of execution cycle. And as we start to build the order book for that particular facility, it will then go into the execution cycle. So actual results in terms of its revenue and recognition, you'll probably start to see near the second half of the next year. When it starts, that's exactly when you will start to see the results. Till that time, we have to first build it, we have to keep it ready, we have to get it certified, and we have to get all the machines humming and running. As I speak with you, we are also executing our first contract out of that facility so that the whole process gets settled. Absolutely no doubt in my head that all the vectors that we have talked about are very much present, and we will see them unfold as we move forward.
So, Mr. Joshipura, here's my question, all right? I mean, there's just so much of promise within the space that you operate in. You are the leader in almost a bunch of key technologies that you guys are present in. The numbers, let's say from even March 2024 quarter till now, are kind of around the same levels, right? If you will, revenue front, EBITDA front. In fact, EBITDA 9 month has been very good. Profitability, which was very strong in the first 2 or 3 quarters. This quarter has come off, but otherwise kind of in that zone. When does the how do I say the inflection point or the J curve to your mind come in, sir? I mean, does it happen at a particular time cycle in the next 12 to 24 months, or does it happen because of some capacities or otherwise, or some policies coming on place?
Well, I think very, very great, good question. So for the bioenergy business of ours, I see a very clear pathway where number of initiatives are actually started to unfold. We have talked about ethanol and everybody has talked about it, but there is much more than ethanol. There is CBG that is developing positively now. There is SAF, on which there is a lot of activity that is beginning to take place. Although there are no regulations in place yet for SAF, we expect that will happen as we move through the this calendar year. And once that starts to play their own place, I'm sure that we will see a much more differentiated growth coming across. I also mentioned about the fact that a lot of our business will come from our overseas markets. And these are targeted actions that we are taking, very strategic positioning that we are doing. We are building organizations in United States, in Latin America, in Africa, and we are very, very sure that these markets will start to return. They have already started, and will continue to build strongly as we move forward through the year. So that's the second part of it. The engineering, so while the bioenergy business is very strongly driven from what we do on the technology side, and I will talk about a very, very important development, or let me take it up now itself. We announced the launch of biobitumen as a product from just about a month ago when Honorable Minister Gadkari inaugurated the first stretch of national highway near Nagpur that was built using biobitumen technology that we have developed. Now, that is a technology that is set to dramatically alter the financial viabilities for CBG projects that are based on agri-waste or any other waste that is rich in lignin. And that's now beginning to play out. When that happens, I'm sure that we will see a very different dimension emerge in the CBG space from the perspective of developer and promoter, that how it will move forward. We are very, very confident about several other measures that we are taking, even on the ethanol side of business, where we have decided that if we can use technology to deliver co-products, and co-products are those where the input feedstock does not change, either in quantity or quality, and we just create higher value-added streams beyond the main product line. And that's what is going to happen in form of several products that we are going to launch now. We are talking of a new blending program. So there are several initiatives that are on the way where technology will play a role.
Wow. Well,
then I move on.
Please continue.
Then I move on to the engineering. Then I move on to engineering business, which is a little different business than bioenergy. In bioenergy, we keep on investing into developing of technology. So it happens over a period of time because I can't do everything in a short period of time. Technology development takes its own. That's something that we've been working on for quite some time. In the engineering business, especially in the EPCS space, I have to build an infrastructure first. And therefore, I need to create a large infrastructure, which we have done now in Mangalore. And that infrastructure, once it is on ground, it takes something like 12 months. So first 12 months is the building time. Next 12 months is what I would call as the operationalizing time, and then it just starts to hum and roll. And that's what is going to happen on the engineering business side. If you look at our PHS business, Praj High Purity, which serves, that also, in fact, the last quarter was a very, very good quarter for them. They completely turned around the first 2 quarters performance on that, and they have started to go back to where we intended them to be. So third quarter, an aberration, but that is not foretelling about the company or its future. Overall, if you look at 9 months, we are still good on margins. We are flat, we're not growing, but these initiatives that I've told you about will help us to grow.
Got it. Well, Mr. Joshipura, it's just the crunch earnings season, and therefore can't ask about some of these wonderful things that you spoke about. But biobitumen, very interesting if it actually becomes mainstream. And I look forward to maybe talking to you post the earnings season madness about the newer technologies and higher value-added products on the ethanol stream too. Well, lovely to understand some of these because they make a real difference to the country as well. So all the best for that. Thank you so much for speaking to us today.
Thank you. Lovely speaking with you.
That's Praj talking about how Q3 is a bit of a one-off elements out here. Not quite the same. 9-month margins, Tamanna, have actually looked not bad. But the street, of course, has punished the stock today because the drop in margins slightly more than what was anticipated.
Yeah. So that's the story with Praj, but decent bit of recovery in the markets. Let's just pull up the Nifty for you, and not half bad. Nifty with a bit of recovery, come off actually. The highs right now is about 0.5% up. Bank Nifty is what is worrying and is in a world of pain as well, about 0.5% down. But some of the movers this morning, and among them is Kalyan Jewelers. Kalyan Jewelers has been buzzing, good set of numbers. The stock is about 10% up now. We had an extensive conversation earlier this morning with the company's executive director, Ramesh Kalyanaraman. And he talked about the FY27 EBITDA margin guidance, among other things, and of course the quarter gone by. Listen.
Again, you should look at it in 2 ways. If you are looking at PBT margins, even the first 9 months this year versus the 9 months last year, if you negate the metal loss, PBT margins have grown by around 0.2, 0.3%. Okay. And the way we should look at Kalyan Jewelers is PBT margins again, rather than EBITDA margins, because I told you EBITDA margins will degrow. Because if you look at, now we are at 40% franchisee revenue versus 60% owned store. If you look at 50-50 in the next year, then EBITDA margins will be only in the range of 6.5, right? So it will again degrow from where we are today. So you should look at the PBT margins. PBT margins are growing. If you negate the metal loss, PBT margins have grown in this year also. And for FOCO model, you know that the PBT margins are higher than our COCO model.
All right. Another stock which is not doing too well today is JSPL. The company's Q3 earnings were disappointing for the street, with the stock now 10% down. Why is JSPL being punished by the street today, Mihika?
So the stock is down 10% on an intraday basis. It's the steepest fall it's seen since June 4th of 2024. Now, EBITDA did miss estimates by 3%. And this is the first time JSPL has missed its estimates in the last 4 quarters. In terms of your EBITDA estimates, they have been cut by brokerages. Nuvama has cut FY26, FY27 estimates by 13% each. ICICI FY26 EBITDA estimates for JSPL cut by 12%, FY27 by 23%, and MOSL has also cut FY26 estimates by 17%. In terms of what went wrong for JSPL, well, sales volumes did come in lower than expected at 1.9 million tons. EBITDA per ton was down 27% on a year-on-year basis, and also did not see any sequential improvement and stood at 11,494 rupees per ton in Q3, because the benefits of the lower coking coal prices and higher steel prices were offset by higher iron ore purchases from the market, because the input from the company's captive iron ore mines were lower. And lastly, the main pointer is that the company has announced 16,000 crores of fresh capex. This comes over and above the 31,000 crore announcement that has previously been made by the company, and only 76% of the previous capex has been sent. And as per ICICI Securities, the fresh capex in the current environment with lower spreads could be a key deterrent to the stock performance of the company, and can be a key overhang until more clarity comes by.
Yeah, Mihika, the capex is the big culprit. But Bank of Baroda up. Mihika, thanks for that. Now Bank of Baroda up next, and Harsh, looking forward to the conversation.
Well, yeah, we have with us Mr. Devadatta Chand, who is the Managing Director and CEO at Bank of Baroda. Interesting, because margins have come off sharply. I'd be curious to understand as to why that is so. And growth is holding up quite well. In fact, better than industry, 12% YOY growth in this quarter. Roughly 3% odd on a sequential basis as well. So very, very healthy growth. Let me first start off, sir, by understanding from you whether this kind of growth clip is sustainable for you, 12% YOY.
Broad number basis, what the bank is working out is to have a sustainable business model, right? If you look at the growth in deposit advances, it's something not only strong this quarter, we also had a strong earlier quarters and consistently for the last many quarters now. So looking at the current scenario in terms of growth of deposit and advances, the growth has been fairly balanced this quarter at 11.8%. And earlier, when we had given a guidance on the deposit for the full year at 9 to 11 and advances at 11 to 13. And if you look at the deposit in this quarter, rather we exceeded the guidance. On the advances side, if you look at the component of advances, the retail continue to grow more than 20%, like almost 20% for many quarters now. And that is something sustainable going forward also. Similarly, on the agri and MSME, if you look at the December quarter YY growth, it is almost 200 BPS higher than the September YY. So there clearly we have the traction, clearly balance out the business model in terms of growing faster in these two segments. The only component where we slightly moderated is on the corporate loan. While saying so, corporate loan, clearly mindful of the cost structure happening on the deposit, and typically the segment where we slightly moderated the growth is on the finely priced book, which definitely high quality, but these are typically refi transaction or something of a takeover transaction, right? So there we slightly went slightly moderated the growth. So on a full year basis, if you look at the corporate growth going to be more than 10%. The agri and MSME for the full year going to be 14% or in excess of 14%. Retail continue to grow at 20%. In that way, the guidance of 11 to 13% on the advance side, which we had given, I think we will be at the upper band of that, rather we will be in a position to exceed that also. So going by the scenario that prevailing, and particularly this March quarter is something different because there is a liquidity measures, there is a rate stance expectation, and I think these are all positive for the banking industry. And that can typically put us into a very strong growth for the full year also. And as I said at the beginning, we are working on a very stable and sustainable business model. I think FY26 also will be clearly replicating the same growth model for the bank.
Right, but sir, the major concern where the street is concerned as well is with regard to margins. They've come up from 3.1% to 2.94% on a sequential basis. You've also trimmed your expected guidance band with regard to NIM from 3.1 to 3.2% was the band. Now it's 3 to 3.1. Where does it lie, and what's the context? How quickly can you get back to that 3% number?
See, that is what actually our earlier guidance to operate between 3.10 to 3.20, and now we are saying that because of the cost dynamics on the deposit market, we'll operate 3 to 3.10. So clearly my 9 months NIM is 3.08, right, at this point of time. So considering the current scenario, I think we'll be operating in the band of 3 to 3.10. Saying so, clearly there is a cost pressure which already we have seen not only for the bank, but all the banking players in the industry. At the same time, if you can optimize on the income side, then possibly we can sustain your margin. So in a scenario like that, we have demonstrated for 9 months that we can still operate in excess of 3% on the NIM side. And although we do have a significant global book where the margin is much less. So the domestic NIM is...
आज बजट सत्र के प्रारंभ में मैं समृद्धि की देवी मां लक्ष्मी को प्रणाम करता हूं। और ऐसे अवसर पर सदियों से हमारे यहां मां लक्ष्मी का पुण्य स्मरण किया जाता है। सिद्धि बुद्धि प्रदे देवी, सिद्धि बुद्धि प्रदे देवी, भुक्ति मुक्ति प्रदायिनी, भुक्ति मुक्ति प्रदायिनी, मंत्र मूर्ते सदा देवी, मंत्र मूर्ते सदा देवी, महालक्ष्मी नमोस्तुते, महालक्ष्मी नमोस्तुते। मां लक्ष्मी हमें सिद्धि और विवेक देती है, समृद्धि और कल्याण भी देती है। मैं मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे। साथियों, हमारे गणतंत्र के 75 वर्ष पूरे हुए हैं। और ये हर देशवासी के लिए सर्वाधिक गौरवपूर्ण है और विश्व के लोकतांत्रिक जगत के लिए भी भारत का ये सामर्थ्य अपनी एक विशेष स्थान बनाता है। साथियों, ये देश की जनता ने मुझे तीसरी बार ये दायित्व दिया है और इस तीसरे कार्यकाल का ये पहला पूर्ण बजट है। और मैं विश्वास से कह सकता हूं कि 2047 जब आजादी के 100 साल होंगे विकसित भारत का जो संकल्प देश ने लिया है, ये बजट सत्र, ये बजट एक नया विश्वास पैदा करेगा, नई ऊर्जा देगा कि देश जब आजादी के 100 साल मनाएगा तब विकसित होके रहेगा। 140 करोड़ देशवासी अपने सामूहिक प्रयास से इस संकल्प को परिपूर्ण करेंगे। तीसरे टर्म में हम मिशन मोड में देश को सर्वांगीण विकास की दिशा में, चाहे वो भौगोलिक रूप से हो, सामाजिक रूप से हो या आर्थिक भिन्न भिन्न स्तर के संदर्भ में हो, हम सर्वांगीण विकास के संकल्प को लेकर के मिशन मोड में आगे बढ़ते जा रहे हैं। इनोवेशन, इंक्लूजन और इन्वेस्टमेंट, ये लगातार हमारे आर्थिक गतिविधि के रोड मैप का आधार रहा है। इस सत्र में हमेशा की तरह कई ऐतिहासिक बिल पर संशोधन को चर्चा होगी और व्यापक मंथन के साथ वो राष्ट्र की ताकत बढ़ाने का काम करने वाला कानून बनेंगे। विशेषकर नारी शक्ति के गौरव को पुनः प्रस्थापित करना, पंथ संप्रदाय के भेद से मुक्त होकर के हर नारी को सम्मानपूर्ण जीवन मिले, उसको भी समान अधिकार मिले, उस दिशा में इस सत्र में कई महत्वपूर्ण निर्णय लिए जाएंगे। रिफॉर्म, परफॉर्म एंड ट्रांसफॉर्म। जब विकास की तेज गति को प्राप्त करना होता है तो सबसे ज्यादा बल रिफॉर्म पर रहता है। राज्य और केंद्र सरकार ने मिलकर के परफॉर्म करना होता है और जन भागीदारी से हम ट्रांसफॉर्मेशन देख सकते हैं। हमारा युवा देश है, युवा शक्ति है और आज जो 20-25 साल की आयु के नौजवान है, जब वो 45-50 साल के होंगे तब वो विकसित भारत का सबसे बड़े बेनिफिशियरी होने वाले हैं। उम्र के उस पड़ाव पे होंगे, नीति निर्धारण की व्यवस्थाओं में उस जगह पे बैठे होंगे कि वे गर्व के साथ आजादी के बाद जो शताब्दी शुरू होगी, एक विकसित भारत के साथ आगे बढ़ेंगे। और इसलिए ये विकसित भारत के संकल्प की पूर्ति का प्रयास, ये अथाग मेहनत, आज जो हमारे टीनेजर्स हैं, हमारी युवा पीढ़ी है, उनके लिए ये एक बहुत बड़ा तोहफा बनने वाली है। जो लोग 1930 में 42 में आजादी के जंग में जुट गए थे। पूरी देश की युवा पीढ़ी खप गई थी आजादी के जंग में, और उसके फल 25 साल के बाद जो पीढ़ी आई उसको नसीब हुए। उस जंग में जो नौजवान थे उनको नसीब हुए। आजादी के पूर्व के वो 25 साल आजादी के जश्न मनाने का अवसर बना। वैसे ही ये 25 वर्ष समृद्ध भारत, विकसित भारत, ये संकल्प से सिद्धि और सिद्धि से शिखर तक पहुंचने का देशवासियों का इरादा। और इसलिए इस बजट सत्र में सभी सांसद विकसित भारत को मजबूती देने के लिए अपना योगदान देंगे। विशेष करके जो युवा सांसद है उनके लिए तो सुनहरा अवसर है, क्योंकि वो आज सदन में जितनी जागरूकता, जितनी भागीदारी बढ़ाएंगे और विकसित भारत के जो फल है वो तो उनकी नजर के सामने देखने को मिलने वाले हैं। और इसलिए युवा सांसदों के लिए एक अनमोल अवसर है। साथियों, मैं आशा करता हूं कि हम देश की आशा आकांक्षाओं के इस बजट सत्र में खरे उतरेंगे। साथियों, आज एक बात आपने जरूर नोट की होगी, मीडिया के लोगों ने तो जरूर करनी चाहिए। शायद 2014 से लेकर अब तक शायद ये पहला पार्लियामेंट का सत्र है कि जिसके 1-2 दिन पहले कोई विदेशी चिंगारी नहीं प्रगटी है। विदेश में से आग लगाने की कोशिश रही हुई है। 10 साल से यानी 14 से देख रहा हूं, हर सत्र के पहले शरारत करने के लिए लोग तैयार बैठते थे, और यहां उसको हवा देने वालों की कोई कमी नहीं है। ये पहला सत्र मैं पिछले 10 साल के बाद देख रहा हूं कि जिसमें किसी भी विदेशी कोने से कोई चिंगारी नहीं हुई। साथियों, बहुत बहुत धन्यवाद।
STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh That was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we'll take you through the next 1 hour of trade. We're a little delayed starting this program because you were hearing the Prime Minister Narendra Modi speak ahead of the presentation of the Union Budget. Remember, in case you missed it, in case you haven't been watching this channel over the last week, we are going to be seeing a trading day tomorrow. It's going to be a normal market day, and there's a lot lined up in Budget 2025. For now, let's very quickly take you through what's happening in the markets right now, and you're seeing quite a bit of chop and churn, quite a bit of swings. That's been the case all through the week, and that continues to be the case, but we are at the high point of the day for the benchmark Nifty 50 at about 23,400. The broader markets are looking good as well, and there too you are very close or at the all-time, not all-time high, sorry, the high point of the day. The mid-cap index up about 1%, small cap index up about 0.9%. We're still over 13% or thereabouts of the all-time high for both those benchmarks. Let's talk about individual stocks, and before we get to others, let's talk about Prestige Estates, because this is a real estate company that has reported earnings for the third quarter, and the stock has recovered quite substantially from the low point of the day. In fact, it is trading above yesterday's close. What stood out in the numbers was a drop in the pre-sales, and incidentally, the pre-sales have come in less than expectations. So that's something that the street was focused on at the start. Let's talk about why that came to pass and what the outlook is in the fourth quarter and indeed heading into the new financial year. Mr. Irfan Razak, who is the chairman and managing director of the company, is joining in. Mr. Razak, thanks so much for taking the time. Pleasure speaking with you. Let me ask the question that I think a lot of people are asking, which is, there was an expectation that pre-sales would be higher both in the third quarter and for the whole financial year. But as I understand it, you're waiting for some regulatory approvals. Is that what has caused a bit of a miss? And what is the guidance for the full year now?
Good morning, Alex. Yes, you're absolutely right. You see, we have to follow the regulatory requirements. And though we have a whole lot of inventory that's in the pipeline, which all designed and put in for approvals, the regulatory works according to their timelines, and we have to go through the process. So right now we have got several projects which are under approval or have been approved and waiting for the RERA final nod with the RERA number registration. So hopefully this quarter itself, we should bring in 5 big projects in 5 different cities into the market, and then try and see that we don't falter on the initial guideline that we had given in the beginning of the year. We have 52,000 crores worth of GDV. That's the value that is there for us to sell in terms of the inventory. I don't see any sort of strain in the demand. The demand is there. In fact, there's a huge pent-up demand. The only thing is that we need inventory. And once the inventory comes, and I think the sales will come, not I think, I'm sure the sales will come, because we have that traction, we have that feel, the ground. All my sales staffs tell me that the customers are more than happy to invest and to buy their homes. They are waiting actually for these products to come because they know they are coming. Let me start with certain names, like in Bangalore, I've got Prestige Southern Star. This got approved only yesterday, and now we have to get the RENA number. We've got Prestige Suncrest in Bangalore, and then we've got the Prestige Nautilus in Mumbai, hugely awaited, and still the plans are approved, only waiting for RERA. Then we have the Prestige City Indirapuram in NCR. Now, even that, the plans are approved, but we are just waiting for the regulatory to see that the RERA number is granted, which hopefully should get done very soon. And then we've got the Prestige Spring Heights in Hyderabad, which is again a 3,000 crore value product. And ultimately, I think the fee letter will come in today to pay the fees, and then it's RERA. And then we've got Chennai, where the plans are approved, and then we have to log in for RERA. So all these products come in. Yeah. It'll be about 32,000 crores worth value of inventory that comes in.
32,000 crore. Mr. Razak, I'm sorry to rush you. I'm very sorry to rush you, but we're hearing that the president is going to speak very soon. I might have only one question that I can ask you. So 20,000 to 25,000 crore, as I understand it, was the guidance for pre-sales for the full year. You're saying, given the kind of approvals that will come through and that kind of inventory, you will comfortably meet it?
Yes, I mean, that's the endeavor. They are working hard towards it. The teams are working hard towards it. They all know that they have a responsibility for the guidance that we've given. We believe the demand is very much there. It's just that I can't sell even one unit without the regulatory and without getting the RERA registration. And we are very, very hopeful, and we are very positive that it'll all come through and we'll cross the line.
I hope that is the case as well. The only reason that there is perhaps a little bit of doubt, and nobody is saying that this is not going to come through, Mr. Razak, it's only the outlook for the fourth quarter. And like you're saying, there is a lot of pent-up demand. But for the 9 months, it's at 10,000 crore, which is less than half of the guidance for the full year. That's the only concern.
Yeah, it's a cause for concern for everybody, including us. I wish it had happened a little faster. We tried hard to bring in Indirapuram in December, but it's like when you're stuck in quicksand, the more you speed the wheels, it just gets stuck further. But it's all getting worked out. Hopefully, we see the light at the end of the tunnel.
Right. Mr. Razak, Mahima also joining in this side. Overall, we've seen that in the real estate space, the launches have kind of slowed down. And right now, your realizations are standing at around 43%. I want to understand as to, where these realizations will go going forward. Because do you expect that considering the realizations going up, demand will come down? What's the scenario like? What are the trends like, that you're observing right now?
I think we can't go on percentages on the realization. Yes, the end selling price has creeped up little by little, because that's a function of the cost of raw material, which is land, plus also the cost of construction. And as a company, we also have to make sure that we protect our bottom line. But at the same time, we work very hard to see that the product doesn't become unaffordable. And it's a balance that we have to do. It's a daily balance. It has to be proper. A rate has to be acceptable to the consumer, and the consumer has to see that there is enough on the table for them in case they invest and buy a home. It should not happen that there's no growth in capital. As a company, we've always believed that we give value to the customer, and I think that's the strength that we have, and that's why whenever we brought bring any product to the market, it gets sold off the shelf very soon.
Mr. Razak, you've spoken about the buildings or the projects rather that are awaiting approval, but can you give me a sense of the pipeline heading into the next year? What is on the anvil?
See, we have a total pipeline of 52,000 crores where the lands are tied up, the designs are done and all put in for approvals, out of which about 30,000 is near approved, which can come in this quarter. And going forward, we have another pipeline of another 50,000, which is projects which we have to design and which we have to bring to the market. So it's a continuous process. There is enough pipeline. There's enough inventory. We don't want to overtrade. At the same time, we don't want to be overcautious. We have to balance it properly. We have to see that the capital also utilized correctly. And I believe at the end of the day, it's a balance to see that we don't unnecessarily pay higher numbers to buy land and then holding cost increases.
Yeah. We're seeing live visuals of the president moving towards her address. And on that note, Mr. Razak, let me ask you one last question, which is, we're speaking on the eve of the union budget presentation, and there's hope that there's some bolstering of consumption that will take place. Anything that is on your wish list?
The only wish list, because see, annual budgets is an exercise by the government to see what they can collect in terms of revenue, what they can spend, and what is their priority for spending. In that, I only wish and desire for every budget is that the common man is left with some money in their pocket so that they have savings. And this saving can ultimately and will ultimately land up into consumption, which is again a benefit to the government, because with the VAT system, every rupee that I spend is money to the government. And also if there is saving, the consumerism happens, consumer spending happens, as well as people can have that additional money in their pockets to invest in either stocks or in real estate or any other consumer product.
Okay, fantastic. Mr. Razak, always a pleasure speaking with you. Thanks so much for taking the time and speaking to NDTV Profit.
Alex, thank you so much.
All right, we have to take a very quick break on this program, but on the other side, we will take some of your questions. Of course, the President, as I told you, is scheduled to speak very soon, also ahead of the budget. So do stay tuned for all of that.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs, and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policymakers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets, and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see the new tax regime increasing the rebate to 7 lakhs. But apart from that, there were some continuations of policy measures, but nothing big to report as for. For 2022, it was a very interesting budget because we did see a strong reaction going into the budget just a week before by roughly about 2.5% on the positive side. But in the next week as well as the month after, we saw a sharp reaction on negative 5% of the Nifty reactions. Some of the key measures were like they had involved rupees 2 lakh crores as additional credit to MSME firms. Apart from that, we also saw roughly 48,000 being allocated for building 80 lakh houses. But none of these measures could give the big positive boost, and this was the first such non-pandemic budget, so as to say.
Welcome back. You're watching Budget Special Ask Profit on NDTV Profit. For viewers who are just tuning in, you can ask all your stock related queries, especially with respect to trades on budget day tomorrow or trades that you can take today. You can ask all your stock related queries on the number that will be flashing on your screen. You can either call us or WhatsApp us. With that, let's also welcome in our guest for today. We have Avinash Gorakshakar, who is joining in. He's the Director Research at Profit Mart Securities, and we have Kushal Gandhi, Technical Analyst at Stockbox, joining us. Welcome to both of you, gentlemen. My first question is on NBCC. Manoj from Nagpur is holding around 7,500 shares, bought at 108 a piece. He wants to know as to what should he do with this particular counter. Should he keep holding it or sell at current levels? Kushal, I'll come to you since it's not mentioned the long-term or short-term view on this one. How does it look on charts right now?
Well, it's a positive outlook. The stock is, attempting to make bottom formations, and it's formed a minor double bottom pattern. Again, it's a very classic sign of trend reversal. So I have a positive view for the target price of 107 followed by 190.
Okay, this is a time when a lot of you will look to maybe take a position ahead of the budget if you've got a short-term time horizon, of course. So in case you've got a question specific to the budget, I'd invite you to ask us. You can even call us on the number on the screen. I promised that I would take this question at the start today. Jay Krishnan was written in from Kozhikode in Kerala. Keynes Tech is the name of the counter. 7,170 is the buy price. He's got a medium-term outlook, and he's wondering whether to book his loss. Avinash, on the fundamentals, we saw it take a bit of a beating, but it has recovered somewhat from that point. Would you say hold on?
Yeah, good morning, Alex. See, I think my sense is that, guidance which was given by the company was disappointing. I think they have reduced their guidance, and that was one factor which actually made the market negative on the company. See, my sense is that, the investor has purchased the stock at a peak level. And so in the very immediate near term, to get his buying price again would definitely be a little problematic unless he's got a 2-year view, because the overall EMS space is going to grow quite significantly. Keynes has also said that they would be entering the semiconductor kind of market. And I think in terms of their technical expertise, in terms of their management bandwidth, I think it's a great business. But I think the time frame has to be slightly longer term. I think if we can give a time frame of at least 2 years, and obviously average some quantity at the current level, it's not possible that in the short term he could make money. But yes, in the next 2 years, if he can hold on and believe the story, and EMS as a space is definitely showing a lot of promise, I think he could definitely get a decent risk reward. So the opportunity is there, but I think he needs to give in a long term time frame.
There's one more question, in the EMS space. Dixon Technologies is the counter. The person, do we have his name? Yes, Sumit. We have Sumit. So Sumit is saying that should we expect Dixon to hit the 20K mark again if the budget gives some incentive on PLI scheme? That's his question. And Avinash, I'll stick with you again. Do you think that PLI scheme for these EMS companies will be, better this time? Some better announcements are expected, and if yes, do you expect Dixon to, rise to those levels of 20,000?
Yeah, I think clearly, Dixon is one of those companies which is one of the market favorites in the EMS space. And, whenever some good news or some policy announcements for EMS comes in, and I think, outsourcing EMS, which I think Dixon is very well known for, the kind of brands they are associated with. I won't be surprised that again, the time frame has to be slightly longer term. I think, announcements can come in tomorrow, the stock can go up, but that won't happen in a hurry. I think the stock has now consolidated, and I think markets obviously now want to look at the earnings quality numbers post these kind of policy announcements. So I think if the investor can have a slightly longer term time frame, he can definitely bet on it. But I would say that it's always better to wait for the budget announcements tomorrow, because what comes out finally is going to decide the trend for the overall market and specific stocks. So longer term prospects are definitely positive. In the short term, whether it touches 20,000 or 18,000, it's a little difficult to predict as of now.
Understandable, of course, especially given the kind of swings that we've seen in individual names in the recent past. We've got a caller from Hyderabad. Ekambraya is calling us. If I remember correctly, we've taken your questions numerous times on chat. This is the first time we're speaking, right, Ekambraya? Thanks so much for calling us.
Yeah.
Please go ahead.
I'm holding the Tejas Network about 125 shares at a price of high price, 1277. So I'm really in dilemma whether to exit or book the profit, loss. Or to hold. What you say, please.
Okay. Can you help me with the reason why you bought this? Did you buy it to hold it for the long term, Ekambraya?
Yeah. I'm looking for a 1 year tenure.
1 year tenure. Okay. So let me then, Kushal, come to you on the charts. It's at 901, but it's up and about in trade today, up about 4%. Would you suggest holding on for a period of 1 year?
I would recommend him to sell his positions because the stock has undergone a very long phase of distribution. So it looks like the savvy investors have started to chop out the stock. And I believe 984 is a very crucial resistance zone, and I believe any rise would get rejected. So it's best to avoid this counter because it's trading below 200 DMA with a negative crossover. So yeah, the bearish implications may continue further.
All right, so that's the view coming in on Tejas Networks. The next query is from Ravi Suresh, who's from Hyderabad. He's purchased RVNL 350 shares at 476 a piece, and he wants to know whether he should keep holding them or sell from a longer term perspective. Avinash, I'll come to you. Railways is something that will be in focus tomorrow on the back of budget. The past budget did not focus much on the railways, but we're expecting big announcements this time, in that area. A lot of brokerages have also come out saying that. What are your views with respect to the railway sector and RVNL specifically?
No, I think clearly, I think on an ongoing basis, we have been seeing that most of the railway, players are getting orders. The budget may not have announced something last year, but I think, railways is going to be a focus area for the government. I think very clearly in terms of infrastructure, in terms of, the modernization of railways, a lot of, action has already been initiated by the government. And I think this will continue for the next, say, 2 to 3 years. So I think coming specifically to RVNL, I think it has a very strong order book. My sense is that, unless the investor can patiently wait for the next 12-15 months, order inflows will definitely come in, but I think how quickly the company executes these projects, execution is going to be very important. So I think RVNL is definitely standing tall, and I think should do reasonably well for FY26 also. So keep a time frame of 12 to 15 months, because the stock has corrected from its buy price. But I think if he can patiently wait for some more time, I think he can definitely expect a decent risk reward.
That's the view coming in on RVNL. Moving on to our next caller, Tarun Agrawal from Ranchi is calling in. A very good morning to you, Tarun. I believe you have a question on Vedanta.
Yes, sir. Yeah, I'm holding around 800 shares of Vedanta at an average price of 411. Just wanted to know whether I should buy further, considering the demerger issue that is coming up, and today also the quarterly results are being announced. Can you advise me?
Perfect. Yeah. So you're looking for a fundamental long-term view on this particular counter, right?
Yes.
All right. Avinash, I'll come back to you again. Vedanta is going to post its earning, like Tarun said, and revenues may rise around 7%. EBITDA is expected to rise around 15%. And like he mentioned, commentary on demerger is something that, every investor is looking forward to. What are your views with respect to Vedanta? Should he keep holding them, add more?
I think holding the stock would be more prudent, because considering the fact that the numbers are not going to be anything having any big fireworks. But yes, I think the commentary on the demerger is very important, because I think that is the the forward way of looking how value is going to be distributed across the 5 companies which are going to be demerged out of the main entity. So I think he can hold on. He's got a reasonably large quantity as of now. It's better that he waits for the results and the commentary, because I think markets are really looking at what kind of value comes for every company. The only positive part about this demerger is that debt gets distributed. I think debt was a very big pain point for Vedanta on a consolidated level. So I think going forward, it's going to be only specific companies within this 5, demerger companies which are going to get re-rated. Of course, for the shareholder, these stocks come free of cost. But I think fresh buying, if it all has to be done, I think one can wait, for tomorrow's numbers, and probably, once the demerger happens, one can pick and choose whichever company, has got the best growth prospects.
Okay. We've got a question coming in from Kailash, who's writing in from Trivandrum. Okay, so you probably see this on your screen, and you should in fact be seeing this. We've got live visuals coming through from Parliament, where President Murmu is set to address Parliament ahead of the presentation of the Union Budget. A lot, of course, is being thought of in terms of the prospects, particularly for the middle class. You heard the Prime Minister speak about it earlier today, saying that he's prostrating himself in front of Ma Lakshmi so that the middle class gets more money. And in fact, that is exactly what the ask is from the middle class, talking about the consumption story. In fact, a lot of analysts tracking the budget are expecting an announcement to come through. There is, of course, room to spend this time around, because if you think about it, the CapEx amount that was estimated for the current financial year was set at 11.1 lakh crore rupees, and what was spent eventually, or what will likely have been spent, is only to the extent of about 10 lakh crore rupees. So let's listen in to what the President has to say.
माननीय सदस्य, संसद की इस बैठक को संबोधित करते हुए मुझे हार्दिक प्रसन्नता हो रही है। अभी 2 माह पहले हमने संविधान को अपनाने की 75वीं वर्षगांठ मनाए हैं, और कुछ दिन पहले ही भारतीय गणतंत्र ने 75 वर्षों की यात्रा भी पूरी की है। ये अवसर लोकतंत्र की जननी के रूप में भारत के गौरव को नई ऊंचाई देगा। मैं सभी देशवासियों की तरफ से बाबा साहेब आम्बेडकर समेत सभी संविधान निर्माताओं को नमन करती हूँ। माननीय सदस्यगण, इस समय देश में महाकुंभ का ऐतिहासिक पर्व भी चल रहा है। महाकुंभ भारत की सांस्कृतिक परंपरा का, भारत की सामाजिक चेतना का पर्व है। देश और दुनिया से आए करोड़ों श्रद्धालुओं प्रयागराज में पूर्ण स्नान कर चुके हैं। मैं मौनो अमावस्या के दिन हुई हादसे पर अपना दुख व्यक्त करती हूँ। घायलों के शीघ्र स्वस्थ होने की कामना करती हूँ। कुछ दिन पहले ही हमने देश के पूर्व प्रधानमंत्री डॉक्टर मनमोहन सिंह जी का को खोए हैं। मनमोहन सिंह जी ने 10 वर्ष तक प्रधानमंत्री के रूप में देश की सेवा की। वे लंबे समय तक संसद के सदस्य भी रहे। मैं मनमोहन सिंह जी को भावभीनी श्रद्धांजलि अर्पित करती हूँ। माननीय सदस्यगण, भारत की विकास यात्रा की इस अमृतकाल को आज मेरी सरकार अभूतपूर्व उपलब्धियों के माध्यम से नई ऊर्जा दे रही है। तीसरे कार्यकाल में 3 गुना तेज गति से काम हो रहा है। आज देश बड़े निर्णयों और नीतियों को असाधारण गति से लागू होते देख रहा है और इन निर्णयों में देश की गरीब, मध्यम वर्ग, युवा, महिलाओं, किसानों को सर्वोच्च प्राथमिकता मिली। मेरी सरकार ने तीसरे कार्यकाल में सभी के लिए आवास के उद्देश्य की पूर्ति के लिए ठोस कदम उठाए हैं। प्रधानमंत्री आवास योजना का विस्तार करते हुए 3 करोड़ अतिरिक्त परिवारों को नए घर देने का निर्णय लिया गया है। इसके लिए 5,36,000 करोड़ रुपया खर्च किए जाने की योजना है। मेरी सरकार
All right, the President there speaking ahead of the presentation of the Union Budget. Just to complete the point that I was making, there is room perhaps on spending because the fiscal deficit might actually come in lower than the target that was revised downwards for the current financial year to 4.9%. Let's see where it goes, and that's certainly something to track when the Finance Minister presents her budget for the new financial year. Let's go back to taking some of your questions then, and we've got an interesting one coming in from Kailash, who's writing in from Thiruvananthapuram in Kerala, and 3 stocks is what he's asking. I will make an exception and ask this. Signed DLM and Tanla platform for the long term, and he's defined that as 3 to 5 years. He's asking whether it should be accumulated or which of these would you suggest should be accumulated. Avinash, this one's for you.
No, I think clearly, I think out of the 3, I would suggest that Cyient and Cyient DLM are stocks where long-term prospects appear to be quite positive. Although, in the near term, Cyient DLM, which came out with its Q3 numbers, were quite disappointing. But I think overall, the kind of business opportunity which Cyient DLM caters to is a very large market. And I think they have a very well-established, list of marquee customers. So I think, Cyient on the frontline IT stock has been one of those companies which has been delivering steady kind of numbers. So, these are companies where one gets a decent amount of comfort to invest for the longer term. As far as Tanla platform is concerned, I think it's an OTT value-added kind of telecom player. Hopefully, with the 5G rollout and with better services, even this company should do well. But I think here also numbers are not expected to improve at least for the next 1 or 2 quarters. So I would say that, Cyient and Cyient DLM can be, held on for a slightly longer term period. Tanla, I think one needs to review at least for the next couple of quarters, and then one can take a fresh review.
So it's a hold on Cyient and Cyient DLM, but wait and watch out for Tanla platform is the view coming in from Avinash. We have our next caller from Chennai. Shankar is calling in. Shankar, a very good morning to you. How can we help you?
Very good morning. 2 days before I bought Granules shares, 190 shares at the rate of 504 rupees.
Okay.
I want to know about its fundamental outlook. At the time, I want to more buy. Is it correct?
You want to buy more and you want to see how Granules India is carrying out on charts, right?
Yes, I think at the time I bought 504. If it down, I want also accumulate. But it suddenly went up to about 60 rupees.
Okay, well, what's the time period of holding?
The price is correct to buy.
Okay, and how long do you want to hold Granules India?
Definitely 2 years, 3 years, 4 years.
2 years. Okay. Then Avinash, I'll come to you. Granules India, he's saying that can he add more at current levels or should he keep on holding to what he's already holding?
No, I think if he can have a 2 to 3 year view, definitely he can buy in more. But I think, it's always better to buy the stock when there's a decent correction. I think his entry price has been pretty good. I would suggest that, maybe from the current price, if he can expect us further kind of a lower level, that would give him a better risk reward. I think even if he does decide to buy, I think it's always better to buy in a SIP style so that, his averaging works out in his favor.
I do want to point out that we're trading comfortably above 23,400 for the benchmark Nifty 50, and the Bank Nifty has also recovered from the low point, if I'm not mistaken. Let's pull up the intraday chart. It's trading more or less flat. I'm talking about the Bank Nifty. Let's pull up the Bank Nifty if we can. And it has recovered. There you go. So it is currently trading just about flat. Let's see if some momentum can be built up towards the end of the session. But let's talk about the next question. We've got Raghu, who's asking about South Indian Bank. He's writing in from Bengaluru, and he's bought, I believe, and I think, I'm not sure about the buy price, but he's asking for the long-term view. I will come to you, Kushal, on the charts. What do you make of this, and would you hold on to this, or would you exit if you bought? And I'm pretty sure that he's bought lower than the current market price.
Well, I feel that the stock is, making some good attempts to bottom out. I mean, the stock is already trading down 40% from the peaks, and it's now forming some basing formation and just trying to reclaim the 200 DMA and the 50 DMA, which is a positive development. From a relative strength perspective, it's trying to garner some strength, again, a positive development. So I feel you should hold on to this stock with a very strict stop loss near 23.90 and just wait for the targets of 31 followed by 33 on the upside.
Okay. All right. So that's the view on South Indian Bank. Girish is calling us from Bengaluru about ONGC. Girish, good morning. How can we help you today?
Sir, but ONGC at 300 levels. Can I hold? Can I sell, sir?
Okay. What is the time horizon that you have, and have you been tracking the company?
Sir,
how
more
long?
than 1 year.
Okay, more than 1 year. So okay, all right. So you're looking for a fundamental view or a technical view?
Technical view, sir.
Technical view. Okay, Kushal. Results today on ONGC, certainly something that might move the stock price. But on the technicals, what is the recommendation that you would give?
ONGC is trading at a very precarious levels, and it's trading very thinly. I see there's some buyer's demand happening in the stock, which is a positive development. But in that, when I have to look at the price trend, the EPS trend, as well as the group strength, it's significantly low. So my sense is to just hold on for a short-term trading opportunity. Probably the today's results can act as a catalyst. So my sense is to hold on to the stock for a very short-term opportunity near 281 followed by 289, and have a very strict stop loss near 245.
All right, so that's the view coming in on ONGC. Moving on to the next query that we have. This query is on PN Gadgil, and this is from Ravi, who's from Pune. He wants to hold PN Gadgil from a 1 year perspective, and he is asking whether this is the right time to buy or not. Avinash, I'll come to you. Kalyan Jewelers posted its results today, and they were a good set of numbers. The stock is also up on the back of that. PN Gadgil is another player, although much smaller than Kalyan Jewelers. But do you think it's the right stock to buy against big players like Kalyan Jewelers and Senco Gold?
I think the entire jewelry space has been doing pretty well. If you look at Kalyan or you look at Senco Gold, which operates largely in Eastern India, I think PN Gadgil definitely also has a very niche positioning in the market. And I think, the only part which the investor should realize is that, these stocks have gone up significantly. So I think if one were to invest at these levels, the tail room for growth is definitely there. Gold, as an asset class has been attracting a lot of buyers. And most importantly, if the investor can give in at least 12 to 15 months and then gradually buy the stock, I think earnings numbers are going to be much better for FY26. Hopefully consumption, for the gold jewelry market is growing. The unorganized sector share is gradually reducing, and that is being eaten away by the organized sector players. So net, I think the opportunity is large, and I think, good players like PN Gadgil would benefit. But time frame for investment should be at least 1.5 years. Only then one can get a decent risk reward.
1.5 years the time period to get decent risk rewards on PN Gadgil is the view coming on. Is the view coming in from Avinash. Moving on to the next caller, Dheeraj from Hyderabad is calling in. Dheeraj, a very good morning to you. I believe you have a question on Cochin Shipyard.
Good morning, ma'am. Yes, I'm calling regarding Cochin Shipyard.
Yes, go
so
ahead.
I'm holding 80 shares of Cochin Shipyard at 1510. I accumulated today morning.
Okay.
I saw a positive outbreak in it. So I would like to know to hold or sell.
Right. Since you mentioned outbreak.
Or add.
Okay. Since you mentioned.
Add some more shares.
Since you mentioned outbreak, I believe you want a technical view on this particular counter.
Yes, ma'am.
Right. Kushal, I'll come to you. Cochin Shipyard on the charts.
Well, I have a positive outlook on the stock. I mean, it's a good thing that he started accumulating from today, and the stock is, showcasing some strength from the demand zone near 1400 odd levels. So I believe the stock is in the stage one, which is, after a very, a deep plunge of 57%, the stock is finally undergoing some accumulation phase and it's trying to garner strength. So it's good to hold on to the stock with a stop loss near, 1320. The risk was also quite favoring. So my sense is to hold on to a stock. I'm expecting some further upside once the stock crosses a very stiff resistance near 1766. So it's a positive view, and you should hold on to the stock.
Okay. Varun Beverages is the name of the counter we're talking about next. Vijay Babu is asking this question, writing in from Hyderabad, bought at levels of 440 and looking for a short-term view. So he's making money in this trade. The question is, should he book it? The question is for you, Kushal.
It is thin. BBL is trading very thinly to the very near support zone near 528. Again, it holds a very crucial demand zone. We've seen some multiple pullbacks, but just in terms of relative strength, the stock has deteriorated quite significantly. So my sense is to avoid, or rather, have a very strong, just hold it with a very strict stop loss near 519. A breach below 519 levels, I'm expecting selling pressure to further intensify. So apart from BBL, I think something like a Marico is a counter where, you should keep on radars and probably switch your money there.
Okay. Ricky is calling us from Mumbai. Ricky, good morning and thanks so much for calling us again. How can we help you?
Yeah, good morning. Actually, I just want to know about a company named Praj Industries.
Yes.
It is trading near 52 weeks low. So I would like to give a certain amount to this counter in the portfolio. So I just want to know the long-term prospectus of this company.
Okay.
Is it good to hold for long-term for 5 years at least?
Okay. Have you studied the company, Ricky?
I did my own research on the fundamentals and technicals, and it looks good to me.
Okay.
From the last 5 years.
Sure. So I just want to, before I ask Avinash, and I will take the question, I just want to know what, according to you, what stood out to you when you did the research on the company?
It is giving constant good profits. The profits are increasing and everything is good in the company.
Okay.
CAGR is also good. Return of equity is also good, and the valuation seems decent to me.
Okay.
Yeah.
The valuation also seems decent to you. Let me pull it up while I'm speaking to you. But I'm going to take the question to Avinash. Avinash, Praj Industries, what's your opinion? Would you buy for 5 years?
Yeah, I think, if you look at the business, Alex, they are a large dominant player in the agri market as well as they are into the custom synthesis market. And both these markets offer a very strong kind of runway for growth. In between, of course, there have been some quarters where the company, missed its estimates. But I think looking at the kind of quality of management and the kind of growth opportunity, both on the custom synthesis as well as on the agro chemicals side, my sense is that this company has got the potential to actually do reasonably well over the next, say, 2 to 3 years. But I think the investor should realize that the agrochemical business is obviously dependent on the monsoon factor. So, in case the monsoon does not play out to that expectation, then there could be a little bit of underperformance. But otherwise, the company has done remarkably well in the last 3 to 4 years. And he's right in mentioning that, all the operating metrics like ROC, return on equity, earnings growth, everything has shaped up pretty well. So I think, he can take a reasonable, kind of position here, provided he's got at least a 2-year plus kind of time frame, for his investment.
Okay, so that's the view coming in on Praj Industries. Moving on to the next query that we have, Gul is asking on BEL, and he's saying from a budget point of view, as a buy today, sell tomorrow trade, is that the right counter to trade? Kushal, I'll come to you. Is that the right counter to trade?
Well, no, because, if you see over the last 3 trading sessions, the stock has been, showing some very tremendous pullbacks, some strong pullbacks. So I believe there could be some profit booking because 50 DMA is acting as constant resistance and the upside remains capped around those areas. So I believe 291 is a stiff resistance. So my sense is to not play a BTST in BEL.
Okay, all right. Mohan is joining us on the phone line. Mohan, thanks so much for calling. How can we help you today?
Yeah, good morning.
Good morning. Please go ahead.
I have Godavari for shares, 1,000 shares.
Okay.
Bought at 162.
Okay. What is the time?
Is it right to hold for, is it good to hold for 2 or 3 years?
Okay, 2 or 3 years. So when did you buy this, Mohan?
Yeah, 4 months back.
4 months back. And why did you like the company? What is it that drew you to the company?
Yeah, one of the friends suggested.
Okay, all right. But did you read up about the company before you bought the shares?
No. My friend suggested so that I bought.
You trust your friend a lot. I can see that. All right. Let me ask the question to Avinash then. Avinash, his friend has suggested Godavari Power to him. Has his friend given him good advice?
No, I think it's a good company, Alex. As I understand, it is one of the leading players within the steel segment, have a large captive power kind of facility. So I think numbers have been pretty good, and this has been one of the favorite mid-cap stocks. So my sense is that yes, I think he's already in the money. If he can give in at least next couple of years, because these kind of companies typically take a lot of time in terms of support from the institutions and from the larger set of investors. So I think if he has the time, frame of at least say 18, 24 months, he can definitely look at getting a decent alpha in this company. But I think in the near term, I think he'll have to face the volatility like all other small and mid cap stocks.
Got it. That's the view coming in on Godavari Power. Moving on to the next caller, Shailja from Hyderabad is calling in. A very good morning to you. How can we help you?
Yeah, hi, good morning. I have 100 shares of Ola Electric at 98 rupees.
Okay.
Since then, it's going down. I was seeing around 3,000 negative since I purchased.
Right.
So today it has increased around 12%, with a loss of 2,000.
Right.
So shall I exit at this point, or else can I wait to recover my loss?
Right.
Or else I want a fundamental view. Will it increase? Will the share will increase to 98, or else shall I exit at this point and invest in some other shares?
Understood.
Some other stock.
Got your question, Shailja. Avinash, I'll come to you. Should she exit at the current levels, considering the stock is up 12%, or should she wait to recover losses? And if she wants to exit right now, what counter she would invest in is her query.
No, I think electric vehicles as a product segment is gaining very fast momentum in the country, and I think tomorrow's budget could possibly announce some relief for the electric vehicle mobility sector. So I think the investor is probably a little confused, whether one should look at the short term or the longer term. But I think if the investor has a couple of years in mind, then I think she should hold on. But if she's got a short-term view, then I think it's better to exit. I think it's better to put money in some well-established sectors like, public sector banks, or typically, even in some auto kind of stocks or auto ancillaries. So I think if she wants to have a short-term view, she can take out the capital and put in companies like Ask Automotive, or for that reason, something like a Bharat Forge. These are well-established players where capital protection is guaranteed. The business is well proven. So I think, there she could expect steady to decent returns over the next 12 to 15 months. But if she's got a 2-year view, then I think she should continue to hold it.
We did have the management of Ask Automotive speak to us just yesterday, I believe, wasn't it? Yes. And they spoke about an improvement in the business on account of the mix that is improved also over the past couple of quarters in the aluminium product space. We've got the next question coming in from Dinesh, who's writing in from Gurgaon, and he's apologizing that he keeps asking questions. This is meant for you to ask questions, so I'd encourage you to keep doing so. IRFC is the name of the counter he wants to know about. 197 is his buy price, and he's wondering whether to add more at the current market price. He is incurring a loss currently. Kushal, what should his strategy be?
It's wisdom to hold on to this position with a stop loss near 127. Yes, the stock is attempting to bottom out, and it's under the accumulation phase. So my sense is to hold on, and probably you can add more above 163. That's where the 200 DM is situated. Probably a move above that or a decisive closing above that can attract further bullish strength. So my sense is to hold on to the stock.
Hold on to the stock is a view on IRFC. Let's get our next caller on board. We've got Kumar calling us from Chennai. Kumar, morning. How can we help you today?
Yes, I am holding a Maharashtra Seamless at the 620 200 shares.
Okay.
Can I accumulate more at this stage?
So, am I right in assuming that you recently bought the stock?
Yeah.
When did you buy?
Around 2.5 months back.
2.5 months back?
Yeah.
Okay. And what is the time frame that you have in mind, Kumar?
I am looking at holding for a long period of time. So I saw it went up, but again it has come back. So is it possible that it will again go back again?
Okay, and so you bought this from the pipe space. Did you like it because of the business that it has been doing? Did you study the company?
Yeah. Maharashtra Seamless. I saw the fundamentals are good, so that's what I.
Okay, all right. Avinash, what he's looking for is a view on his decision to buy Maharashtra Seamless? It's more or less at where the price is right now. 620 is buy price. Should he hold for the long term?
Yeah, I think, see, first of all, Maharashtra Seamless is one of the oldest players which caters to the oil and gas sector. And I think, in terms of order book, in terms of their positioning, they are a well-established vendor to ONGC. My sense is that, as and how oil and gas investments in the country grow, you're going to see a lot of demand for, pipes which are required for the oil and gas sector. And I think Maharashtra Seamless is well positioned. See, now if he has purchased it about a couple of months back, my sense is that he needs to give in some time for this investment to play out. It's a stock which is well researched and well, tracked by a lot of analysts. So typically, I think, he can expect a decent return only and unless he keeps the stock with him for at least the next 12 to 18 months. Hopefully, something comes in the budget tomorrow that could lead to a short-term spike. But longer-term prospects are good. I think the promoter, the business, everything looks good. But yes, he'll have to give some time to get some decent risk reward here.
All right, so that's the view coming in on Maharashtra Seamless. So the next caller is from Prakash, who's from Bengaluru. He's bought 9,000 shares at 969 a piece of Motilal Oswal. Let's pull up the chart of Motilal Oswal and see where the stock is trading at. And there you go, it's trading at 641. So he's sitting on a significant loss of almost 30 lakh rupees. And he is saying that he still wants to hold it for the next 5 years. Should he add more or not is his question. Avinash, he's already sitting on a loss of 30 lakhs, but he's saying he wants to hold it for the next 5 years. What's the view on Motilal Oswal? What do you think? Should he keep holding it?
No, see, I think the broking business has come under significant pressure. And I think one reason for the underperformance was that Q3 numbers have not been up to market expectations. That is probably one of the key reasons why the stock has underperformed, because Motilal Oswal is one of the large retail and institutional brokers. They have various other businesses like the asset management company, typically a lot of fee-based activities which they do. But I think recent developments on Kalyan Jewelers also has actually left a lot of discomfort with investors, because they had a large holding in Kalyan Jewelers, and that obviously had an impact on their portfolios. But longer term, I would believe that this company has a very dynamic and a very strong management bandwidth. They have been in the market for various cycles. So I think unless the investor has got a 2 to 3 year kind of time frame, he should stick to his investment. And he's right in saying that longer term prospects will continue to flourish. Indian capital markets are bound to do well. And to that extent, I think unless the time frame is long term, in the short term, the stock will continue to remain volatile. But longer term, I think he could even think of averaging and probably then, looking to, stay invested for the next 2 to 3 years.
Okay. All right. Avinash, thanks so much for that comprehensive view. And indeed, thank you so much to the both of you for joining in, Kushal, Avinash, and for answering all the questions you did. Pleasure having you on the program. All right, that brings us to the end of this special edition of Ask Profit, which is a budget special, but I know that a lot of you asked your regular questions. That's perfectly fine. We've got lots lined up ahead of the presentation of the Union Budget, so do stay tuned. This is NDTV Profit.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets. General elections.
Union budget.
2 more. Yashwant Sinha and P. Chidambaram.
Arun Jaitley. Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra. Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every day. Today, we are talking about Indigene Limited. Now, while this is a company from the healthcare space, it's a unique one. What this company does is it, in fact, aids other pharmaceutical companies in carrying out, trials and tests and eventually helps them market these products. But let me tell you a little bit more about Indigene and why we're talking about it. Of course, we've had the earnings from the company, but in general, it's a digital-first healthcare and technology company. That's what we're looking at. Besides that, it assists life sciences companies with drug development and clinical trials, as well as regulatory submissions, and eventually taking some of these drugs into the market for their respective clients. In terms of the revenue breakup for FY24, to give you a better idea of where it gets a majority of its revenues from, well, the company essentially gets enterprises commercial solutions is what contributes to nearly 59%, followed by enterprise medical solutions. That contributes another 23%, as you can see. The balance will come from omni-channels and others, but the long stay as far as these two segments are concerned. Even in terms of your clientele will split, it gets mostly majority of its revenues from biopharma, followed by medical devices, emerging biotech, as well as others. Now, as usual, what we tend to usually do is, we talk about the various parameters that we judge the company on. So we talk about the income statement, the balance sheet. We talk about the return ratios based on those two financial statements. And of course, we also talk about the cash flow. And we move beyond the financial statements when we take a look at the shareholding. We take a look at street credentials, street coverage, as well as the outlook for the company as well. And we rate the company. We give you a total rating of the company. To help me do this and take us through some of these aspects, I have with me my colleague Varsha, who is also going to take us through some of them. So let me bring in Varsha and let's talk about, the top line, the profitability in terms of margins and the bottom line. Varsha, welcome to the show and thanks for joining in. What can you tell us about this particular aspect?
Thank you, Agam. So, if I were to see the last 3 AGR growth for Indigene and FY24 numbers, in FY24 the revenue was 2,590 crore, while EBITDA margin was 20%, net profit was 337, and if you see the 3-year CAGR growth, its revenue has grown 39%, EBITDA 30%, and net profit 32%. Well, this seems good when it comes to last 3 years, but the problem here lies if you see Q1 FY25, Q2 FY25 and the recent numbers Q3 FY25, the numbers are not that good. If you see, the revenue growth has been like 7 to 8%. So overall this looks good from FY24 basis, but when it comes to the recent numbers, the numbers are not that good, and the margins have also gone down. So the margins have gone down to 17 to 18%, wherein in March 24 the margin were 22%. So yes, overall we would give a thumbs up, but we need to keep a watch on what lies ahead in Q4 as well as in FY26.
Right, so that's as far as the balance sheet is concerned, and pardon me, that's as far as the income statement is concerned. So I'm going to talk about the balance sheet as well. As of now, it does look like it does have a strong balance sheet. It has no debt, negligible debt, which is as good as zero debt, but as against shareholders' equity worth around 2,400 crores, nearly 2,400 crores, and this is as on September 2024. Again, it has a significantly higher cash in bank worth around 550 crores, and this is higher in comparison to its gross debt, that is its lease liability essentially. So on a net basis, it's debt free, and it does have a significant amount of reserves. We must also remember that the company is coming out of a very strong growth phase. Obviously a lot of that has come and contributed towards the balance sheet as well of late, which is why we're looking at such a strong balance sheet. So it's going to be a thumbs up as far as the balance sheet is concerned as well. Varsha, what about the return ratios? These also look pretty good.
Actually, yes. They are good when it comes to FY24 numbers. So you have return on equity of 28%, 27% in 24 and 28% in 23, and ROC numbers are actually very good when it comes to 23 at 33% and 24 at 29%. But this because considering the net profit decrease, or considering the subdued numbers that the company has seen in the last few quarters, we need to see what FY25 return ratios look like. But overall, considering this 2 years, yes, good, very good return of ratios. Now also we need to consider that company doesn't have to do much capex, because they are not into kind of manufacturing drugs or manufacturing any kind of products. They give services to the pharma companies which bring products, which they help pharma companies' products to bring into the market. So not lot of capex is actually required, and this is also reason we are seeing the good return ratios for the company.
No, fair enough. I think it comes down to what these return ratios will eventually look like. But as far as the past is concerned, well, it does look good. I'm going to also talk about the cash flows, and again, when it comes to cash flows from operations, it's a pretty steady state. At the moment. What we're looking at is about 508 odd crores coming in from cash flows from operations, and on a net cash flow basis also it's a positive number. So overall, that's how things are, as far as cash flows are concerned. Just want to point one thing out, that while we have seen steady growth, the management at this point in time is indicating a slightly closer to double-digit growth. And while we may or may not see double-digit growth for the upcoming few years, the management is suggesting that they will beat the sector. That's as far as financial statements are concerned. Let's look beyond and talk about the shareholding too. The reason I want to address shareholding is because it's a bit peculiar. So firstly, it does not have promoters. It does have institutional holding, but institutional holding is relatively low. Sure, you might argue that you've actually seen an increase in FII holding and an increase in DII holding over the course of the last 9 months, the last 6 months. But overall institutional holding for a company that does not have a promoter is, fairly low, as I mentioned. It does, however, have two marquee investors. The first one, of course, is a Singapore-based venture capital company. That's Nat Arthur Far East, which owns about 22% in the company. and the other relatively large investor is CA Dawn Investments. This is a Carlyle unit. So that they own about 10% in the company. While we do have significant ownership by these two marquee investors, the question really is that what about the balance? This just adds up to about, 32%. So the balance is out there, and as I mentioned, the institutional holding in the company is not significant just yet. So if you move that on the side, we do consider the shareholding as a little bit of a weak spot as far as the company is concerned. But Varsha, what can you tell us about how the company's price has done since its IPO?
Well, yes, Agam. So if you see since listing, so this company got listed in around May 24. Since listing, they've gained 30% on IPO issue price. Now this looks good, but from listing day close, the stock is up only 5%. Now Indigene being a small cap company, the investors, the expectations of investor from this company would be at least a double-digit growth in stock price that they must be interesting. And now, but the stock price is up only 5%. Now, company needs to prove when it comes to their financial numbers, so that the valuation premium the market can give to this company.
Yeah.
And also, if you see, if I were to talk about the street view, so they have 3 buys, 2 holds and 1 sell, but the upside potential for this company lies at 14%. And actually, recently, a lot of analysts are interested into this company, maybe considering the future prospects that the company has. But overall, from a street cred or from a returns point of view, we would give a neutral stand to that.
Okay, so Varsha, I'm going to come back to you on the outlook for the company, but I do want to make a point with respect to the upcoming growth. And I've made a point on this, but I'm going to emphasize a little bit more on this one. So firstly, when it comes to growth going forward, and outlook again will be something of importance, because the management is saying that while they have grown 35% over the past few years, we are not going to see the growth anywhere close to those numbers here on. It will be, maybe somewhere close to the double-digit growth, but it may not be. They are saying that they will grow faster than their peers and faster than the sector. But in general, it will not be. Of course, the management, or rather the company, is also growing at, or has grown over a smaller base so far, and now the base has become slightly larger, and here on it does seem like growth may not be as exponential as what we've seen so far. So that's one of those areas that may be of a little bit of a concern. But what about the other factors in terms of the outlook here, Varsha?
Yes, Agam. So one thing is that company is actively scouting for M&A acquisitions. So basically here the simple point is the company is going to expand through inorganic acquisition, number one. Number two is now they want to increase their client base, and especially increasing the $1 million client. Now this is very important. One is what additions of clients you have taken and what is the size of that client. This is the second important thing which they are actually concentrating on, and they want to have EBITDA margin to stabilize at 20% in near term. Now, in Q2 and Q3, the margins were 17 to 18%. They want to take overall margins to 20 to 22%, with medium term exceeding 24%. Now, we need to see what strategies have laid down management to have this 22 to 24% of EBITDA margin that they are expecting. So overall, a good kind of outlook, but management needs to prove themselves that what they are saying, they need to, walk the talk management we need to have.
All right, fair enough. So that's as far as the outlook is concerned. We're going to give it a neutral outlook at the moment because of some uncertainties and also a slowdown in growth. Where does that bring us when it comes to your overall rating after considering all the parameters that we've spoken about right now? So certainly so far in terms of the financial statements, the company looks at a very strong footing. So we've given thumbs up on all the major statements. But let's move on and talk about the other factors. So it's a thumbs down for shareholding, neutral otherwise on street credentials. That is the kind of returns that the company has seen, street coverage as to what the street is making of it, and the outlook, of course, also remains neutral. And given the fact that we give a thumbs up, 1 point, about half a point for a neutral, and no points for, a thumbs down, the total score at the moment comes to about 5.5 out of 8. The outlook at this point in time is something that's going to be at the forefront of every shareholder's mind at the moment. But speaking of that, let's get in the management. Well, I spoke to the CFO of the company, Suhas Prabhu. This is what he had to say. Listen in.
Yeah, as you rightly observed, a good quarter from a sequential growth perspective, strong 4.9% revenue growth with strong margin growth. We crossed the 700 mark in revenue for the first time, and also 150 crores in EBITDA and 100 crores plus in PAT at a healthy 15.2%. We strive to maintain this level of performance with also stable to growing margins going forward. And given our pipeline and new wins, we feel confident that we are on the right path going forward as well.
Okay, but can you give us some sort of a view? Because, over the past few years, you guys have shown revenue growth of around 30-35%. And at the moment, we're looking at, somewhere near double digits. But the question really is that what can we expect in the top line for FY26?
Sure. Well, I'll refrain from giving a forward guidance specifically, but if you look at a slightly longer and medium-term perspective, dialing back, while as you rightly pointed out, a couple of years of 30% plus growth was there. What we believe is that over a longer period, we should deliver growth which is higher than what the industry is growing at, which is at 5 to 6%, and outsourcing in this industry growing at a 9 to 12%, and we will strive to actually beat that and go beyond, and that's our ambition. Now, there'll be periods where it'll be slightly slower, and there'll be periods where it is very high, like the 25-30%, but over a medium term, we'll strive to beat what the industry and the outsourcing trends are.
Okay, so not at the same clip as what we are used to, but still beating the industry. That's what we gather. Suhas, also a word on margins at the moment. What are the challenges? Because, the indications and the expectations are about 20 to 22%. But we've actually seen margins come off just a tad bit sequentially. So where do we head from here? What are the current challenges, and what is the company doing to overcome some of these?
Actually, margins at a EBITDA level have come in strong sequentially. We've grown EBITDA margins by 240 basis points to 20.8% sequentially, which is in the range, north of 20% that we have delivered in the past. Even on a YTD basis, we are in the vicinity. We are just short of 20% at 19.7, 19.8%. And given that the inflation and more importantly the wage bill hike is behind us, we believe that the performance will be stronger going forward on the margins also, such that on a full year basis we should be in the range that are the expectations based on our past performance.
Okay, so Suhas, let's talk about business and particularly enterprise commercial solutions, which forms a very large chunk of your revenues. What's in store as we move into FY26? What are the areas that this particular segment will focus in?
Yes. So enterprise commercial solutions, the largest part of our business, is where we transform our customers' commercial operations and help them effectively engage with the market. And this is an area where we see significant changes, one coming from the regulatory side, pricing pressures and a changing product profile with the new innovator products hitting the market, needing the industry to transform the way they engage with the market, while new technology and personalization requirements also bringing up new requirements. And confluence of all of this, we believe we are very well poised. Having said that, we are also having a strong pipeline. We've seen progress many of our customers where we continue to do more and more and add more value in this process, and we have remained very bullish on this segment.
Okay, and can you also give us an idea about the same when it comes to your enterprise medical solutions?
Enterprise medical solutions has seen a strong growth. One with increasing regulatory complexity, right? There's a natural requirement to enhance, what our customers are doing, which impacts us positively in this segment. And the other thing that we have capitalized in the recent future on is we saw increased outsourcing trend in some of our customers, especially outside the top 20 globally ranked pharma, doing more outsourcing in this segment, coming out of newer requirements, higher requirements coming from the regulator. And that has resulted in this growth. And we see that continuing in the future as well.
Okay, so Suhas, if we look at your business maybe 2 or 3 years down the line, I'm assuming that a very large chunk of your revenues will still come from commercial solutions and medical solutions. The question is that, is the mix likely to change, or will that depend from year to year based on what the demand from your own clients will be?
Yes, you rightly mentioned that again, we're not seeing a major shift in the proportions. There might be interim changes where there'll be a small variation, 2 to 3% between the segments. But in the longer term, we don't see the proportions changing drastically between these segments, even as we scale from the current levels of revenue.
Okay, so can you tell me about the kind of clients that you've seen in terms of addition for the quarter gone by, and what is the size of these clients?
Sure. One of the things that we are proud of is the fact that we work with pretty much all the top 20 global pharma for a very long time. And therefore, naturally, that means that my client addition, my logo addition is going beyond the top 20 pharma. Now, when I say going beyond the top 20 pharma, these are still very large enterprises ranging anywhere between $2 billion in revenue to maybe $5-10 billion in revenue, my customer revenue sizes. And they also have all the requirements, of course, at a slightly different scale than the top 20 pharma, but the requirements remain constant. We see that there is significant revenue potential with these customers also. So while we strive to get our top 20 globally ranked pharma to a $50 million, $75 million, $100 million customer for us, the next tier customers could very well be a $25, $35, $50 million customer for us. And that's the potential we are excited to tap into.
Okay, so Suhas Prabhu telling us about what's in store. So firstly, we've spoken about growth, where they said that while the sector can likely see growth of around 6-7%, Indigene is most likely expected to beat that particular growth. But it's going to be closer to double digit and not anywhere close to what we have seen in the past few years. In terms of margins, they are, well, looking forward, eventually they will hit the 20% margins. Right now, we've seen those margins come in at around 18-19%. And, moving in as far as their strategy with respect to the current clientele is concerned, firstly, they are going to look to grow with the growth in their respective clients. They're going to look to consolidate. The concentration risk at the moment is not considerable. Sure, they do get about 83% of their, or rather well over 80%, or rather well over the 4/5 of their revenues from their top 20 clients. That's a good one, but they're looking to consolidate there. And of course, in the meantime, as and when they get to see for newer additions in clients, that will also be a part of the process. That's what we have in terms of KYC in today's edition. And that is all that we have, but lots more lined up on the other side. Stay tuned to NDTV Profit and we'll keep bringing you more.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks that impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's of course the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be lesser compared to the previous budget. Now, this time it is assumed that if the fiscal deficit is contained at 4.5% of the GDP in 2026, it could of course be a shortfall met by borrowings. Apart from this, UBS feels if the capital expenditure for 2026 is budgeted at a similar levels of rupees 11 lakh crores, similar to the FY25 budgeted capital expenditure, it could be negative for companies like L&T as well as the other core infrastructure companies. UBS also says the importance of domestic orders for the infrastructure companies is now higher given the limited overseas opportunities, especially in the Middle East. In this regard, UBS thinks companies exposed to private emerging infrastructure and power value chains are relatively better placed given the private sector capex growth remains in the double digit. Now, UBS also does not expect any changes in the tax policy, especially for the capital markets in their base case estimates. UBS also expects the administration to maintain a lower target for divestments of around 30,000 crores for FY26. UBS's revenue collection estimates are marginally improved in line with the nominal GDP expects, and the gross tax revenues will be in a growth phase of about 11.5 to 12% in FY26 versus about 10.7% on a year-on-year comparable basis between April and November of 2024. In terms of divestments, as mentioned, the target is around 30,000 crores for FY26, which is lower than the 50,000 crores estimated for FY25. From year to date until FY25, the government has only
Hello and welcome to Markets at 12. This is Anushi Vakharia. Let's take a look at how the markets are doing currently. Now, in terms of where the Nifty 50, the benchmark indices are concerned, we are looking at strong gains, about 0.77% of an uptick in trade today. Even the broader markets, the breadth of the overall market seems in the positive. We're looking at gains of around 1.21% in the mid cap and the small cap 250 space as well. But coming to the benchmark indices, a lot of earnings in focus, which is leading to the strong uptick that we're looking at. Let's pull out the point contribution to see which is leading to these gains in the markets. So if we are seeing, we have the stocks like L&T leading the chart here. This is after the management has affirmed its order guidance for the year, and with this is the expectation that it may increase the 10% of the order inflow growth guidance that it has stated. Another couple of names that we have include Infosys and Reliance, which are contributing positively, while on the other side, ICICI Bank, Bharti Airtel and Bajaj Finance and Finserv Twin Pack are in pressure in trade today. So this is as far as where the Nifty 50 is concerned. Coming to the mid-cap space, a lot of stock specific action here as well. We have the likes of, if you are seeing Fortis Health, Kalyan Jewelers is the one stock which is faring well in trade today. This is after the Q3 results came out, a positive set of numbers and a sigh of relief after Kalyan Jewelers was down and hammered in the markets in the previous few sessions on the concerns of the promoter pledge which were taking place. Mascow, Dock, Suzlon, some of the other smart movers in trade today. We are looking at gains of around 5 to 5.2% here as well. Suzlon locked in another upper circuit 5%. It had reported a very strong set of numbers in their Q3 earnings. Supreme Industries and Sundaram Finance making to the list as well. While what is dragging the index, we have some names like Fortis Health in focus. KPIT Tech is another stock which is seeing a downtick of around 2%. Sun TV down about 2%. So these are a couple of stocks which are seeing a downtick as far as where the mid-cap space is concerned. But let's pull up the small cap 250 as well. In the small cap 250 index, we have gains in counters like, if you can pull up the counters, we are looking at around 1.23% of a gain in terms of where the around 2% of gains where the Nifty is concerned. Jupiter Wagons is one name which appears right at the top, 9% of an uptick, and this is because of the Q3 earnings yesterday. In fact, we also spoke to the management yesterday and very optimistic outlook that was given. Naveen Fluorine, Garden Reach, some of the other counters that are in focus along with that. But as we But let's also see how the markets are doing. As we approach the end of January, an interesting data point has emerged. This month hasn't been too good for the markets, as Nifty is seeing a decline of over 2% and is all set to end in the red for the month. This will be a fourth consecutive month of fall, which has happened in last in 2001. But what has followed? Let's bring in Somit to get more details on that insight.
Well, this could be the fourth consecutive month of fall for the benchmark index as the Nifty 50, and so far in the month of Jan we are down around 2% and today is the last day of the month. Now this will be the in the last 4 months we have declined around 10% and this will be the biggest consecutive losses, month-wise losses for the Nifty 50 index in the last 23 years. Last we had seen this kind of a fall back in September 2001. In fact, if you look at since 1991, we have seen a decline of more than 4 or more months, nearly 5 times, and this could be the 6th such instance. Now in the past 5 instances, 5 times we have seen a decline to continue over the next couple of months as well. 1 time we have seen not much of a gain after 4 months of decline, and 2 times we have seen a strong bounce back from the Nifty 50 index post 4 months of decline over the next 2 to 3 months. However, 3 months of consecutive decline is something that we have seen quite often since 2001. To be precise, around 11 times we have seen 3 consecutive months of decline for the benchmark index. Now out of this 11 times, 3 times we have not seen much of a growth over the next couple of months or the next 3 months. As you can see here, in September 2011, over the next 2 months we just saw another decline of around 2% Over the next 3 months we declined around 6%. So not much of a gain that we had seen, but nearly 8 times we have seen a strong bounce back coming in the benchmark index over the next 2 months and the next 3 months. For one of those example is here in September 2001, when we had declined nearly for 4 consecutive months. Over the next 2 months we saw a gain of nearly 17%, and over the next 3 months we saw a gain of nearly 16% coming in for the benchmark index. Now what are mainly the reasons behind this decline in the benchmark index? The first one and the biggest culprit here is the FIs. They have sold nearly 2.7 lakh crore rupees over the last 4 months, which is one of the biggest that we have seen. However, DIs have tried to hold on and contributed much to the benchmark by buying of around 2.74 lakh, but it's the FIs selling which has led to this bigger fall. Apart from that is the second consecutive quarter of earnings decline that we have seen, that also led to analysts cutting their EPS estimates for the benchmark. And apart from that is the geopolitical concerns, lower capital expenditure, this being an election year, and delayed rate cut, which has also impacted the consumption in India, which also led to this downfall in the markets. One of the reasons was also the expensive valuation. However, after this fall, the valuations, at least for the benchmark index, look quite cheap compared to its 5-year average. As you can see here, the 12-month forward P for Nifty stands at around 18.7 times, while the 5-year average is close to 19.3 times. But when it comes to the broader indices, the valuation is still expensive compared to 5-year average. For Nifty Mid Cap, the 12-month forward P is around 30 times, while the 5-year average stands at around 26 times. While when it comes to the Nifty Small Cap Index, the valuations, 12-month forward valuation is 21 times, while the 5-year average valuation stands at close to 18 times.
Well, thanks for that, Somit. That was very insightful on how the markets have been in the month of January and what has the trend been like. But quickly, let's pull up Nestle as well. The company just came out with its Q3 earnings, and we're looking at a 4.9% of an increase in terms of where the net profit is concerned. The net profit standing at about 688 crore as compared to 656 crore. Nestle again in focus. The stock seeing a strong uptake, about 4% up on the back of the Q3 earnings as we speak. But another stock which is in focus is Adani Enterprises, which came out with their third quarter earnings yesterday. My colleague Somit continues to give us more perspective on these respective set of numbers. Over to you, Somit.
Well, yes, Adani Enterprises did report its number yesterday. Now, if you look at the top line and the operating profits, that is the EBITDA, they were pretty much stable on a YOY basis, but we did see a big decline when it comes to net profit. But one needs to understand or delve deeper to understand why this fall in net profit has come in when it comes to Adani Enterprises. So after doing that, we understood that nearly 70% of this decline that we are seeing in the net profit is owing to a non-cash cost item. Now, despite stable operating performance, Adani Enterprises net profit showed a big decline, which was because because of a non-cash item of close to 1,542 crore rupees. Now, during the third quarter of FY25, we have seen the Indian currency depreciate much more than what we had seen in the previous quarter against the US dollar, and this led to some mark-to-market foreign exchange losses of close to 1,542 crore rupees. Now, these losses were because Adani Enterprises, which is the main company or the parent company, had given some loan to its Australian subsidiary, and because of rupee depreciation, there had to be a mark-to-market loss which need to be accounted on the financials, and hence we had seen this big drop in the net profit number. Now, if you add back this foreign exchange loss, which is a non-cash cost item for Adani Enterprises, the profit number would have stood at close to 2,118 crore rupees as against 2,360 crore rupees, which the company reported last year. So again, a pretty much stable set of numbers on a YY basis if you add back the non-cash cost item for Adani Enterprises. Also during the quarter, if you look at the new businesses of Adani Enterprises, which is the ANIL and airport business, they added nearly 473 crore rupees to the bottom line of Adani Enterprises. ANIL ecosystem and the airport business EBITDA jumped nearly 34% and 59% on a YY basis. And on the balance sheet side, if you look at the company's overall debt was pretty much stable. The debt coverage ratio and interest coverage ratio both on Q-on-Q basis continued to remain stable. The debt did increase, but that was largely because of the new businesses that the company took over when it comes to the airport, roads, copper and the PVC business. But its leverage ratio, that is the debt coverage and interest coverage ratio, that remained pretty much stable on Q-on-Q basis.
Okay, thanks for that, Soumit. That's the correct way to analyze on what's happening with Adani Enterprises. And in fact, all the Adani Group stocks are up in trade today. But another stock which is sinking in trade is JSPL, that's Jindal Steel and Power, after the company reported its Q3 earnings. Mika joins us with more details on what's hurting the stock in trade.
So the stock is down 10% on an intraday basis. It's the steepest fall it's seen since June 4th of 2024. Now, EBITDA did miss estimates by 3%. And this is the first time JSPL has missed its estimates in the last 4 quarters. In terms of your EBITDA estimates, they have been cut by brokerages. Nuvama has cut FY26, FY27 estimates by 13% each. ICICI FY26 EBITDA estimates for JSPL cut by 12%, FY27 by 23%, and MOSRL has also cut FY26 estimates by 17%. In terms of what went wrong for JSPL, well, sales volumes did come in lower than expected at 1.9 million tons. EBITDA per ton was down 27% on a year-on-year basis and also did not see any sequential improvement and stood at 11,494 rupees per ton in Q3 because the benefits of the lower coking coal prices and higher steel prices were offset by higher iron ore purchases from the market because the input from the company's captive iron ore mines were lower. And lastly, the main pointer is that the company has announced 16,000 crores of fresh capex. This comes over and above the 31,000 crore announcement that has previously been made by the company, and only 76% of the previous capex has been sent. And as per ICICI Securities, the fresh capex in the current environment with lower spreads could be a key deterrent to the stock performance of the company and can be a key overhang until more clarity comes by.
Thanks for that, Mika. Another stock which is in focus is L&T after it reported its Q3 earnings yesterday. Now, when we did see that the revenue was majorly in line, but it was the EBITDA, the margins which were missed, but it was on the account of the IT department and the IT and the technology services, which was quite accounted for already. But it's the order inflows which was a clear standout in this scenario. We've seen about a 53% in an uptick in terms of where the order inflows are concerned. If you look at what the brokerages are saying, Jefferies have maintained their buy target over here. They've cut the target price to 4,500 from 4,600, expecting that the Q3 EBITDA was lower than the estimates by 10%. This is mainly due to the IT and finance subsidiaries. E&C and margins, that's engineering construction margins, were impacted due to the revenue recognition in the hydrocarbon business as we speak. Commentary highlights bottoming of macro indicators that includes on what the trajectory going forward is for the order growth forward, and believes that double-digit revenue and EBITDA growth visibility should drive upside going forward for the business. While Goldman Sachs on L&T also has a buy rating, but like Jefferies, they've also cut the target price to 3,920 from 3,960. In their Q3 review, they said that the strong order inflows and margins have remained muted and is set to deliver healthy double-digit revenue growth over the medium time. Coming to what Bernstein had to say, they had the most optimistic outlook on what L&T is doing. They've maintained the outperform rating with a target price of 3,922, which is at 14% of an upside that we are are looking, they believe that the execution and margins were below expectations, driven primarily by the domestic markets. But the massive order book is set to justify future growth and should be a leading indicator for the company's performance going forward. And lastly, coming to MK on L&T, they have reiterated the buy call with a target price of 4,550 with a 33% of an upside. Their order inflow is a key positive surprise and expects surpassing 10% of guidance. So low margin in PM and the moderate growth in tech business was what had impacted profitability, but expect domestic segment to continue on the way ahead. So if you look at what L&T is doing, it is up around 4% in trade today. So this is where L&T is concerned. Even another stock which is in focus is Bharat Electronics. Another strong set of numbers, revenue, margins, PAT, all beat across the fronts. In fact, even the brokerages are quite positive on the outlook on the performance of BEL. Nomura has maintained a buy call with a target price of 363, which is a 30% of an upside. The significant beat was in terms of all the operational metrics which are there. They expect heavy ordering in Q4 of FY25. In fact, in the conference call yesterday, the management did indicate to the size of orders in tune of 25 to 30,000 crore of QR SAM, which is the missile that they make in FY26, along with the next generation corvettes that would be around the size of 14 to 15,000 crore. Jefferies also has a buy call with a 370 target price with a 34% of an upside, believes that exports should rise going forward to 9% as compared to 2 to 3% in FY24. Coming to Morgan Stanley on BEL, they have maintained overweight rating and a target price of 364. So this is what is happening in terms of where Bharat Electronics and L&T is concerned. But one of the key earnings in focus is Nestle's Q3 results. Mahima joins in with more details on the same.
Right, so in terms of the numbers, revenue is up around 4%, EBITDA is down 0.9%, and margins are down by 110 basis points at 22.7%. The net profit is, however, up 5%. Now, these numbers are pretty much in line with what analysts had estimated. In terms of the estimates for revenue were around 4738 crores, EBITDA was around 1066 crores, margins were expected at 22.5%, and net profit was expected to rise by around 2.4%, versus which it's grown by about 5%, which is why we're seeing a significant uptick in the stock. It's up 7% as we speak. In terms of the business comments coming in from the management, the e-commerce is what has aided the growth for the company. The consumer acquisition, the festival activation and premiumization is auguring growth, is what the management has said. The retail business has continued to lead its journey, that is led by Maggi and beverages and overall premiumization as well. The out-of-home consumption is one of the fastest growing business that is driven by geographical expansion in the metro cities. In terms of the exports, they've seen that registered strong growth across key international markets, which is on the back of nutrition as well as instant tea and confectionery. In terms of how dishes and cooking aids did, it also had a strong growth. In terms of milk product, the growth in Milkmaid was supported by festive season. Munch has maintained its focus in the larger regional markets. And lastly, in terms of commodity outlook, the management has said that the commodity prices continue to be firm for coffee, cocoa and cereals and grains. Prices of edible oil have now stabilized for the company, and prices continue to remain stable for milk and packaging. So this is the overall view as to how Nestle has panned out. Good set of numbers for the company, in line with what the management was expecting, and the stock is seeing an uptick of around 6%.
Well, thanks for that, Mahima. In fact, very strong reaction to the earnings, as you've mentioned. But another stock which is in focus is Kalyan Jewelers, another good set of numbers that we are looking at. Do talk to us more about the details on this one as well.
Kalyan Jewelers also a good set of number overall in terms of how the revenue grew. The revenue grew by 40%. The company recorded an EBITDA growth of roughly 75 odd percent, 18 odd percent, and the margin stood at around 6% versus out of 7.1%, so came down to 6%. Net profit was up 21%, and this was on the back of a one-off that was due to custom duty reduction that the government had announced back in budget, and otherwise the net profit growth was around 44%. In terms of the key earnings highlights, well, same-store sales growth stood at 24%. The launch of 30 Kalyan showrooms and 15 Candor showrooms is on track, and there is no impact of lab-grown diamonds seen, is what the management has said. And the impact of custom duty is now over. That will not be carried forward to any other quarter. In terms of the international business, the Middle East revenue grew over 23%. We also spoke to the management today, and they've said that in terms of the debt profile, they are in conversation with the banks to release the collateral for the debt that is already being paid. This quarter, they did not pay any debt, but going forward, they will be repaying 150 crores in the next quarter as well. In terms of the outlook, FY26, they plan to add 90 Kalyan stores and 80 Candor stores. They've said that by FY27, they will be paying off their debt, after which they will decide as to how they want to use the net cash available to them. They will be either opening their own stores or may even buy back, is what the management spoke to NDTV Profit today as well. In terms of the margins then by FY27, if they plan to open their own companies, the difference, the ratio between company owned and franchisee will be 50% and 50%. So then the margins will be around 6 to 6.5% is what the management has said. And because the results were strong and the commentary coming in is also strong, the stock is seeing an uptick of around 11% as we speak.
Well, thanks for that, Mahima. In fact, as Mahima mentioned, we spoke to the management earlier today. We caught up with the company's executive director, Ramesh Kalyanaraman, who talked about the FY27 EBITDA margin guidance. Do listen into that slice of conversation.
Again, you should look at it in two ways. If you are looking at PBT margins, even the first 9 months this year versus the 9 months last year, if you negate the metal loss, PBT margins have grown by around 0.2, 0.3%. Okay. And the way we should look at Kalyan Jewelers is PBT margins again, rather than EBITDA margins, because I told you EBITDA margins will degrow. Because if you look at, now we are at 40% franchisee revenue versus 60% owned store. If you look at 50-50 in the next year, then EBITDA margins will be only in the range of 6.5, right? So it will again degrow from where we are today. So you should look at the PBT margins. PBT margins are growing. If you negate the metal loss, PBT margins have grown in this year also. And for FOCO model, you know that the PBT margins are higher than our COCO model.
Okay, so from the consumption space, let's shift focus to the auto space. With just the January auto numbers around the corner, what kind of data is the market expecting? My colleague Rucha joins in with more details on this one.
According to Nomura, Jan 25 registration data mostly reflects the kind of discount that were given in December, and therefore they expect discount to rise going ahead as January had low inventory. Now, in terms of what Jefferies believes, that it believes that registration data for Jan shows strong growth, and therefore they prefer M&M, Eicher Motors and TVS. Now, in terms of estimates based on the total wholesales volume, Maruti Suzuki expected to report around 7% growth according to Nomura and 5% growth according to Jefferies over here. Moving on to Bajaj Auto, both largely expect around 5 to 6% of growth over here. Hero MotoCorp again 4 to 5% lastly, but M&M is expected to report a strong growth at 11% for both these brokerage houses. Largely muted growth expected in Tata Motors and Hyundai Motor India around 0 to 2%, and TVS Motors also expected to report strong growth at about 16% according to Nomura and 11% according to Jefferies. So strong growth expected largely in M&M and TVS Motors, and muted expected in Hyundai and Tata Motors as well. So this is what we have on auto sales preview for January.
Okay, so that's as far as where the auto sales previews are concerned. We'll have a focus would be tomorrow as well once the company start reporting its numbers. But another stock in focus which is doing fairly well in trade today, in fact it's up around 10%, is Wockhardt. This is after the company Zenith has completed major clinical trials. Varsha joins in with more details on this one.
Thank you, Anushi. So yes, Zenith, which is one of their novel product by Wockhardt, it is used in, it's for antibiotic resistance. Now it has successfully completed a major clinical trial, that is phase 3. Now this is a big development for the company. That's why you're seeing the stock is up almost 10%. Now Zenith has proven to be better than currently used antibiotic called meropenem, and the trial was focused on complicated urinary tract infections, wherein Zenith cured 89% of patients in the combined measure, while the meropenem, the competitor drug, cured only 68%. Now if you see the Wockhardt, now what happens next? And why this is important for Wockhardt? Because Wockhardt now plans to ask the US and Europe to approve this product so that doctors can prescribe it to their patients, and they are expecting no direct competition expected for next 15 years, so that's a big thing. And the addressable global market is at around $25 billion. Now if I were to talk about the key highlights on Zenith launch, they're considering licensing deals for Zenith in the Western markets, and they plan to offer this product. So Zenith is also called WCK 5222 at 75 to 80% discount in India versus US pricing, and they're going to file Zenith US approval in Q2 of next year, and they are expecting approval from US for Zenith in 2026, and the revenue potential for this drug stands at around $3 billion. So a big development for Wockhardt, and that's the reason the stock is up almost 10%.
Very big development. Thanks for that, Varsha. The stock is locked in the upper circuit of 10%. But shifting focus back to budget, which is just around the corner, we talked to Pavitra Shankar, the MD of Brigade Enterprises, about what is their budget wish list. Listen into what she had to say.
Quite honestly, the real estate industry keeps asking for a few things. Typically, the industry status for the sector, which would help in terms of lower, interest costs and single window clearance and faster approvals and streamlining of a lot of the regulations. I think while it's not necessarily part of the union budget, GST is something that really has to be rationalized, not just for real estate, but also related sectors like, the GST rate on cement, which is say 28%, extremely high. Definitely some more incentives for home buyers. Interest rates are good, but it would certainly help if interest rates were also lowered and some kind of tax benefit reintroduced on affordable housing. Affordable housing is something that I think should be on the government's radar, just because we are seeing a dramatic ramp up in pricing, and at some point affordable needs to be a priority again. So whether it is in terms of bringing back something like the Section 80IB benefit, maybe lowering GST on input costs for the affordable housing segment, even relooking at what should be considered affordable housing. Today it is still 45 lakhs, which is considered as the ticket size limit for affordable housing, which where customers can avail of a 1% GST for those kind of products. That's been the same since 2016 or 17, whenever the regulation was first introduced. So I think all of those things would really help if we could make a kind request.
Okay, so that was the view for the real estate side, but let's focus back to the consumption side, where Nestle has reported a relatively strong set of numbers, majorly in line with expectations. We're seeing a revenue uptick of around 4%, margins at 22.7% versus 23.8%. But discuss more on what the Q3 numbers mean for us. We are joined with Naveen Kulkarni, the CIO of Axis Securities. Hello and welcome to NDTV Profit. Give us your sense on what the Q3 FY25 numbers were, whether they were in line or were they outperforming on what the street expectations were.
Yeah, so overall the numbers are pretty much in line with expectations. But having said that, overall expectations for Nestle were pretty muted. From that perspective, I would say that inline numbers are also been something which market is taking it very, very positively, and we are seeing the buying activity happening. Overall, I would say that there is a growth which is coming back. So revenue growth is, let's say, around 4% for the domestic business. Margins have improved. EBITDA numbers have improved. So overall, I would say that some growth coming back. Maybe people envisage this to be some degree of turn happening in the consumption theme. And probably with the budget impending, I think people are willing to look back at such quality names and look at taking some position in a stock like Nestle.
Right. Naveen, Mahima also joining in. With respect to the margins, last quarter we had seen that the margins were lowest, in 2 years. But now margins are still lowering, but it's come at 22.6, which was kind of the expectations. But considering that considering what they've said in the commodity outlook, most of their commodities are now, seeing some ease in terms of growing. Do you expect the margins to bounce back from these levels? And if yes, what does the trajectory look like for Nestle?
So it's possible that the margins can bounce back from the current levels, right? Because in any case, the trajectory for margins has been going down, and Nestle over a long term, we know that is a company which tends to deliver on margins, right? So that's one aspect which Nestle actually has never had a problem in terms of delivering. It's to do many a times we've seen that there have been challenges with regards to volume growth, the product prices being slightly on the higher side. Those were the key areas, right? Once I think volume growth starts kicking in, I don't think so they should be having any challenge in terms of delivering in terms of the margins, because the pricing power that Nestle enjoys is still tremendous. I don't think so anybody in the FMCG industry comes close to Nestle in terms of their pricing power.
You know, the press releases, they've not yet mentioned what kind of volume growth they would have penciled in. But if you've got the chance to, read the numbers, the volume growth seems to be in low single digits.
Yeah, that's what it seems to be the case, because they have given category-wise some bit of bifurcation where in terms of growth. So it seems that probably there is some degree of volume growth which has come in. But exact numbers I'm still trying to figure out. It will take probably some bit of time to understand the volume growth based on pricing actions that they would have taken. But it's little early for me to comment on the exact volume growth numbers, but probably it looks little healthier.
With respect to, Tata Consumer as well, if you've got the chance to, see those numbers as well, we've seen a sharp downtick in terms of the margins, because of the tea inflation that was upheld. But international business did well for the company, and the streets have, kind of penciled in that aspect. How did you read those numbers, and what do you think? Why did the stock see an uptick in trade today? Was it on the back of the international business? Because I was penciling that kind of margins hit that the company has taken, the stock might see a downtick.
I'm really very sorry. I don't track Tata Consumer that closely, but overall, I would say that FMCG stocks have been beaten down quite a bit. If I were to look at FMCG sector as a whole, valuations from let's say 40 plus have now come down between 30 and 40 for a lot of companies. So there has been around 15 to 20% compression in terms of overall multiples. And considering that these are all quality franchises which don't require much capital to grow, I think there is a case to start re-looking at some of the FMCG names.
Right. And one last question, Naveen, before I let you go. A recent trend that's been observed is the small packs. They are something that's gaining traction because the common man does not have enough money in his hand to buy those bigger packs. Is that the common trend that you've been observing amongst all the results? And if yes, going forward, what will volume growth look like then?
See, volume growth is bound to improve, right? Because what we have seen is that in terms of what state governments are doing, there is a lot of push towards consumption as a theme. And I think even the central government will start looking at pushing consumption as a theme, right? So from that perspective, and also we are looking at a very, very low base for most of the FMCG companies. So from that perspective, overall, the volume growth trajectory in many of the categories has started to improve. And I think even in the staples category, we should start seeing improvement in volume growth numbers.
Okay, well, thanks for that, Naveen. Improvement in volume trajectory is something that we should be watching out for. But that's all the time that we have on this show. Stay tuned to NDTV for more updates and news.
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991 Manmohan Singh. That was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner. It's a very interesting time.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers, a special earnings edge edition. I'm Hiral Dadia. First up, Biocon, that's the company that we're focusing on, reported numbers. If you see in terms of the quarter after the one-offs, that's the BFI divestment and Bikara, the numbers are looking pretty strong. The key question is the growth going to continue? Joining us on the show to discuss more is Peter Baines, Group CEO at Biocon. Peter, good afternoon and welcome to the show. My first question coming to you is with regards to the like-to-like numbers, if you see after you exclude the one-offs, the kind of growth that you've seen in this quarter, are you expecting to see a continued similar position or will it improve? Because our estimates are probably we could see double-digit mid-teens.
So thank you, and thank you for the question. I mean, we're very happy, I think, with the growth seen in this quarter. As you say, on a like-for-like basis at the group level, it's 14%, 10%, which is 14% from biologics, 11% from our research services division, and although a 2% degrowth in generics, it's a healthy 8% sequential. Those are good growth dynamics, and we've been working very hard on the building blocks behind that to put in place pipelines that can ensure that that sort of growth momentum can continue and perhaps grow a little bit more going forward. So what's really important is that the pipeline in biologics now has 5 assets on a global basis to launch. And with the generics business, we're now well placed, particularly with generic liraglutide, to roll that out in the coming year. And with the research services, we've seen the return to growth with the research services picking up very nicely and supported by the ongoing growth in the development and dedicated center businesses. So yes, I mean, we're pleased with the growth this quarter, and we can have line of sight now for potentially sustaining and building on that growth going forward.
Okay, so sustenance is one part of it, but do we look at double-digit mid-teens then?
So we don't guide specifically in that sense, but the numbers we're achieving, are pretty good. As I said, on a like-for-like basis, 14% with the biosimilars, double-digit 11% with the Syngene Research Services, and more looking at the sequential growth, 8% on the generics business. So pushing to double-digit growth on all three of the drivers, and then looking to push that in, towards the teens is clearly something we're working on. It will depend on the phasing of the launches in the products we're looking to bring to market, and of course execution. But those are the kind of goals and targets that we're looking at.
Okay. Coming to your biologics segment as well, one is the market share in some of your products has actually doubled, right? So if you have to look at the other aspect, has there been any price erosion in the portfolio?
Yeah, so there's always a balance there. I mean, we're very pleased with the market share performance, as you pointed out, in the United States in particular, in the oncology franchise, where with our two lead products, Fulphila, pegfilgrastim, and Ogivri, trastuzumab, we're in the 20% market shares. Those are extremely strong positions. Inevitably, there will be some pricing pressures in the life cycle management there, but now we're well placed to bring in the new products like ustekinumab, where we're looking to launch in the United States starting next month. And that will come in at a higher margin, so you get the blend there, looking to sustain margins, and even if we can get all the products out, to expand them. So there isn't a fixed margin there. It is a mix and a blend reflecting the stage phase of your portfolio. What's important to us is to fuel that portfolio with new product launches. And in the United States, we have now line of sight in the next 12 to 18 months, 5 products to bring in, and in the rest of the world, an additional 3. So we're in a good position to look to drive the growth at the top and look to build on the margins in between.
Okay. And when you talk about the margin picture as well, your expectation has been around 22 to 23% in terms of the guidance. But taking the kind of launches that you have planned from here on, is this a conservative number? And is there a possibility you could bounce back to 25% that we'd already seen in the previous quarter?
Yeah, and I think what we've said is that we would look at EBITDA margins around 25, and around 25 because it will move, plus or minus 25, but that's the kind of number that we're looking to achieve.
Okay. And with regards to generic business, sequential good growth coming in there in spite of the pressures that the industry had seen in the generic business. You've mentioned about the mid-teen growth that could be coming in this segment. So what is going to be your focus area from here on, specifically when you look at the GLP portfolio?
Yes, and again, it's that balance and blend. So we're happy to see, while price pressures have been maintained, we have seen some volume growth across the product mix in the generic business. But, clearly a priority focus now is generic liraglutide, which we're looking to bring into the UK and then roll out across Europe in the course of fiscal 26 and then beyond in the United States. So that will drive revenues, and these are early days in the GLP market. Liraglutide is a significant opportunity for us, and of course ahead of that is semaglutide, which is a huge global opportunity with originator sales already at the 50 billion a year mark, and we'll be looking to play into that in the years ahead. So without a doubt, liraglutide is a priority focus for us to build out that portfolio on a global basis. We are scaled now in capacity to meet global demand as we see it, and we are extending our reach in both direct to market and through our partners on a global basis. UK, Europe, other markets, and the United States.
Okay, so what's the timelines with regards to launch of the GLP products in the Middle East and Brazil? Because I think those are the key agreements that you've already signed.
Yes, so the loss of exclusivity and then regulatory timelines will dictate that. And of course, we're looking to ensure that we're in a very strong launch position in all markets and are working to achieve that end. So that would be Brazil. Canada's an important market. And of course, with now that we've got the European decentralized approval, we'll be working to roll out approvals and launches throughout Europe. The file is in the United States, and we will look to get that approved, as soon as we can, and then roll liraglutide into the US as well.
And with regards to where the Malaysia facility goes, which is a big positive with the VI that has come in, apart from Stellara as well as Aspart, any other products that are awaiting US FDA approval?
Yes, and it's bevacizumab coming out of the Bangalore facility. And remember that, we've had essentially FDA holds on our two major facilities in the biologics business, Bangalore and Malaysia, for almost 2 years. And that's been a significant break on the business momentum with the successful closures and the VIA classification in both sites, which is a real highlight for the quarter. Those breaks are now off, and that means that we can go fast for both Aspart from Malaysia and Beva from Bangalore, but many other product lines that were held back by the CRLs can also move forward, product line improvements. So that now, the very significant single product opportunities in Aspart and Beva, but also breaks off on a lot of other things. So we're now mobilizing all those opportunities to take to market.
Okay, so what's the potential uptick that you're expecting specifically with regards to Stellara? Because I think the launch is in the next couple of weeks.
Correct. So, this is a significant market as an opportunity. It's globally around a $10 billion product. At the originator level, we are launching globally. The US, as you say, in the next month, but also throughout Europe. And we've received approval in Japan, and we'll be working in many other geographies. So this is a real global launch for Biocon Biologics. Of course, focus will be on the US, and we're well positioned there. The commercial team has been working on this in anticipation of the launch and looking to secure early successes, with channels and with customers there. And we're making good gains there. But it's early days. We've got to wait and see how.
But Peter, any number that you can put to it in terms of what's the maximum opportunity that comes out of it?
No, we're not going to be drawn into that. Quite clearly, everyone knows that as these markets form, there are unpredictabilities there, and we've got to navigate all of those. It's just too early to call out a number. What's important is that we position ourselves to get out of the blocks fast. We've got a fantastic product profile, and that our team is working very, very hard to secure as many early gains as we can.
Right. Moving on in terms of your insulin facility where you had a recent expansion, your capacity has doubled. So what's the target out of this one?
Insulins is a unique opportunity, and Biocon Biologics is uniquely placed. It's perhaps the biggest differentiated platform in the company. We are the largest player outside of the originators and are already a major supplier to global markets. Epidemiology in diabetes is simply going to only increase over the next decades, and the market expansion opportunity for us is very significant. That's why we put the investments into doubling the capacities of output in our Malaysia facility to capture that market opportunity, where we're very highly differentiated in our vertically integrated model through drug substance, drug product, through devices and into the market. And we're uniquely globally scaled to meet this ever increasing and large global demand.
Okay. My last question, Peter, coming to you is running short of time, so a quick one. With the additional acquisition that you've made of around 1.5% in biologics, how have you funded it, number one? And secondly, would you look at demerger of the biologics business into a separate entity at any given point in time?
So on the first question, we funded that through a short-term bridging loan facility, and we are committed to deleveraging, and that remains, a clear area of focus and priority. So this is a short-term bridging arrangement. And as you rightly said, it'll increase Biocon's holding in BBL by about 1.5%. With regard to sort of more corporate activities around options in BBL, we are monitoring, the market situation and the triggers that we have in our own control in terms of our business plans. But we're not committing to anything specifically at this time. But we're of course, monitoring all activities, including the market.
That's the management of Biocon, on track for the growth due to biosimilar business, research services through Syngene, of course, where they've seen improvement and generics portfolio. But other stock that is in focus is Dr. Lal Path Labs. Now, this is on the back of Q3 earnings that the company has reported. Q3 is normally softer, when it comes to diagnostic companies, but company grew despite not taking any price hikes. While I had a conversation with CEO Shankha Banerjee of the company regarding the plans going ahead. Listen in.
Volume for us there are two indicators of volume. One is what we call as the patient volume, which are basically patient visits, and sample volume, which are the number of tests that we are doing. So sample volume growth this quarter was a very healthy 10.3%, and even patient volume was 3.8% this quarter, which is significantly better than what we were doing same time last year.
Okay, so now last quarter you had mentioned that you don't want to go for any price increase and you want to take business ahead with the volume growth. Where do you think you want to settle? Is it like 100 or 200 basis points that you are considering the growth in the volumes going ahead?
So, again, like I said, we have patient volume and sample volume. Now, sample volume at 10.3% is more or less in line with our revenue growth number, which is close to about 10.7%. Now, when we look at patient volumes, our YTD patient volume growth for the first 3 quarters is about 4.4%. So, in the range of about 4.5%. Pre-COVID, we used to have numbers in the range of 7 to 8% in terms of, patient volume growth. I think as a business, we are trying to figure out and track, how do we reach that number as we go ahead.
Got it. Also, Mr. Banerjee, talking about the Swasthfit contribution, which contributed, the overall contribution is about 23 to 25% and has remained in that range in the last few quarters. What is the medium-term aspiration that you have set in for this?
We are not setting any target specifically on Swasthfit, but what we see as, overall market, the acceptability of bundled packages has been going up year on year. Even this quarter, our Swasthfit, portfolio grew upwards of 27%, which is significantly faster than, the overall business. And that is something which we are seeing quarter on quarter for the last 3 quarters as well. So the contribution is up versus last year about 2 percentage points. So although we've not set ourselves any specific target on that, but we see that this traction is likely to continue in the near future.
Got it. Also, how are the smaller players doing in the industry? Any specific trends that you have observed?
I assume that by smaller players, you mean the unorganized sector or?
Yes.
That's what, okay. So, in our market visits and what we get feedback from our sales teams, etc., I think, for the last year or so, there has been a bit of stability in the market, overall market in terms of pricing and the kind of advertising or marketing spends that were being seen in between. So that stability is seen even with the local players and the unorganized players in the market. So there is a sense of what would I say, with the slightly lower competitive intensity from the online players. I think because they were really impacted quite hard by the online players. So there is a sense of stability in that sector as well. Although we don't see a huge increase in maybe number of new labs that want to come in, but yes, there would be some in the periphery which may still be opening up. But yeah, there is a bit of a stability in that sector as well.
Also, Mr. Banerjee, sticking to the competition, last quarter you had mentioned that there was some pressure when it comes to competition from hospitals. Have you seen this competition increasing, or it is in line with your expectations?
So we hadn't said that there is any pressure from hospital. What we continue to say is that there are certain corporate hospitals who want to enter retail pathology. Or you see, hospitals always had pathology in-house, so it's nothing new for corporates. So we believe that they are trying to come into retail pathology, and we'll obviously need to watch how that business segment evolves for them. As of now, there is nothing significant to report. I think it is more or less similar to what we've been seeing in the last few quarters. They are obviously still building their retail pathology network, and we continue to watch as to how that segment is emerging.
Also, Mr. Banerjee, so clearly the company is actually focusing a lot on growth. Are there any adjacent areas that we have identified to further accelerate the current growth?
The overall, we are primarily in pathology business. I think more than 95% of our revenue comes from pathology. So, the pathology market itself has a huge headroom to grow. So our primary focus remains pathology, and the geography expansion and new reach that we are creating is to be able to provide access to more and more communities in the country. But the adjacencies for us would be newer streams like focusing on the genetics or the genetic kind of testing, those streams. Also 5% of our revenue, close to 5% of our revenue comes through basic radiology, and that's something which is an adjacency which we keep with us in certain markets, and that's something we work on. However, the core focus will continue to be pathology, and we believe there is a significant headroom in this area itself for us to grow.
Got it. Last two questions from my side. One is if you could help me with the number of labs that you've added in the last 9 months, and also the capex target that you have for FY25 and FY26.
So, we stated upfront that this year we are planning to add 15 to 20 new labs, and we are very, very well on track for doing that. These are numbers which we talk about once the year is over, but as your viewers can see that or be told that, we are more or less well on track for that. In terms of capex, typically, we do about a 60-70 crore of capex, and that's the range in which we are likely to be this year as well.
I present the budget for a historic
STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks that impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce? We bring you what UBS expects in 5 key aspects. The first one's of course the impact on the stock market. Government's fiscal deficit, which occurs when the government's total expenditure exceeds its income. The third aspect would be infra companies to be impacted in this key budget, changes in the capital market structure and taxation, and finally, what government companies could be divested this time around. Now, UBS feels that the budget might not boost the market as the expenditure on consumption as well as capex might be lesser compared to the previous budget. Now, this time, it is assumed that if the fiscal deficit is contained at 4.5% of the GDP in 2026, it could of course be a shortfall met by borrowings. Apart from this, UBS feels if the capital expenditure for 2026 is budgeted at a similar levels of rupees 11 lakh crores, similar to the FY25 budgeted capital expenditure, it could be negative for companies like L&T as well as the other core infrastructure companies. UBS also says the importance of domestic orders for the infrastructure companies is now higher given the limited overseas opportunities, especially in the Middle East. In this regard, UBS thinks companies exposed to private emerging infrastructure and power value chains are relatively better placed given the private sector capex growth remains in the double digit. Now, UBS also does not expect any changes in the tax policy, especially for the capital markets in their base case estimates. UBS also expects the administration to maintain a lower target for divestments of around 30,000 crores for FY26. UBS's revenue collection estimates are marginally improved in line with the nominal GDP expects, and the gross tax revenues will be in a growth phase of about 11.5 to 12% in FY26 versus about 10.7% on a year-on-year comparable basis between April and November of 2024. In terms of divestments, as mentioned, the target is around 30,000 crores for FY26, which is lower than the 50,000 crores estimated for FY25. From year to date until FY25, the government has only fulfilled 9,000 crores in terms of divestment versus previous targets of about 50,000 crores, and UBS expects stake sales by the government in companies like NMDC Steel, IDBI Bank, Shipping Corporation and BEML as the likely candidates to be pushed forward in FY26. What do you think of these particular measures, and do you think the government will lower the capex or increase it in this particular budget? Let us know in the comments below and follow NDTV Profit for more.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV.
Welcome back to Profit Buzzers. My name is Varsha. Well, Max Healthcare is the other company which is in focus. Now, this is on the back of Q3 numbers that the company has posted. Net profit did decline. Now, that was because of the exceptional item and increased finance cost.
Varsha. 1. The Economic Survey 2024-25. The Economic Survey 24-25 Statistical Appendix. Thank you.
सभा की कार्रवाई कल शनिवार 1 फरवरी 2025 को रात 11 बजे तक के लिए स्थगित की जाती है।
Well, let's hear it from Mr. Abhay Soi, who's the chairman and managing director of company. What lies ahead for the company and what was the reason we've seen the decline in the net profit? Listen in.
So I think, we've had a revenue growth of 35% and we've had an EBITDA growth of 32% for the quarter. If you take out the exceptional one-time item, which was essentially 74 crores that we had to pay to YEIDA, which is the Yamuna Expressway Development Authority, for transfer of shares to us with respect to the JP hospital acquisition transaction. And this is clearly a one-time item. Ex of that, we had a 15% growth in profit after tax. Of course, we had a net cash of 300 odd crores in the previous quarter. And in this quarter, we have about a 1600 crores debt. And this debt, 1600 crores, was essentially taken to fund the 1850 crore JP transaction that we did in October this year.
Got it. So also just, let us talk about EBITDA. Your EBITDA per bed on an annualized basis was at 73 lakhs. Now, if I compare this with Q3 FY24, it was 75 lakhs in Q3 FY24. Any reason for the decline? And most interesting part is the scale up expected in EBITDA per bed when it comes to your new units.
That's right. So we've done 3 acquisitions last year, Nagpur and Lucknow, which we acquired in 9 months ago. Obviously they would have lower ARPOBs and lower EBITDA per bed, which were expected to pull down the overall EBITDA per bed and ARPOB. But having said that, we have to look at it in terms of ROCE. What we've also been able to do as far as the performance is concerned, demonstrate very good efficiencies, because we've more than doubled the EBITDA emanating from these 2 acquisitions in less than 9 months. On top of that, we launched our Greenfield, which was in July, about 6 months ago. And I'm happy to sort of bring to your attention that we've broken even in less than 6 months. But obviously the EBITDA per bed is going to be 0 because we've just broken even. And, again, the ARPOB will be lower. But having said that, we've been able to do this in a record time of 6 months. Normally, the period for break-even on greenfields is anything between 18 months to 2 years.
Right. So this break-even EBITDA, I assume you're talking about Dwarka.
That's right.
So what are your plans there now? What is the target that you've set now, considering the unit has been EBITDA break-even?
So, well, it's been a very quick ramp up. It was supposed to be a 290, 280 bed hospital. We launched 140 beds that we've already achieved 76% occupancy. Now we are in the ramp up stage. We are already launching the balance beds. I think we'll be doing this within this month. Subsequently, and I see this perhaps same time next year being capacitied out entirely. So we need to plan for further expansions over there, which we are in the works right now. Because any expansion that we do is going to take us another 2 years, and we need to put it in works right now. So we're looking to expand it by another 200 to 300 beds going forward as well. So it's a very quick ramp up. We're expecting strong results from there, but it's been far better than what we anticipated internally as well.
Got it. And also, Mr. Sir, your ARPOB, if I were to see historically, if you see, that has grown almost 8 to 9%. Now, but this quarter, now quarter 2, I assume that it is lower when it comes to ARPOB, but quarter 3 is good when it comes to ARPOB. But your ARPOB did come down marginally. Is this because of the new units that has come online? And what is the sustainable ARPOB that you are expecting going forward?
So that's right. I think you need to look at it really on a Y-on-Y basis, year-on-year basis. And overall, whilst this may show a picture of a 1% reduction in ARPOB, the existing units, that is, X the new units, they've grown at 8%, which has been the growth in the past as well.
And also, your ARPOB in new hospitals, are they growing in double digit?
No, absolutely. I think our revenues have been growing in, almost 50 odd percent on a year-on-year basis. Our EBITDA, we more than doubled. It's more than 100% growth in EBITDA since we acquired them.
Okay. And let's talk about the occupancy. In Q3, so normally you have a lower occupancy when it comes to Q3 versus Q2. This is just sequentially that I was talking about. But what is your target when it comes to occupancy? Because Nagpur occupancy has also gone down. I mean, I think in Q2 it was around 90 odd percent. Now it is in the range of 70 or 75 odd percent. So what is the peak occupancy that you are expecting at your existing units?
Again, occupancies are normally higher in Q2 and Q4. Q1 and Q3 particularly because of the holidays, Diwali, New Year's, etc., doctors on leave, as well as patients tend to postpone their surgeries or prepone their surgeries. So we see that lower sort of occupancy impact. This year, having said that, we've had a lesser of impact as far as North India is concerned. Diwali time, typically our occupancy goes down to 70%, but this year it was 76%. On an overall basis, if you see at the consolidated level, on a year-on-year basis, our occupancy has grown by 5%. So it was 73% this last year. I think it's about 77, 78% this year for this quarter, which has been a good occupancy as far as this quarter is concerned.
Got it. Also, now speaking about your international business, your international patients, what is the share over there and what are the trends that we are expecting? And also, just wanted to know your Bangladesh contribution as well.
So we have about 10 odd percent of our patients are international patients. On a year-on-year basis, it's grown by 28%. On a quarter-on-quarter basis, grown by 8 or 9%. But really the number to look at is on a year.
Right. Meanwhile, the economic survey for 2026 has been tabled in both houses of the parliament. Let's take a very quick look at some of the key highlights that are coming in from this year's economic survey. Global economy is expected to grow by it has grown by about 3.3% in 2023. The IMF projects global growth to average about 3.2% over the next 5 years, modest by historical standards. The Eco Survey does talk about global challenges continuing well into the next year as well. Inflation rates are trending downwards steadily, the Eco Survey says. Despite the economic uncertainty globally, India's real GDP growth of 6.4% in FY25. Now, this is as per the first advance estimates that we had received earlier this month, does remain close to the decadal average. So the economic survey does believe that despite the fact that we have seen lower than what was previously being estimated GDP growth for India, the Indian economy does continue to show a fair bit of resilience. Now, keeping in mind the upsides and downsides to growth, real GDP growth for FY26 is expected in the range of 6.3 and 6.8%. Now, that's one of the big takeaways from the Eco Survey that's just been tabled. Let's quickly get in Dheeraj Nim, economist and FX strategist at ANZ Research. Hi, Dheeraj.
Hi, Pallavi.
So I know we're still going through the details of the economic survey, but of course, one of the key details that was being awaited was the range for GDP growth that the CEA would give, like he had given in the last eco survey. That's been projected at 6.3 to 6.8% for FY26. Is that broadly in line with estimates? Was the expectation that there would be somewhat of an upturn by the next fiscal year, at least, given that we are in the middle of an ongoing slowdown? Tell me your quick thoughts from this projection.
I think it's a very credible range. So I am projecting growth in FY26 at 6.5%, which is right in the midpoint of this projected range by the Chief Economic Advisor. I do think that in FY26, given a number of factors, growth will still remain in the 6.5% ballpark and somewhat below potential. So I think from a policy perspective, of course, there is a need for policy support even going into FY26. So I think it's a credible range, something that we will see play out over the next year.
Okay, all right. So, given the projections that are coming in for GDP growth, and given that there is a fair bit of consensus that the government is going to stick to its fiscal consolidation path for FY26, so we're possibly looking at fiscal deficit at about 4.5% of the GDP or so. So, how does that sort of juxtapose in a slowing economy? It does make the government's job that much more difficult, right?
Well, I think so, and I agree with it. Look, the economy is in a bit of a negative output gap, if I were to sort of voice my own view. And in that scenario, if the government is having to consolidate the fiscal deficit, then the fiscal impulse to growth, as we economists call it, will be negative. So in effect, the budget impulse to growth will be slightly negative. So instead of a driver, budget could actually be a bit of a drag on growth. Having said that, I do think that budget is not just a one-year document. It sort of also creates a vision for the medium term as well. And given where the fiscal deficit ratio, public debt ratio, debt servicing costs for the central government are, and they are very elevated, I do think that sticking to the glide path is still the most important thing for the central government finances. So I think at that minor cost to growth, as far as fiscal impulse to growth is concerned, I do think that government should stick to its glide path.
Okay, all right. Some comments on inflation in the Eco Survey. While there are no projections by the government as such, it does say that the RBI and international institutions do expect, inflation to come in closer to the 4% target and gradually align with that target in FY26. Is that broadly in line with expectations? Can we see a 4% figure or an inflation figure of a tad below 4% maybe? When is the expectation?
Okay, so a couple of things here. The RBI's own projections show that the CPI inflation will align with the 4% target by Q3 2025. I think it could happen sooner. If you look at the daily vegetable prices, because vegetable inflation was what was keeping headline inflation quite elevated. If you look at the daily vegetable prices over the course of January, headline inflation is already tracking at about 4.2, 4.3%, which is substantially below the readings of the previous few months. So I think that if food continues to, continues on a downward trend, food inflation continues on a downward trend, we could see the 4% figure in a durable manner sooner than the RBI projects currently. And I think that this view is very on point.
Right. Okay. Well, the Eco Survey also talks about how the focus needs to be on domestic growth levers. That's, a compulsion going forward. But for more details, let's also quickly go to Shrimi, who joins us with more on the Eco Survey. Hi, Shrimi. What have you been picking up?
Hi. In the July budget, the Eco Survey already pegged the growth between 6.5 to 7%. That was the range. Now it's gone further conservative and the growth rate is between 6.3 to 6.8%. Now, couple of growth drivers survey is talking about, and I wanted to highlight that. Still, I'm going through the details of it, but the couple of details. One is, of course, that government should focus on the agriculture as it remains a strong growth driver for the economy and for the next fiscal year as well. So there government wanted to have a focus. Second important point survey is mentioning about deregulation. The survey is underlining that deregulation is very important in terms of having a ease of doing business. In fact, specifically for the manufacturing sector, which survey is seeing it and it remains a concern even for the next financial year, and deregulation is required both at the state and local regulation point, especially in terms of land licensing and all the clearance, which at present causing a lot of issues in the businesses, particularly in the manufacturing sector. Third important point survey is talking on and touching upon on the employment. In fact, it's saying that artificial intelligence is one of the area which government should look into, because somewhere it's posing a risk to the overall employment. So these are a couple of points which survey is mentioning, and in fact it also touches upon the global trade, which has continued to see the down risk looking at the present geopolitical scenario, and manufacturing sector, as I mentioned, that it's remain a concern in fact for the next fiscal as well. And you remember that survey is an important document which lay a foundation for the budget, setting a tone for the budget. So we may see tomorrow some sort of fiscal stimulus from the government, because survey again highlighting that about the urban consumption which requires government attention.
All right, thanks a lot for that, Shrimi. Do stay on. I'm also joined by Upasana Chachra, Chief India Economist at Morgan Stanley. Upasana, thank you so much for speaking to us. Now, we're just unpacking the Eco Survey. I'll my first question to you as well is regarding the growth forecast that's been put out in the Eco Survey, 6.3 to 6.8. Do you find that broadly reasonable? And also to add to that, how much of a cause of concern do you find that figure to be? Because, while we are in the middle of a slowdown currently, the expectation was that next year might be better, but it does not look like it's going to be exponentially better. Any thoughts?
Hi, Pallavi. So I think on the growth side, our number for fiscal 26 is at 6.5%. So pretty much in between or in the range of what the Eco Survey is suggesting at 6.3 to 6.8%. I think it's a realistic range that the government has gone ahead with. We should, I think, remember that external factors and external developments are not probably going to be very supportive of growth. And the growth alpha is likely to come only from domestic demand. So in that context, I think starting with a range which is in this sort of mid-6 levels as a target for fiscal 25 is probably more realistic. And that bodes well from a fiscal math perspective as well. That is, you're probably going to get numbers which are going to be more realistic from the union budget that is likely to be the numbers that are that we will likely see tomorrow for fiscal 26 as well.
Yeah, so I wanted to ask one question that, post-pandemic, if you see the growth range like GDP numbers, for 3 consecutive years, we have seen growth reaching, above 7%. It touches on above 8% also. Even the last fiscal FY24, we have seen the growth is, slightly over 8%. So I wanted to ask, since second quarter seen 5.4% growth. RBI also slashed that. Do you think that government should now, change the strategy and the whole economic policy, at this point of time?
So I think, for growth to improve, there were transient factors that played their part in the number that we saw in September quarter, and there was also the role from sort of unintended but quite a bit of fiscal consolidation that happened in this fiscal 25 because government spending targets have been tracking weaker than what they've budgeted, and that I think has been a key reason. Alongside, we've also seen some amount of monetary tightening, which has its own role to play in the cyclical slowdown. But as we speak now, and as you see for the outlook, monetary policy is likely pivoting. We are seeing more aggressive measures from the RBI to address the liquidity deficit. We're probably likely to see a rate cut in the next policy. That's what our view is. And from the fiscal policy side as well, yes, the fiscal deficit is consolidating still, but probably we're going to get the slowest pace of fiscal consolidation in fiscal 26. Our estimate is that about, say, 30 basis points to 4.5% in fiscal 26. And incrementally, if you were to see, government capex spending should likely be picking up from here, just because April to November the trends have been so weak. So there is a need to catch up, at least to meet, and it's very unlikely that they meet the budgeted numbers for fiscal 25. But nevertheless, to catch up and to cover some ground. And in going into fiscal 26, we expect that at least in fiscal 26 they will meet the targets that they set. So I think the fiscal drag that we saw, which was meaningfully higher in fiscal 25, is going to be behind us, and that will by itself be supportive of growth. So we don't think that there is a need for the government to sort of give away on the fiscal consolidation roadmap, but I think it's more about actually execution and implementation and keeping the focus on, especially on meeting with the capex numbers.
All right, coming to you, Dheeraj, I do want to ask you, the eco survey, whatever we've been able to glean from it so far, any indications in terms of budget expectations for tomorrow, given maybe, for instance, the growth range, for instance, is that reason enough to expect some kind of a stimulus coming in tomorrow?
Look, like I said, the imperative to consolidate the fiscal deficit is very much there. So if you go along with fiscal prudence and fiscal credibility, which has probably been the hallmark of the current government for several years, I think a GDP growth rate, nominal GDP growth rate, anywhere between 10 to 10.5% will be a very credible number. Now, with that kind of GDP growth underlying your fiscal projections, and if you still remain conservative on revenues, for example, your tax buoyancies, etc., I think the government will still have to cut back their spending by about 30 to 40 basis points as a share of GDP. And that by itself tells you that you probably do not want to expect a big stimulus coming out of the budget for the aggregate economy. But I do want to highlight that, the budget can also work with non-fiscal measures, such as about regulation and, ease of doing business, etc., with which it can create a higher medium-term potential growth. And I think this is the perfect opportunity for that when your own growth has slowed.
Right, all right. Thank you so much, Upasna and Dheeraj, for taking time out to speak to us. We will continue our coverage of the eco survey once we go through a few more details. But till then, do stay tuned to NDTV Profit for our continuing coverage.
This is the day that shapes the future of 1 billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner, and we get you some of the major wish lists according to Bajaj Broking, the key sector expectations, as well as the 3 key stocks that you should watch out for in this particular budget. Let's start with, some of the key budget expectations in terms of sectors. In terms of banking, they have mentioned that, they're expecting no favorable terms in terms of deposits to come in, but capital infusion for PSU banks as well as insurance companies will be something to watch out for. When you move on and look at the other key expectation from banking, they are expecting that the focus of the banking and the financial space will be on sectors such as cement as well as the metals, which haven't done too well over the last 2 years. Import duty changes to support any kind of domestic production will be something to watch out for, especially for the metal space, because we are expecting and hearing rumors as well in terms of some anti-dumping duties on metals coming from China.
Hello and welcome. You're watching Top Trades on NDTV Profit. I'm Somit Sarkar and I'll be your anchor for the next half an hour of trade. Well, the Nifty continues to soar higher. It's about 1% up. It has crossed the crucial level of 23,500 in the that's the benchmark index. But when it comes to F&O stocks, we are seeing a strong traction on Kalyan Jewelers after the company reported a strong set of numbers. Now in Florin is up 7% This is on the back of strong numbers and double upgrade coming in from Jefferies. They have upgraded their rating to buy from underperform. Similarly, Sant is up around 7% in trade, and this is after JP Morgan upgraded the rating on this counter to overweight from neutral. Apart from that, it's IRB Infra, Tata Consumers, BHEL, which which have been gaining anywhere between 6 to 6.5%. When it comes to cash stocks, it's Gulshan Polyols, which has hit an upper circuit of 20% in trade, followed by Pokarna, which is up 15%, Sasken Tech, that is up around 15% in trade, and then there is Ola Electric, Suven Life, and Wockhardt, which have gained around 10% in trade. But on the losing side, we have JSPL. Now the numbers are pretty much in line with what the street was expecting, but it was the capital expenditure, in fact the surprise capital expenditure, which has led to a 7% downtick in the share prices. Then it's followed by Divi's, Bank of Baroda after a weak set of numbers, KPIT Tech, Sun TV Network, they are down anywhere 3%. Voltas is falling for the second straight session. It is down around 2%. Yesterday the stock was down more than 10% after the company reported a weak set of numbers. On the cash side, if you look at on the top losers, not much of a name, but Whirlpool is down again 9% in trade. Yesterday the stock had hit a lower circuit of 20%, so 30% down in 2 trading sessions. Vedant Fashion is down 8% after reporting a weak set of numbers. Anup Engineering is down around 8%, and then that's Raymond Lifestyle, which is down around 7% in trade. But though the benchmark index is up around 1.2% in trade, Nifty is set to decline for the 4th consecutive month. Now this will be the longest losing streak on a month-wise if you look at for the benchmark, at least in the last 4 months now, at least since in the last 23 years. Now last time when we had seen a 4 months continuous decline for the benchmark, that was back in September 2001, and since then never has the index declined for the 4th consecutive month. Now we have seen multiple times the benchmark declining at least for the 3 consecutive months, and to be precise it has been around 11 such instances where the benchmark index has declined for around 11 consecutive months. For 11 times in fact they have declined for 3 consecutive months, and out of those 11 times, 3 times we have not seen much of a positive return coming in the index over the next 2 or 3 months, but the remaining 8 times we have seen a solid gain coming in. So we'll have to wait and watch how the benchmark index reacts now going forward. But Jefferies also came out with this note today in the morning where they're saying that the long-awaited market correction is now underway for the last 126 days. Now this is the second longest correction that they have seen out of the 10 corrections that they have seen in the last 10 years. Now they're saying the markets have declined around 15%, and the current correction is in line with the average correction that they have seen in the last 10 years, and they're saying that Nifty should bottom out before Feb 7. Now Feb 7th is the RBI MPC meet, and they're expecting no tax surprise to come in the budget, and RBI to be pro-growth, to have a pro-growth stance in their MPC meet, and based on these 2 factors they're expecting that the Nifty would bottom out on 7th of Feb. Apart from this, they're bullish on the rate sensitive. They're expecting them to do well in the near-term rally, and they're saying that 12-month outlook depends on the FPI flows and strong equity supply, which could offset by domestic flows as well going forward. So we need to wait and watch what happens with the benchmark going forward. Well, moving on, a host of stocks that have been buzzing in trade, and a host of stocks that have been buzzing in trade. In fact, Kalyan Jewelers did join with us today in the morning, and the management was quite positive on the growth outlook as well, and that's the reason why the stock is up around 11% in trade. Navin Florin, as I was mentioning, Jefferies had done a double upgrade on the stock, and Citi has also hiked the target price. Pallavi will be joining us now to bring us the highlights of the economic survey.
Right, now, the eco survey has just been tabled in both houses of the parliament a short while back. The most important takeaway is that GDP growth has been estimated to range between 6.3 to 6.8% for FY26. Now, this would mean sub 7% growth for India's economy for the second straight year. Geopolitical risks have been highlighted. The eco survey says that they remain elevated because of ongoing conflicts and tensions, and continue to pose significant risks to the global as well as the national outlook. However, given the external scenario, the eco survey does say that the sectors domestically reveal that they're all performing well. Agri remains strong, consistently operating above trend levels. The industrial sector too is currently above its pre-pandemic trajectory, and the robust rate of growth in recent years has taken services as well to trend levels. So given the global economic scenario, India's GDP growth continues to be commendable. That is what the eco survey says. Some of the other focus areas are AI, agriculture, MSMEs. And we're going to be watching out for what these cues might indicate in terms of budget expectations tomorrow.
Well, Sami Hotels announced their Q3 numbers. The net profit growth and the net profit number came in at close to 23 odd crore for the third quarter of FY25. My colleague Anushi caught up with the company's chairman and managing director and chief executive officer. Let's listen into that conversation.
So first of all, I think the quarter three played out exactly as we had expected it to be. Just one correction, if I may. Because we own largely business hotels, we have traditionally seen quarter four being the strongest quarter. So quarter three was clearly very strong, as you said, that it's 10% growth over last year. But we also see quarter four trending pretty strong.
So, Mr. Jharkhandwala, I want to understand from you for Q4, what are the strong levers that you're expecting? And also, if you can give us an outlook on what FY26 can mean for the business in terms of where the revenue growth is concerned, and as well as if you can give us an outlook on the margins.
So quarter four is obviously strong also because of the fact that we don't have many holidays in this quarter. Quarter three has Diwali, Dussehra, Christmas, New Year. Whereas quarter four, after people come back from their annual vacation, we see pretty good run from then till 31st March. So that's just basically a statistical fact which helps us do better in quarter four. The second is there is a higher density of events in quarter four. That also helps. You got events in Bangalore, you got events in Ahmedabad, there are events in Mumbai. So all of these events also help shore up the demand in quarter four. And then general uptake in office space and continued growth in aviation is helping a demand for business hotels in key cities, So that's really as far as the current quarter is concerned. For the next financial year, we think that the businesses will be able to maintain a high single digits to early double digit total revenue growth. And in terms of margin in our business, we reported about 37.9% margin in the last quarter. In the next fiscal year, we have 2 or 3 things which will help us improve the margin. First is the acquisition we had made just prior to the IPO. That's playing out really well for us, and we expect that portfolio margins to cross 40%. And the second is we'll see further reduction in ESOP expenses. And the combined impact of that should help us cross the 40% reported EBITDA margins in the business in FY26.
Absolutely. In fact, I was just going to address the employee expenses now. They have seen a significant downtick in this quarter also. Want to understand from you, you've mentioned about the 2-3 levers which are there in terms of the expansion in margins that can help you. That is the integration of the various acquisitions also taking place. I want to understand the developments, the timelines on when these acquisitions would be on stream for the business and when it can start reflecting in the revenue and the margins as well.
So if you see what we've done in the last 6-8 months is we've done 2 acquisitions. One is for an operating hotel in Bangalore, which is going to be converted to a part of the Tribute portfolio by Marriott, and we're adding a Westin hotel in the same development. And then we have an office building which we are converting to a W hotel in Hyderabad. In addition to that, we have fair bit inventory addition happening within our portfolio in the Holiday Inn Express platform in large hotels like Sheraton Hyderabad and Hyatt Regency Pune. So we expect that all of these additions will start adding to the revenue starting financial year 2026 and actually continue every year till almost FY29. The big impact would be that our upscale portfolio, which operates at almost 2x revenue per key than the portfolio average, is going to double from about 1,000 rooms to almost 2,000 rooms. And that will have a substantial impact on our top line. And in terms of margins, as we keep adding revenue, and of course, as you've said, we've largely rationalized the operating structure, we expect the business to maintain more than 40% EBITDA margins on a consistent basis.
Okay, that's quite an optimistic outlook that you have. So you've mentioned about the growing focus towards the upper and upper scale hotels that is there. In fact, if you look at the RevPAR, that's the revenue per available growth, in the last 2-3 quarters, the number has ranged from 13 to 16%. So considering more of these hotels, well, after they are rebranded and repositioned, where can we see this number going up to? What's the kind of growth that you expect? Because there is expectations of a higher RevPAR growth in the coming quarters.
So the RevPAR growth has remained, as you rightly said, in mid-teens for the last 3 reported quarters. I think we maintain our point of view that total revenue growth, which includes what's coming from rooms, which is reflected in RevPAR, and also which comes from food and beverage, right? The combined effect of that will deliver, as I said, between 9 to 11, 12% total revenue growth. We feel really happy with that because we have strong operating leverage in our business. So when the revenue grows at 10% year on year, we should expect the EBITDA to grow anywhere between 13 to 14% year on year. And that's something you see even in our last few quarters. So the total revenue growth will remain in that zip code of 9 to 11%. The RevPAR itself slightly depends on the segment and the cities you're in. And some of the cities like Bangalore and Hyderabad, where we have good inventory, we continue to add more inventory, are seeing mid-teens to high-teens RevPAR growth. And some of the other cities are seeing high single digits to early double digits RevPAR growth. So that's very dependent on the city, but total overall business should deliver about 9 to 11% revenue growth.
Absolutely, that was quite informative. Mid-teen to high-teen growth is something that we can expect for the business going forward in terms of where the RevPAR growth is concerned. But coming to my next question is, with the renovations, with the upper upscale hotels inventory increasing in the next coming few quarters, want to understand from you, what is the revenue mix going to be like? Currently, if I look at the revenue mix, the 43% is the scale for upper upscale and upscale. So where do you see this number increasing to? Because that would lead to a downtick in the mid-scale segment. And also, if we can also talk about the capex plans for the business.
So I'll first take the capex, easier questions first. In the current, the next 2 months, we expect we have only about 20 odd crores of capital expenditure, largely towards initiating the W in Hyderabad and the Westin in Bangalore. For the next fiscal year, we're targeting circa about 200 crores of capital expenditure, most of it going toward opening new inventory in Hyderabad and Pune, but also continuing to do work at the W Hotel in Hyderabad and Westin Tribute in Bangalore. And then subsequently, we expect about an annualized 150 crores capital expenditure to complete the projects that we've just announced. So that's part one. In terms of impact of this on the overall portfolio mix, so as you rightly said, that currently about 45% of our total revenue came from upscale assets, and that's really doubling. So if we just see the total revenue per room in SAMI, and if we just kind of take the new inventory mix that we will have once we implement all these growth projects, we actually expect about a 35% increase in total revenue. And I'm not assuming any market growth in that. So just the portfolio mix change will itself induce about 35% or total revenue growth in SAMI because of the fact that we have higher upscale hotels in the next few years. In terms of contribution of upscale, we expect the upscale to go to about 60-65% in the short term. Just a word of clarification, we actually quite like the mid-scale space, and we believe in the long term, we'll maintain that healthy 50-50 ratio between upscale and the broader mid-scale. But in the short term, given how our portfolio is transforming, we expect the upscale to be at about 65% once Westin, W, and the Tribute hotels open.
Okay, so in near term, 65 and then 50-50 mix. Is that the correct understanding for SAMI Hotel?
That's right. That's right.
Okay. And considering the capex plans which are ongoing, I want to understand, you are also focused on reducing the debt as you move forward. I want to understand what is the current debt like and how do you plan to decrease to? What should be the levels that we should look forward to, say, FY26 and 27?
Our current net debt is about 2,000 crores. We expect that we will close the current fiscal year at about 4.5 times net debt to EBITDA. We have a stated target to get that down to about 3.5 times net debt to EBITDA in FY26. We are on track to deliver that. Actually, even this year, if we consider the amount of capex that we've invested and if we kind of remove it from our overall debt, we should start touching about 3.8, 3.9 times at the end of March 31, 2025. So we expect to take it down to about 3.5 times net debt to EBITDA by end of FY26. What's causing that is the fact that we maintain pretty healthy cash generation from the business every quarter. The capital expenditures largely, being done from the internal accruals and the cash we hold on our books, and therefore there's really no increase in gross debt. And as we implement these growth projects and start getting income from them, and plus additional cash that we accrue because of the quarterly free cash that we have, we feel fairly comfortable to touch 3.5 times by end of FY26.
Well, that was an interesting conversation with Sami Hotels, but as we wrap on this edition of Top Trades, with budget just being around the corner, NDTV Profit brings to you the wish list from various sectors, and our focus today is on the renewable and infra sector. Mihika and Anushi both are joining us to give us more details on what are the sector expectations from renewable and infra.
The government of India's focus on renewable energy stands very strong, and our country has set some ambitious target of 500 gigawatts for 2030. Our shift to clean energy is no longer just a trend, but the transition cannot happen overnight, and it certainly won't be smooth without strong government support. We need a comprehensive energy transition policy to accelerate the transition while also making energy security of the country strong. So with the Union Budget 2025 just around the corner, here is what the analysts believe and industry wants for the renewable energy sector. Let's first start with 5 key expectations. This is spread across various sub-segments of renewable or clean energy. The first key expectation is higher capital allocation for the PM Surya Ghar Bijli Yojana scheme in FY26. The current allocation stands at 75,021 crores in order to install 1 crore household rooftop installations. More support for this program can benefit players like Tata Power, Waaree Renewable Tech and Adani Green Energy. Next, Jefferies awaits tweets on duties on solar modules and cells. Positive policies in this area could benefit Waaree Energies and Premier Energies. The third key expectation is for higher budgetary support for offshore wind energy. Carriage ratings note that incentives for project cost funding, larger turbines as well as mandatory sourcing from distribution companies could help the space. The need comes due to low developer interest in offshore wind despite the 6,853 crore viability gap funding scheme announced last year. The major driver for the low interest is the 2.5 times higher setup cost for offshore wind projects when compared to onshore projects. The fourth key expectation is for battery energy storage, an ecosystem that is key for 24/7 power supply. Nuvama expects the government to take measures for energy storage technologies. Carriage Ratings, on the other hand, notes that how domestic battery energy storage ecosystem can benefit from initial subsidy support via a PLI or viability gap funding schemes. The rating agency also adds how tax for crucial raw material imports can help adoption. Furthermore, it is key to note that media reports have noted a budget proposal which has been sent to the Finance Ministry, and this proposal includes a mandate for developers to establish battery storage facilities. The fifth expectation is for higher fund allocation for green hydrogen over and above the SIDE program. Current production costs for green hydrogen are not comparable despite government efforts, and this needs to be addressed. Nuvama also expects mandates for the use of green hydrogen, ammonia in key sectors like steel, refineries, fertilizers and more. The government could also implement blending green methanol with petrol in transportation and other sectors by providing incentives for producers. This would help consumers adopt the fuel. And lastly, we also spoke to different companies operating in the space, so here's the industry wish list. As per Waaree Energies CFO, expansion of rooftop solar programs to increase adoption remains key. The company also mentioned how anti-dumping duties for solar modules and cells is critical to diversify and indigenize the supply chain and mitigate any short-term price fluctuations. Waaree Energies also notes how an increase of export subsidies on renewables from 1% to 5% will be a significant boost to the sector. Apollo Green Energy notes how the budget should address the need for modernizing infrastructure as the current grid stands outdated and ill-equipped to handle growing demands. Renew Power states that the budget needs to introduce focused funding for green skilling to ensure that India's workforce is prepared for the clean energy transition. And lastly, manager of O2 Power, which was recently acquired by JSW Energy, states how extending the conventional 15% tax rate under Section 115 BAB by 5 years would be a significant boost for the sector. The company's CFO also noted how the industry needs long-term financing challenges which have to be addressed. Well, that was what analysts expect from the budget 2025 for the renewable sector and what the industry wants. Stay tuned to NDTV Profit.
The Union Budget 2025 is anticipated to prioritize infrastructure-led sectors, particularly roads. While the Ministry of Road Transport and Highways has shown significant growth in recent years, certain challenges remain this year, such as project delay on revised cost of the Bharatmala project and capex shortfalls. Let's delve into the key expectations from this Union Budget 2025 and recent developments that one should keep a track of. The government's capex target for FY25 was rupees 11.1 lakh crore as per ICRA's expectations. The FY25 number would stand at rupees 9.7 lakh crore, missing this year's target by 13% and clocking in a growth of 2.4% on a year-on-year basis. The view, therefore, is that FY26 capital expenditure target will be set at rupees 11 lakh crore, similar to the FY25 target, which would thus lead to a 12 to 13% of an expansion over the previous year. With this growth case scenario in mind, the expectation is for a higher allocation towards infrastructure-led sectors like roads and highways. Do note that the road sector capex in the FY25 budget was up 3% to rupees 2.72 lakh crore as compared to previous three fiscals in which we had witnessed a whopping 29 to 82% of a growth. In fact, of this budgetary support for NHAI, that's National Highways Authority of India, registered merely a 0.65% growth in the last budget as compared to 18% and 148% growth in the previous two fiscals. This again reinforces the government's stance of a more cautious approach on not intending to increase NHAI's debt. It is to be noted that the NHAI could not award any projects in the first quarter due to the restrictions on awarding imposed in the wake of the Model Code of Conduct ahead of the general elections. The NHAI hence started awarding projects only July 24 onwards. Thus, higher allocation is something we need to closely track for this upcoming budget. Higher focus on developing individual corridors is the second expectation we can track. In FY25, the Cabinet approved 8 high-speed road corridor projects spanning 936 km with a total capital cost of 50,655 crore. The length of national high-speed corridors has increased from 93 km in 2014 to 2,474 km at present. According to media reports, government plans 5 to 6% hike in highway budget for FY26, aiming to reboot infrastructure development after subdued performance in FY25. Now, coming to the key highlights of not just this year, but past decade, let's see what has happened. National highway network length rose 60% from 91,287 km in March 2014 versus 1.46 lakh km. 4-lane and above NH network expanded from 18,278 km in 2014 to 45,947 km. Length of national high-speed corridors increased from 93 km in 2014 to 2,474 km. On to performance in FY25 and other key highlights. Road awarding has remained tepid in FY25 owing to delays in approval for revised cost of the Bharatmala project. Construction of NHAI stood at 5,853 km till December 24 versus 12,349 km in FY24. Construction stood at 21.28 km per day till December 24 versus 33.83 km per day in FY24. Awarding stood at 3,100 km versus 8,581 km in FY24. At present, works in about 12,500 km NH length are under construction under national highways. This also includes Bharatmala projects under which 26,425 km has been awarded and 18,926 km has been completed till November 24. So that was the roundup on the infrastructure sector. Let's wait and watch if these expectations turn out to be a reality in the upcoming budget.
STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policy makers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see the new tax regime increasing the rebate to 7 lakhs. But apart from that, there were some continuations of policy measures, but nothing big to report as for. For 2022, it was a very interesting budget because we did see a strong reaction going into the budget just the week before by roughly about 2.5% on the positive side. But in the next week, as well as the month after, we saw a sharp reaction on -5% of the Nifty reactions. Some of the key measures were like they had involved rupees 2 lakh crores as additional credit to MSME firms. Apart from that, we also saw roughly 48,000 being allocated for building 80 lakh houses, but none of these measures could give the big positive boost.
Welcome, you're watching India Market Close. I'm Mahima Vachrajani. With me is Hiral Dadia. Well, the markets today have been good in terms of the benchmark indices. The Nifty 50 is up around 1.1% as we speak. The Sensex is up 0.8%. The Nifty Bank, is up about 0.3%, but they've remained resilient today ahead of the budget. Let's also pull up the heat map and see how the contributors on the Nifty are looking like. There you go. It's a sea of green today, fortunately. And Tata Consumer, Nestle, the consumer pack is the one that's stealing the show. But let's cut into CEA, which is addressing. Let's listen to what they're saying.
Miss Chandni Raina, Economic Advisor Sri Anthony Syriac, Economic Advisor Dr. Anuradha Guru. Today's press conference will go as follows. First, the Chief Economic Advisor will give a presentation on the key narratives from the Economic Survey 24-25, followed by question and answer session. Over to Chief Economic Advisor, Shri V. Anant Nageshwaranji.
Thank you and good afternoon, everybody. Although we are almost at the end of the first month of the current calendar year, still 11 more months to go. I wish you all a very happy and healthy 2025. And I hope you had a good first month already. So we will go into the presentation on what the Economic Survey 24-25 is about. This is a presentation on the Economic Survey contents rather than on the state of the economy per se, although which will be there at towards the end of the presentation as well. The structure of today's presentation, we will cover the following issues: the changing global landscape and how India can rise the game for the new playing field. And in that segment, we will cover 4 areas, as you can see here: reform through deregulation, augmenting internal capacities for growth, the private sector's role in nation building, the energy transition the Indian way, state of the economy regaining momentum, and the growth outlook for FY26. Capacities for growth, the private sector's role in nation building, the energy transition the Indian way, state of the economy regaining momentum, and the growth outlook for FY26. The changing global landscape, we did cover that in the last survey as well. 2024 was the year of elections across the world. And most of us know that both qualitatively and in terms of quantitative dimensions, the world that existed between 1980 and you can choose the end point, some people would say 2008 or 2012, 16, etc. Roughly about 3 decades was the peak of globalization, hyper-globalization. As you can see in the statistics here, global exports went from 15% plus to 25%. Global FDI flows went from 0.5% of GDP to 3.75% of GDP. Global GDP itself rose 6 times in current prices. Extreme poverty came down because of faster growth in China and India. Internet penetration went from almost nothing to 23% as a share of world population. During this period, applied tariff rates across the world came down and the trade to GDP share went up. But clearly, you all know very well more than we do that this period has kind of ended. Even if we are not reversing very actively, we no longer are advancing along these dimensions. New import restrictions every year were of the order of about 3,000 restrictions imposed by countries across the world. They have jumped to about 5,000 restrictions in the last 4 years. And the key reason that is cited by countries in imposing restrictions is strategic competitiveness. I think that is the important theme that we have to internalize as a country, both in the policy space and in the private sector space. There is strategic competitiveness, so therefore efficiency considerations have given way to resilience and supply side security considerations. The value of trade covered under the new import restrictions was as low as $170 billion in 2014-15. Now it's more than $1 trillion, $1.3 trillion. So effectively, I think both import-export and investment flows are being looked at through the prism of strategic competition. And that is a new world which may be with us for quite some time to come, and therefore we need to get used to operating in this space. As a result, world FDI net inflows as a percentage of GDP has come down from around 5% in the first decade to around 1% of GDP. And world exports as a share of world GDP peaked, even though it may not have come down as much as investment flows have come down. Clearly, it is on a declining trend compared to the ascending trend we saw towards the end of the last millennium and in the first decade. One of the outcomes of the globalization era was also the rise of China as a manufacturing power. India also rose as a power in global services. So what has happened in the last 25-30 years, and it is continuing even now, is in several high-tech, medium-tech areas, the presence of China is pervasive and dominant, and the manufacturing as a share of world gross output, China's share will probably be higher than the combined share of the next 10 countries. It gives them a lot of strategic levers and advantage in several areas, as we will see later in some other dimensions as well. This is an important development along with globalization in the last 40 years. Now, along with the dominance in manufacturing, in terms of the materials and minerals required for global energy transition, let's first take a look at the solar energy. Global demand in 2010 was, China's share of the global demand was very small, and therefore China's production capacity in those areas was also quite small comparatively. But fast forward 11 years later, while demand has grown even within China, but the production capacity in that country has grown even more than demand, basically giving them an important lever in terms of the source of supply for all ingredients and components related to energy transition. And if you happen to see the September 2024 report of Mr. Mario Draghi on the European competitiveness, the entire 75-page report is full of European concerns about the concentration risk that is there with respect to one country as a source of supply for all critical components and technologies with respect to energy transition and manufacturing, etc. Moving on from solar energy to electric mobility, if you look at the key materials that go into it, copper, lithium, nickel, cobalt, graphite, and the rare earth materials, the dominance, and this is a slide which we have shown you back in July 2024 as well. The dominance of one country is quite clear. And in different stages of production, even if those materials are not mined in one country, the processing happens in a single country, and therefore, whether it is the cell components or battery cells, in fact, the truth is every single panel, solar panel we install, every single electric vehicle that we produce in this country, naturally the dependence on a single source for supply keeps increasing. So that dependence has to be kept in mind in the pace of transition towards renewable energies and also with respect to electric mobility. So this is the global context, that the era of globalization, faster and larger movement of trade and goods and services and investments is behind us. And there is a huge presence of a single country, a phenomena that we have not seen in a very long time, at least since World War II. So given this, naturally, we have to raise the game for a new playing field. The playing field has changed, and the game has to be rely on domestic drivers of growth. So what are those domestic drivers of growth? That is what is part 2 about. Just to recap, we do have a goal, a legitimate economic and social aspiration to become a developed country by 2047. The last economic survey broke it down into multiple components, generating about 80 lakh jobs per year, increasing our share of manufacturing in GDP, plugging Indian businesses into global value chains, and creating a viable small, medium enterprise sector, which in the German language is called the Mittelstand. Because countries that basically became powerhouses in manufacturing had succeeded in creating a viable small medium enterprise sector. Therefore, our goal with respect to manufacturing is inextricably tied to the success of being able to raise the share of SME enterprises as well. Therefore, what is the action? The action is we have to raise our game on domestic growth. And how do we do that? There are 4 dimensions to it. One is deregulation for growth, augmenting internal capacities for growth, the role of the private sector in nation building, and doing energy transition the Indian way. First, we start with the deregulation for growth. Now, when we talk of deregulation, it is not even big ticket deregulation or dismantling of the licensing era, which happened in 1991 and pursued by governments over the last 30 plus years. We are talking about the nuts and bolts or the plumbing of deregulation, which particularly affect enterprises, be they in services or be they in manufacturing, which affect them in terms of the time and the resource bandwidth that they have. And these are related to local level rules, laws, and regulations. So this is the deregulation exercise, which will probably not be a news story in the front pages, but that kind of deregulation at the local and the state government level have to happen pervasively for us not only to boost MSMEs, to boost manufacturing, but also to lift the potential GDP growth in the country.
So that's Anant Nageshwaran from CEA clearly indicating as to what's the roadmap ahead from here on. Clearly what he's indicated so far is that more than $1 trillion have been affected in terms of a value of trade goes, and this is on the back of restrictions. In fact, we need to go and up our game in terms of domestic growth as well. But the key that's coming from the economic survey is with regards to the GDP projections, and that's the crucial one that we need to watch out for. And the inflation, which has now softened to almost 4.9% in the April to December quarter, is what we are looking at. But GDP becomes the key mahima, and from there on, what the commentary will be with regards to tomorrow, growth versus the capex. That is what the street is watching out for.
Absolutely. The GDP growth for FY26 is expected to be between 6.3 and 6.8. And that's
range
very
that's
big
been given
range.
out, right?
Yeah, absolutely. And in terms of an interesting thing that even I observed was that for AI they've spoken that it's kind of they are seeing a resource challenge when it comes to AI, which is one of those sectors which is a booming one. But what they've said is that most critical obstacle is to large scale AI in medium term, and resource efficiency is at question right now. So that was also interesting. But with that, let's welcome in our guest for today. We have Ruchit Jain from Motilal Oswal joining us, and we're also joined by Ambarish Baliga, an independent market analyst. Welcome to both of you, gentlemen. Ruchit, I'll come to you first. With respect to the markets, how are you reading the Nifty and the Bank Nifty?
Yeah, hi, very good afternoon to all of you. Well, we have seen some pullback move in last 4 or 5 trading sessions, which was much anticipated because the global factors such as US 10-year bond yield and the dollar index have cooled off from their recent swing highs. But if you look at the FIS data, then still they have been selling in the cash segment and in the index futures too. They have rolled most of their positions on the short side. So I think until we see a breakout above the 200 DMA, that is 23,600 to 650 range, we are reading this up move as just a pullback move and not a trend reversal yet. Definitely, being a big event day tomorrow, volatility is expected to remain high on both the sides. So 23,000 to 22,800 would be the support zone, and whereas 23,500, 23,600 would be the resistance zone. So we expect markets to consolidate within this broad range, and any buying opportunity should be seen only on declines when we come near the support end of the range.
Interesting one, clearly, Ruchit. Ambarish, good afternoon and welcome to the show. Ambarish, my question to you is, have we hit the bottoms now? Because clearly, with the kind of downtick that has come in with regards to the markets, what is it that you're reading? Or do you think that the budget is something which will also probably play spoilsport further?
I mean, see, if we see in the last couple of years, the budget finally becomes a non-event. So I don't see this year to be very different than that. Yes, we will have an effect of the budget for a day or two, but beyond that, I think people will forget about it and life goes on as normal. If you look at the macro numbers which have been coming, nothing too great. Earnings which have come for this third quarter, by and far, they've been a bit disappointing. There were a few surprises, no doubt, on the positive side, but mostly it's disappointing. So I really don't see, any of these really trying to push the markets up. We have seen an extremely good correction in the recent past. So a normal bounce back of, say, about 500, 800 points, I think that's quite normal. And that's exactly what we're seeing as of now. The way I see it is possibly post-budget, we could in fact see lower levels. I'll not be surprised if we see levels of closer to about 22,000 or slightly below that. And that's the time I think it becomes decently priced and could be, good value. It could be a good value picking time at that point of time. Because when I talk of the Nifty going to 22,000 levels, you'll see individual stocks actually correcting much more. So that's the time I think one should be waiting for.
All right, Ruchit, quickly, the Bank Nifty, how would you trade right now?
I think one needs to be very specific within the banking space. I know there have been some signs of consolidation over last few days, and on the high side, 49,500, 49,700 is the immediate hurdle which needs to be surpassed for any continuation of the uptrend. So as of now, as we said in the Nifty, also a broad range consolidation is there. Similarly, a broad range consolidation is also expected to continue within the banking space, and only about 49,700, one should look for aggressive buying opportunities in the Bank Nifty.
Bank Nifty, Ruchit, what would your top pick be?
So very specific, as I said, within the banking space itself, Kotak Bank is one stock which on a positional basis looks positive. So if you look at this stock, compared to the other names, it has shown a good relative outperformance in the recent corrective phase of the market. And also since last 3 or 4 years, we have seen a broad consolidation phase in this stock, and it's now on the verge of a breakout of this consolidation. So we advise to go long on Kotak Bank over here, since the risk reward ratio is favorable, with stop loss below 1,800 for potential short-term targets around 2070.
All right, Nestle is the counter, and consumption overall is in focus. Let's pull up the Nifty FMCG and see how it's faring in trade today. There you go, Nestle is up 4%, but if you can pull up, there you go, 1.7% on the Nifty FMCG, and the contributors are also almost every contributor on the Nifty 50. There you go. It's Tata Consumer, Nestle, Balrampur, ITC, all of them up ahead of results. So probably boost in consumption is what we are clearly expecting. But in terms of Nestle, the revenue is up 4%, EBITDA down 0.9%, margins down by 110 basis points, and net profit was up 5%. And on the back of this, the stock is also buzzing. The results are in line with the expectations. Amrish, I'll come to you. If you had the chance to see the numbers, how did they fare? They were in line with what the analysts were expecting, but and one of those companies that has kind of posted decent numbers where consumption is actually slowing down. So what do you make out of the numbers that Nestle posted?
See, Nestle numbers are not really seen it very closely. But then if you're talking of consumption overall, I mean, in the recent past, we have seen consumption taking a beating. But I mean, at least the way ahead, clearly we see the rural demand picking up faster than the urban demand. But over the next possibly 2 or 3 quarters, we should also see the urban demand coming back on track. And for most of the companies in the consumption space, including Nestle, Dabur, HUL, ITC, in fact, we are talking of a slightly high single-digit growth in terms of volumes, with some amount of increase in margins. So I think over the next 2 or 3 quarters, we should see most of them doing much better than what we are seeing as of now. So I think it's a good buying opportunity as far as the consumption space is concerned.
Right, so that's with consumption, and Nestle seeing gains of nearly 4%. But shifting focus to the pharma pack, you have the stock of the day, which Varsha gets to us. Varsha, over to you. I think you're looking at Wockhardt, blockbuster in terms of the stock performance.
And the reason why Wockhardt has been a blockbuster because of their star product called Zenage or WCK5222, which was under phase 3 trial, has successfully completed that major clinical trial, that is phase 3. Now Zenage is proved to be better than currently used antibiotic called meropenem. Now trial focused was on complicated urinary tract infections, which they've completed. So Zenage has actually cured 89% of patients in the combined measure, while meropenem, the competitor product, has cured only 68.4%. Now Zenage has achieved 96% clinical cure rate, highest cure rate amongst the new antibiotics which has been approved in the last 10 years. Now why this is important and why we are talking about this, because after this, now phase 3, rather the clinical trials are actually important for a pharmaceutical company to get their product approved in US and in European countries and even in India. So now because of the completion of the phase 3 trial, Wockhardt plans to ask the US and European countries to approve this product Zenage so that doctors can prescribe to their patients. If I were to talk about the market position, there's no direct competition expected for the next 15 years. That's a huge for Wockhardt, because it's a novel product of this company, and the addressable global market is almost $25 billion worth. And considering the licensing deals for Zenage in the Western market, so Wockhardt is actually considering when it comes to licensing deals for Western markets, and they plan to offer this product at 75 to 80% discount in India versus US, and they're going to file Zenage US approval in Q2 of next year, and they're expecting this approval in somewhere in between 2026. And lastly, if you see the revenue potential of the single drug stands at around $3 billion. So all in all, of course the other growth driver for the company is the next product called nephrithromycin. But all in all, these two products, if you see, are the next growth drivers for Wockhardt. And so this is the reason the completion of the phase 3 trial of Zenage is the reason why the stock is buzzing today. Much for breaking that down for us, Varsha. And the stock is locked in upper circuit. at about 10 odd percent. Ambrish, I'll come to you. I think what stood out for me is that the stock deserves the upper circuit because no direct competition is expected for the next 15 years, and the addressable market is over $25 billion. That's a huge addressable market. How are you reading this? And if let's say from 2 years, 3 years down the line perspective, how should one play with a stock like Wockhardt? Because it's seen a significant up move. 1 year, it's been up over 260 odd percent.
No, that's true, but I think these are the two products which I think Wockhardt must have been waiting for a while. Because if you see the last 10 years, the stock has been underperforming. And finally now, in the last 1 year, we have seen some sort of an up move. Like you rightly said, it's already been a three-bagger. And with this news, I think we should see much higher levels. Although it may not be a one-way move, we could see some corrections. So I would just really say that whenever there's a correction, I think it would be a good time to buy Wockhardt, because this is a stock, at least for the foreseeable future, at least the next 3 to 5 years.
Okay, GHCL is the counter that's come out with its earning. But before we move on to that, we have Harsh also joining in. And Harsh, if you have had the chance to look at Cholamandalam by any chance, good set of numbers it seems, if you can address the numbers.
Yeah, so let's pull it up. In fact, let's pull up the stock as well. Slightly muted reaction, at least as of now, where the stock is concerned. The numbers showing around a 24% growth YOY, even though total income has expanded far more, not the best metric to look at. But in the sense, the way in which we've seen a sharp reaction on the counter, 1.5% lower. I'm going to quickly pull out the numbers, especially on the provision side. Will be interesting to see what that provision number looks like. And just going to quickly pull that out. Well, we're looking at provision number of 664 crore rupees versus 624 crore last quarter. So we're seeing a bit of a spike where provisions are concerned. So asset quality is suddenly starting to see a bit of pressure. I'm also going to try and pull out the NPA ratios as to what's happened there, because outside of that, it doesn't look like a bad set of numbers at all. You're looking at profit after tax, which is sitting at around 1,087 crore versus 963 crore same time last quarter. And you're also seeing a solid expansion with regard to profit after tax. So growth seems to be quite robust overall. But with regard to NPA ratios, I'd be curious to know where that sits. 4% is where the gross NPA ratio is at. Net NPA at 2.66. We're seeing slight spikes on both of those numbers. And while I'm pulling that out, let me quickly also take a view from Ambrish Baliga. Ambrish, on some of these NBFCs, you had a Shriram Finance declare numbers, you had a Bajaj Finance as well. Both of them declared an overall good set of numbers. Sub 2.5% credit cost number, definitely looking quite decent in a market or in an environment where asset quality has come back sharply into focus. Any of these that you prefer? We've seen a decentish rally that Bajaj Finance has seen as well. Just basis valuations, is there any of these lenders that you prefer? And Chola, in that context, what's your view?
No, see, in this case, overall, I would still be worried about the asset quality. Because if, any of them have not really shown, a higher provision or a declining asset quality, then I would say something is wrong. Because most of the companies in this space have seen asset quality declining. So at least for the next 1 or 2 quarters, I would still wait to see as to where they finally land up. Because there's a lot of pain at the bottom of the pyramid. If you're talking of retail, if you're talking of microfinance, there's a lot of pain in that space. So I think one should wait for a while before really taking a plunge.
Even ROA is, the PBT ROA has come off a wee bit, 3.1% now. 3.2% in Q3, 3.1% year to date. The guidance has always been that they'll be somewhere at 3.5% odd. So that's not taken too favorably by the street. Ruchit, what should one do in terms of Chola for a trade?
I think the stock has already seen some correction along with the broader markets over the last few weeks. and 1330, 1350 is the resistance level which has not been surpassed yet. So I would wait for a breakout above 1350, and if that level is broken, then one can expect a move towards 1500 to 1520 kind of range. So as of now, one can keep it on watch list. Only about 1350, I would advise to create fresh long positions.
Right, Ruchit and Amrish, thank you so much for giving us those insights, and thank you so much for speaking to us at NDTV Profit. With that, it's time to slip into a short break, but stay tuned to NDTV Profit. More on the other side.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
The union budget is around the corner. What could be announced and how will it impact the market? UBS comes out with a key report. UBS thinks that impact of the budget on the stock market would be muted as the capital expenditure and consumption boost could be limited in this time around. But what does UBS estimate the government could announce We bring you what
Welcome back. You're watching India Market Close. Well, let's go on to our next segment, that is Heard on the Street. Now, NDTV Profit brings you all the chatter from dealing room. My colleague Somit Sarkar joins with us with more details on that. Somit, what did you hear today?
Well, a lot of buzz just ahead of the budget. Tomorrow is the big day. Markets are also open. So one stock, in fact, I was going to talk about this at the last, but I'll start with the fact because we are talking about the budget. So ahead of the budget, dealers are strongly pushing the entire insurance space, be it HDFC Life, SBI Life, ICICI Pru Life, and LIC was one stock that we had highlighted back on Tuesday also, that there was strong buying action from the DI and the HNI desk. So that is continuous. That is also being pushed by dealers just ahead of budget. They're expecting some positive announcement to come in, and hence insurance is one stock that dealers have been pushing. Apart from that, on the negative side, we are seeing Sudarshan Pharma Chemicals. Now, selling pressure has been seen on the DI desk. In fact, mutual funds are the one who have been selling this counter in trade today, and hence the stock is down around 5%. Apart from that, and this is an interesting one, and that's Paytm. I guess we were talking to Harsh also this morning. If you look at the cash balance of Paytm, that stands at around 13,000 crore rupees. Now, of this 13,000 crore, they cannot use 2,000 crore for buyback, but the buzz is that there can be a buyback on this counter. Now, apart from the total 13,000 crore pool, they can use 11,000 crore, which is nearly 20% of their current market capitalization. So there's a buzz of buyback, potential buyback that could happen. The company is also meeting a lot of investors over the next couple of weeks. So Street is quite bullish on this stock. And on the negative side for Paytm, do remember there's also a buzz that there could be one FI who could put his stake on the block. So on the negative side, there's a possibility of a block deal, but on the positive side, the company is meeting a lot of investors over the next couple of weeks, and there is a potential buyback buzz when it comes to Paytm.
24% down from those highs just a month ago, Somit. So fascinating that Paytm makes it to your list. And will be very interesting if they do announce that buyback.
This is the second buyback since they have
correct.
listed. 2022, I remember.
The last one they did at 500 odd.
Right.
And now at 770. So, I mean, willing to pay 50% more for likely a very similar kind of company. But yeah, I mean, part to profitability becoming clearer. We're joined in by Kunal Shah, Senior Technical and Derivative Analyst at Sharekhan. Kunal, talking Paytm and drawing focus, because we've seen that stock under some bit of pressure. What's the sense like on charts at this point?
I think on the charts, we have seen that the stock has been already trading in a downtrend, low top, low bottom, are still intact. The stock is trying to take a support around the mark of 759, 760 zone. And once this is taken out, you can expect further downside in the stock. So it's stuck in a range. I think if one wants to go long into, can wait for a levels of at least 800 on the upside, which is a strong resistance. Once that is taken out, then one can initiate long positions, but not at the current levels.
Right.
Okay.
Right. I think it's very interesting to address Mahindra Holidays because it's up 11% right now in terms of numbers. Well, in terms of revenue, the growth is at 7%, but EBITDA has seen a growth of around 39%. Margins have improved from 16.6 to 21.5. Their margins have remained within the range of that 16-17% mark, and net profit has tripled from 11.6 crores to 34.8 crores. So good set of numbers, and the stock is, but that hike has just come post the earnings announcement, and there you go, it's up about 10% as we speak. Kunal, on the charts, Mahindra Holidays, how does it look? Because right now, of course, it's reacting to earnings, but overall, how does the chart fare?
Yeah, I think overall we have seen a very sharp correction in the stock from the higher levels. If you see, the all-time high was 500, the stock has corrected to 300 levels on the downside. Clear cut in an oversold territory. And even if I look at the historical chart, 300 was the level earlier as well from where the previous breakout had happened. So we were trading at a demand zone, and from a demand zone we have got a strong buying post the results. So I think a very good opportunity, even at the current levels, or if you get any dips, that could be an opportunity to buy. I can expect the stock to go first towards the mark of 394, which is the first hurdle for the stock. And once that is taken out, we can expect levels of 415 on the upside.
And Kunal, your budget trade, what should one expect?
See, I think firstly, in fact, we talk about budget. We at Mirai Asset Sharekhan are bullish on the housing companies. So I think there will be something for the housing finance companies, and this is where our focus is on. And out of this, we like one company, and that is Woodco, so Housing and Urban Development Corporation. So overall, a small company, but I think it looks fantastic on the technical charts as well. Relative strength is visible over here. On the PSU space, the kind of fall we have seen, even Hudco has corrected from 350, 360 to the mark of almost 200 on the downside. I think a very good risk to reward ratio is what we are getting here. The technical chart setup looks positive. It has been trading taking support at 200 rupees, which is the rising trend line for the stock as well. So I think the demand zone is quite visible. The bottom has been made on the technical chart, so one can start buying at the current levels. Keep a stop loss of 205 on the downside, and one can look for target of 260 to 280 on the higher end for Woodco. So that is something which is looking very good from a budget perspective. Second thing, the stock which looks good for again from a budget perspective is SBI. I think PSU banks have been again hammered a lot. There will be something for the PSU banks as space is what we are looking at. So over there, my pick would be SBI. Again, the correction has been sharp in SBI from the levels of almost 900 to the levels of 725 on the downside. Now we find that this is the support for the stock. The support what we see is at around 730, 740 zone. Strong demand zone. Multiple times we have seen bounces from those levels. And again, we have taken a support at the same level. I think SBI is a buy for me at the current levels. One can keep a stop loss of 750 and look for targets of 790 to 810 on the upside.
And Kunal, what do you make of the index? What should a trader do at this point? Given its budget day tomorrow, what should one brace for?
So I think better to avoid the index at this moment. I think the volatility will be very high. So even if you're trading, be very selective in your risk management. These are the days where it can wipe out your entire capital if you go aggressively. So be light on your positions when you are trading an index. But having a view here, I think 23,400, 500 was the resistance zone. What we are not able to surpass. Today we have surpassed that. Again, tomorrow is an important day. If we are able to sustain above this mark, we can expect the rally towards 24,000, 24,200 on the upside. So the view is biased. Charts are showing positive structure. Before the budget, we have seen that the range of 23,000, 23,400 has been taken out on the upside. So that's a positive signal. The data also indicates positive. So I think the 24,000, 24,200 is what I'm expecting on the upside. And even for the Bank Nifty index here, today it has been an underperformer. 49,000 has been support for the index, 49,000, 48,500 range. But after budget, Bank Nifty will be also waiting for the RBI policy. So there are two triggers for the Bank Nifty index. But overall, the structure for the Bank Nifty also looks positive. 50,000 is our immediate hurdle of 49,700, 50,000. We are not able to surpass that. So if in tomorrow's trading session on the budget day, we are able to surpass that, sustain above the mark of 50,000, then you can expect a sharp short covering in Bank Nifty, which can even take the index as high as 52,000 on the upside.
Right. Vedanta has also posted its numbers and we're seeing an uptick in the stock. Let's pull up Vedanta. Revenue is up about 10%, but net profit is where the spike is 70%. Probably yet to dissect the results, but might be because of a one-off as well. But right now it seems that it's not
actually,
no one-offs. Okay.
No, we've got power and fuel charges which have come off sharply. So that's the one big positive. And the second big positive seems to be coming from the top line itself.
Yeah, margins have also improved 24 to 28 odd percent. So good set of numbers, no one-offs, and the stock is up about 2% almost as we speak. So that's Vedanta for you. But let's go to our top 3 stocks of the day. Rucha is waiting by to give us those top 3 stocks. Rucha, what is there on your list?
Thank you so much. So I'll start with PNB, that is Punjab National Bank. Well, net profit at about 4,500 versus 2,200 crore. Gross NPA stands at about 4.1% versus 4.48%. NIM, that is net interest margin, stands at 3.09% versus 3.3%. So largely flattish kind of growth over here. So good set of numbers is why the stock is buzzing up about 5% as we speak right now. Next one is Ircon International. Well, it hit an intraday high of about 9.5%, received an EPC contract in a joint venture with AMRIL. This is for the construction of rigid pavement and line drain of 122 kilometers of road in Manipur. Execution periods of 36 months, while the sale consideration is 164 crore rupees. As we speak, the stock is nearly at the day's high, up about 8% in trade. Moving on to the last stock, which is Cyient. Now, this is a brokerage note over here where JP Morgan has upgraded the stock to overweight from neutral, hiked the target price from 1600 to 1750 levels because it turned more constructive for three reasons. Number one is the sharp correction of the stock, and brokerage house thinks that they're already baking in an internal candidate as the CEO. It also believes that there could be potential surprises, that is positive surprises in FY26 because of revenue growth estimates. It also believes that this one is a cheaper IT and ER&D stock, which is trading approximately 55% discount to the peer average, and therefore recommends buying at the dip ahead of the CEO announcement. Upside could be very significant if a strong external candidate comes in. So this is what JP Morgan believes on Cyient, and as we speak, the stock is up about 6.5% in trade.
Interesting, very, very interesting. So those are some big buzzers for you, all on the positive side. Any of these on your radar, Kunal, from a technical perspective as well?
Yeah, I think overall what we are seeing that the entire space, specifically if I talk about mid-cap and small cap, that has been doing well. But I think over here, metals is something what I'll be focusing on. Metals has witnessed a sharp correction due for a bounce from the current levels. So here on the chart perspective, whether it's a National Aluminium, Vedanta or Hindalco, it looks good for a bounce. So National Aluminium is where I'll be focusing here. The stock has seen a double bottom formation on the technical charts, and I can at least expect a pullback rally towards 220 on the upside.
Very, very interesting. So metals on your radar, Kunal. Just want to quickly cover some railway counters as well. Given that we're talking about the budget theme and Texmaco Rail came out with numbers, let's if we can just quickly pull out what the stock is up to. There you go. Nearly we saw that bit of a spike on the back of numbers, but we're seeing a bit of a cool off as well post it. Kunal, any view with regard to railway? And I'd also be curious with regard to infra and housing. Is there any of those on your radar for tomorrow?
Yeah, I think firstly, if we talk about railways, I think that is going to be one sector that is going to be in focus in tomorrow's budget. So definitely, again, we have seen sharp corrections in the entire railway pack. So a bounce was due over here. Coming to the stock specific on that, I think RVNL again looks attractive. It has forming a high bottom formation after the steep correction. The stock in today's trading session has given a breakout above the mark of 440, which was a strong resistance. So I think this looks strong for at least a pullback rally towards the mark of 500, 520 on the upside, which was the gap area which it had formed earlier. So this is a buy for me, RVNL on the railway packs, which looks good. And on the housing, what we discussed in the stocks as well, Hudco continues to be the top pick for me, even at the current levels. Good set of results compared to what the result season, what we have seen in the earlier and this one. So the results have been good. Has corrected from 360 to 200, so you're getting at a good price as well. And technically, the structure looks very attractive. So I think Hudco and RVNL, those both stocks could be a good buy at the current levels.
All right, so those are a couple of stocks on Kunal's radar. Another stock that's flying around in trade is Waaree Energies. Stock is up more than 9%. Multifold jump in the Q3 profit. We spoke to the CEO, Amit Pethankar, and he's given us a bit of an outlook on what to expect. Let's hear it from him.
It's been a good quarter for us. What has worked out in our favor, of course, is a very, very strong order book. The order book continues to be very strong. As you might have seen from our press release, we are at 50 crores of order book, which is pretty much a record for us. And this is a record quarter for us from the perspective of revenues, EBITDA, PAT, and all of that. What has worked is a very, very strong execution machinery that we have, which has delivered to customers on time, and a strong order book is being realized. We have about, I would say, about 45% of the orders coming from India and the rest from the rest of the world.
Okay, so that's of course Waaree Energies in focus on the back of numbers. Stock is up nearly 10% in trade, but let's quickly switch focus. Bull versus bear segment. Focus is on Kalyan Jewelers. Stock has been buzzing after posting a strong set of Q3 numbers. Let's hear it from Mahima, who's here to break down what the bull and the bear case scenario is, because the stock has been quite volatile in that sense. Mahima.
Right, absolutely. It's been volatile, but today it's clearly shining up and above in trade by about 10%. We've seen weakness in the stock in the past few days, but on the back of earnings, the stock is buzzing today. Let's pull up the bull versus bear case. The first case is with respect to the numbers, of course. Revenue growth was 40%, same-store sales growth came at around 24%, so high double-digit growth there. The EBITDA margins expanded by 18%. Net profit grew by 21%, but in terms of the margins were down to 6%, and they further are expecting a further hit in terms of margins because they are moving towards the franchisee-owned model where the margins are around 5%. So margins will further go down from 6% is what the management has said. Moving on to the next case in terms of the Candor business. Now Kalyan has an online presence and which is Candor, and they also have stores, but they focus on fashionable and everyday jewelry. Candor has seen a 90% growth in its sales. Revenue is expected to grow to 10,000 crores soon. But in terms of Candor, the losses are expanding every quarter. This quarter the losses grew to around 7 crores from that 1.6 odd crore, and they've also said that they'll be adding 80 more stores by FY26 for Candor, which means that the losses might further widen for this particular counter. So that's the bull versus bear case for Candor. But moving on to the kind of case that's going around with respect to the collaterals and promoters pledging their share. In terms of the collateral which is sitting with the banks, the management has said that they will discuss or they are already in negotiation with the banks for releasing the collateral, that is land banks that they've already pledged, going ahead for the debt that has already been repaid. And in terms of promoter that have pledged their shares, roughly right now 25% of promoters shares are pledged is what the management said. So that's the bull versus bear case when it comes to the pledging of shares and collaterals. The last case is where the management has said that the profit before tax growth may outpace the revenue growth going forward because of adoption of the FOCO model, that is the franchisee model. But the management has also said that they expect to repay their debt by FY27, which means that after that they will be net cash surplus, and that cash can be used either for company owned models. So if they use it for company owned model, the ratio between the franchisee owned and company owned will be around 50-50%, and therefore margins in franchisees around 5% and company owned is 8%. So the margins even beyond FY27 will be around 6 to 6.5 odd percent. So Harsh, all in all, margins to remain range bound in the next 3 years for Kalyan Jewelers, and management also did say that if they don't use that cash for company owned models, they might even consider buyback.
Well, it's a very, very interesting set of updates that keep coming through, and on regular basis over the last month or so the stock has been in focus for quite a while. And earlier we caught up with the company's executive director, and he talked about the FY27 EBITDA margin guidance, of course, among many other things. We also spoke about the pledged shares. Why don't we listen into a slice of that at least?
Again, you should look at it in two ways. If you are looking at PBT margins, even the first 9 months this year versus the 9 months last year, if you negate the metal loss, PBT margins have grown by around 0.2-0.3%. Okay. And the way we should look at Kalyan Jewelers is PBT margins again rather than EBITDA margins, because I told you EBITDA margins will degrow. Because if you look at now we are at 40% franchisee revenue versus 60% owned store. If you look at 50-50 in the next year, then EBITDA margins will be only in the range of 6.5, right? So it will again degrow from where we are today. So you should look at the PBT margins. PBT margins are growing. If you negate the metal loss, PBT margins have grown in this year also. And for FOCO model, you know that the PBT margins are higher than our COCO model.
All right, so that was the management of Kalyan Jewelers. With that, let's also welcome in Neeraj Diwan. A very good afternoon to you, Neeraj. We were talking about Kalyan Jewelers. It's seen an up move in trade today. How do you read the numbers, and how do you actually read the commentary that the management has given going forward?
Yeah, good afternoon. Yeah, actually, the numbers were good. I think that momentum is showing today on the stock also. But the stock is too volatile for my liking. It's corrected from a very high level. It's been quite volatile. Margins are still very low. Expensive stock, with debt also on the book. So I'm not very comfortable investing in something like Kalyan Jewelers. So maybe looking at the numbers, it may look attractive, and maybe some momentum may be there. So it's corrected a lot from the high level. But I would rather avoid this kind of a volatile stock at such high PE, and then the margins also quite low.
Well, that's one view coming through. Kunal, with regard to technicals, how's the chart looking on this one? Seeing a healthy bounce on the stock price today?
Yeah, I think already the stock had witnessed a sharp correction from the higher levels. So a dead cat bounce cannot be ruled out from the current levels. So we might be getting a dead cat bounce. This dead cat bounce can take the stock higher towards 525, 540 zone on the upside. But again, that would be an opportunity to exit if somebody is stuck into the stock. Overall, the structure is weak. Utilize bounces to exit the stock.
Okay, time to slip into a very short break. Gentlemen, stay with us, and viewers also stay with us, because we're going to get you top BTST strategies, as well as what to look forward to tomorrow, as well as tomorrow's picks, and we'll also have a chat with Neeraj Diwan on his picks. So stay tuned.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs, and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
STT. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT. STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policy makers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget, as well as
strong numbers coming in from UPL flashing at the bottom of your screen, 10% higher on the top line, which is largely in line with expectations, but essentially it's a beat on the EBITDA number. 2162 crore versus 1906 was the expected number. So a very strong beat coming in there, and therefore margins coming at 19.8% versus 17.4 expected. The last year margin, of course, not a comparable. It was a tepid year. It's been a difficult time for UPL. And the net profit clocked at 840 crore nearly. The expectation was something closer to 200 crore. So a very, very strong beat. Stock is now up 4% in trade. But we also have, so let's cut across to the chief economic advisor. He's addressing media after the economic survey has been tabled.
The eco survey also talks about yes, page 249, and secondly, eco survey also talks about CBAM and EUDR as protectionist garbs. What exactly is India doing to sort of protest these on a diplomatic level?
So in agriculture, there is, if you go back to the economic survey, you would see how much has been the credit flow to the farmers, how much of that has increased. And there was also a slide here which said that it's actually enhanced substantially. Also, there is a shift away from money lenders, the traditional means of financing their investments, towards institutional lending, and that has in fact from 90% that used to actually go to money lenders for their resources, it's down to less than 30%, which is much less than 30%, which is an indication that the institutional investing through, and the farmers are accessing that. In addition, for working capital requirement, the Kisan Credit Scheme card, the Kisan Credit Cards have worked very well to enhance that the availability of financial resources for them to manage their working capital requirements. In the long run, the private sector, as in the corporate private sector, will also need to invest, because that is where the resources for capital investments will that are required for agriculture will come in. On the issue of CBAM, So this is CBAM is a border. It's a carbon border adjustment mechanism, as it's called, and it's a levy that would face countries that have emissions in their products, embodied emissions, greater than a certain factor. It is in a way it's a non-trade tariff measure. It's a non-tariff barrier, and it does not take into account the fact that countries like India, we are at a different level of development, so there is clearly, and we see this as a means to a protectionist means to protect the European industry, and more than just the stated goal of reducing carbon emissions, because the end result, and there are discussions on that, and there is that it would only shift the carbon emissions from, at the moment they are consuming, because they are basically importing much of steel, let's say, but by this measure they protect their own domestic industry, and the emissions will happen within their countries. So how much is going to be really stopped in terms of carbon emissions? There are a number of studies, and an UNCTAD report brings out the fact that there's not going to be much gained through that. So clearly a measure to protect their own industry. Thank you.
11.
Right, so that's with respect to the economic survey, but we were just discussing UPL numbers. Neeraj, I'll come to you.
Let's look at that stock as well.
And the stock is flying in trade, and this spike is after the results announcement. Neeraj, I'll come to you. If you've had the chance to see the numbers, how do they look?
Yeah, the number looks very good. Margin improvement, substantial improvement in the performance. That's why I think you've seen the stock, move like this. So if these kinds of numbers, which are now going to come going ahead sequentially, I think the stock has really not done too much in the last 6-8 months. So I think this, so there can be a good momentum, based on the numbers which have come.
Just wanting your take, some of these chemical counters are doing phenomenally well. There are some pockets which are doing very, very well. Something like an Ami Organics coming out with very, very strong commentary as well. And then you have UPL, which is now up 8% in trade. Ami Organics was up 20 and followed by another 5 yesterday, and now still up one more. What's the sense like? What's the play here? And what are the opportunities which are available? What are you reading into everything that's coming through in terms of numbers here?
Is this for me?
Yes, Neeraj, please.
Okay. So I think that, we see lately last, 3-4 quarters, chemical industries are not coming out with good numbers. Most of the companies were struggling with the margins. But I think looking at the numbers this quarter, there was some feeling that we got last quarter also that things may be improving. So the numbers which have come so far, whether it's Naveen Fluorine, whether it's UPL, they were very good set of numbers. So there's a possibility that the stock, which have not really done too much in the last 6-8 months, can now look better because, the numbers, the Naveen numbers are very good. So, but similarly, when you saw Gujarat Fluorochem number, they were not that great. So it's definitely, again, going to be a stock-specific approach as far as chemicals is concerned. But there are definitely certain things which are improving for the sector. Margins are improving. So that is what is helping the profitability to improve. So there's some companies which have been able to expand the capacity in the last couple of years, last 2-3 quarters, 4 quarters. A couple of them I can name is Epigrill, then there is Yasho Chemical. So these are the companies which the capacities have also come in. So if margins will improve from these levels, so there can be a dual impact. One, top line will improve, plus at a better margin. So one should look at opportunities in this space. There is definitely something which is improving as far as margins are concerned, which will definitely go a long way, at least for the next 4-5 quarters. You can see the momentum building up.
Right. Neeraj, 30 seconds. some names which you believe outside of those which have expanded capacity, some names just because of the fundamental tailwind which might or which is visible now already in the chemical space, which may do well?
Epical is one which I like.
Okay.
I think that they have been doing quite well. Even last couple of quarters were good, and even Navin Fluorine, the numbers are good, and I think this can, still going at also the kind of prices that we see in the fluorine market, so that can support the prices, and that can be good for the stock. So these are two names which I can mention among the space.
Kunal, coming to you with regard to UPL, what's the view, and what's the view with regard to Navin Fluorine, both buzzing today?
Yeah, I think UPL, if we see that there was a big underperformance by the stock, and finally in the last couple of trading sessions, we have seen a good buying momentum from the lower levels. So the resistance for the stock was somewhere around 570. We were not able to surpass this. Now today, post the results, we have surpassed this one decisively, trading around 608. Still further upside in the stock. The next level what I see on the stock is 640, 645, which is the next hurdle. At least I can expect a rally towards these levels. On Navin Fluorine, what I can see that the stock again has given a consolidation breakout. Chart pattern has been good. The consolidation phase started in the month of December 2023. Till now, it has been consolidating and finally going to break out above the weekly 200 EMA as well. So clear cut, which indicates that now the uptrend is likely to resume. We can expect the stock to go towards the mark of 4,800 to 5,100 on the upside.
All right, so that's the view with respect to UPL and Navin Fluorine on the charts. But a few more earnings on our radar. Anushi joins in with the list. Anushi, what makes it to your list?
Right, so Mahima, I'll start off with Jindal Steel and Power first. A weak set of numbers is what we are looking at. Sales volume lower than expected at 1.9 million tons. Even the EBITDA per ton fell on both the year-on-year and sequential basis, while benefits from lower coal cost did offset some of those higher iron ore purchases that we are looking at. But it's the capex which is the standout in this result. The company announced rupees 16,000 crore of new capex. Now this new capex comes over already the 31,000 crore of planned capex which is already there, and company has only spent about 76% of the previous announced capex. So fresh capex in the current environment is something that we should be watching out for in terms of if this could be a detriment to the stock performance going forward as well. Analysts have cut their estimates for EBITDA estimates for the company. Nuvama, ICICI, MOFSL, all of them have cut their FY26 to 27 estimates. Now coming to Navin Fluorine is the next one. Strong set of numbers, revenue growth led by strong contribution of the high performance product business, even the higher capacity utilization in the specialty chemical helped margin expansion led by strong pricing and improved utilization. So a thumbs up for Navin Fluorine is what we had given. The stock is around 6% up in trade. Coming to Bharat Electronics, again a very strong performance, revenue margins, net profit were a beat, while the order inflows for the 9 months stood at about 11,000 crore, which is comparatively lower than what their 25,000 crore guidance is. The management remains very confident on the Q4 in terms of achieving the 25,000 crore mark of guidance. In fact, FY26 is something that we should be watching out for in terms of where the order inflows are concerned. We have a couple of order wins in the big ticket sizes. This is the next generation corvettes along with the other order wins in the QRSAM segment as well, which is the quick reaction surface air missile. Bharat Electronics has maintained its FY26 or 25 guidance. It has kept its revenue growth intact at 15%. But also I want to quickly address some other important updates as well. Mahindra Holidays, spectacular set of numbers, 10% revenue growth, margins at 21.5% and net profit 34.8 crore versus 11.6 crore. The member addition stood at about 3,000, and Texmaco is another counter where we are looking at a very strong set of numbers, revenue about 48% up and EBITDA margin at 9.8% versus 9.2%. Net profit also saw high uptick to 76.7 crore versus 31.5 crore. So these are some of the counters which are buzzing on the back of the Q3 earnings and strong outlook for majority of this leaving the Jindal Steel Power.
Right. Thank you so much for that extensive list, Anushi. Neeraj, I think we were talking about Mahindra Holidays earlier also. That's something that really stood out for us. The stock is on a roll post its earnings. And a lot of these hotel stocks like Chalet, Sami, all of them were in line and good, decent set of numbers. And a lot of these hotels also have big plans with respect to the key addition. How do you play this sector right now?
Yeah, hospitality sector, all these hotels have been doing quite well the last 2-3 years now. So I think that growth momentum should continue for them, whether it's Chalet, Indian Hotels, actually this last quarter numbers have been good also because this quarter there's a lot of marriages which happen. So there's, even the utilization goes up as far as the hotels are concerned. And a lot of them now have plans to, like Indian Hotel has such aggressive plans to keep on adding, rooms going ahead. So the growth will continue because, the tourism travel has also increased a lot. Plus, economy, if that picks up, so even the corporate travel can also pick up, which has not been that great over the last maybe quarter or so. So looking at the growth plans that are there and looking at the capacity utilization, which most of these hotels are showing, and the average room rent, which has been going up steadily, I think the growth will continue as far as sector is concerned.
Okay, numbers of Sun Pharma flashing at the bottom of your screen. I'm going to quickly try and address as much as I can. Revenue was expected around 13,378 crore. The number has come in at 13,437 crore. So largely in line where revenue is concerned, maybe a marginal, maybe 1% higher than what was penciled in. EBITDA number we're awaiting, and net profit is coming at 2,900 crore versus the 2,847 crore number that we've penciled in as part of our preview. In fact, apologies, it's 3,033 crore, which is what the consolidated profit after tax number looks like, 3,034 crore, so looks like a wee bit of a beat, if at all, but marginally positive, and you can see that stock price spiking. We're still awaiting the margin number to come through, but quick views. Let me first take a view from Kunal on Sun Pharma. Kunal, of course, stock is volatile because of the numbers itself, but what's your view from a technical perspective?
From a technical perspective, if you see that stock had recently had broken its support of 1728, 70 or 30, and it tested its 200 DMA. Now, whenever any supports are breached on the technical front, follow-up move is necessary. We didn't get any follow-up move on Sun Pharma. Post that, we took a support at the 200 DMA and now witnessing a bounce. So I think overall the structure still remains sideways, neutral to mild positive structure. I think this can go ahead to the levels of 1800, 1820 on the upside. So I'll be a buyer in this. If you get any dip, that would be an opportunity to buy. The 200 DMA, which is on the downside, placed at 1700, should be a stop loss for the trade.
EBITDA seems like a beat, Mahima, by the way.
Yeah. But in terms of finance cost, there's an uptick is what I'm seeing. Raw material costs have eased down. So I think that's what is probably aiding the EBITDA and probably the margins as well. However, stock in trade has gone up by, significantly by around 40-odd%. So that's one thing. That is purchase of stock in trade. Finance cost, like I mentioned, has gone up. But let's take a view of. Okay, there you go. Varsha is ready. Our in-house analyst who tracks Sun Pharma very closely is joining us to break down those numbers for us. Varsha, how is Sun Pharma?
So technically double-digit net profit growth was expected, but it came out to a single digit because of the exceptional item or a loss that the company has seen. But if I were to talk, that's the reason we are seeing this single-digit growth versus mid-teens double-digit growth was expected. Number two, if you see the gross sales, so the gross sales is up 10%, pretty much in line with the expectations. Formulation business was good, up at 14%, but US formulation sales, if you see, was down 0.7%, which was expected in a double digit. The good thing is Sun Pharma is actually concentrating on the specialty portfolio, which is the next growth driver for the company, which is up 18%, while global specialties sales accounted for almost 21% of Q3 FY25, and their emerging market was up 10%. But if you see the R&D investment was 8,450 compared to 8,255. So actually this was expected, the R&D expenses to go up, which is in line. While if you see the EBITDA was up 15%, resulting in at a margin of 29%. That's a good thing. But overall, the net profit, which was expected in a double digit, that didn't come out. The net profit is in single digit because of the exceptional item that the company has seen.
Varsha, thank you so much for breaking that down for us. Neeraj, if you've had the chance to see the numbers, how do they fare? The stock has started tanking. It's down by about 0.5%, and that's because what Varsha said, that the growth was expected in double digits, but it's come in single digits, and that's on the back of an exception item that has come out, which is roughly around 3,000 odd crores. But how do you read the numbers, Neeraj?
Yeah, I've really seen the number in detail, but generally I've been tracking the stock now. It's reached a scale where it's become expensive. It's attractive, investment pick at these prices. For the last 3-4 years, the stock has really moved a lot and given good return to the investors. I think these kind of stock can only be accumulated when you see the dip, the kind of dip that you saw in June, or you can keep on seeing dips in the stocks because of whatever reason. If someone wants to enter fresh, one should wait because it's not cheap at these prices. But if someone is holding, for long term, definitely still a hold, because gradually, if you are an investor for 2-3 years, even from the current level, you will get a decent appreciation in the stock over 2-3 years. But I won't recommend someone should enter into the stock at these levels, and because it is definitely not cheap at these prices.
Not cheap at this level is the view coming in from Neeraj, and not to enter at the current levels for Sun Pharma. But with that, let's shift focus to the auto space, and the auto sales numbers are just around the corner. What kind of data is the market expecting? My colleague Rucha joins in with more details on this one.
According to Nomura, Jan 25 registration data mostly reflects the kind of discount that were given in December, and therefore they expect discount to rise going ahead as January had low inventory. Now, in terms of what Jefferies believes, that it believes that registration data for Jan shows strong growth, and therefore they prefer M&M, Eicher Motors and TVS. Now, in terms of estimates based on the total wholesales volume, Maruti Suzuki expected to report around 7% growth according to Nomura and 5% growth according to Jefferies over here. Moving on to Bajaj Auto, both largely expect around 5 to 6% of growth over here. Hero MotoCorp again 4 to 5% lastly, but M&M is expected to report a strong growth at 11% for both these brokerage houses. Lastly, muted growth expected in Tata Motors and Hyundai Motor India around 0 to 2%, and TVS Motors also expected to report strong growth at about 16% according to Nomura and 11% according to Jefferies. So strong growth expected largely in M&M and TVS Motors, and muted expected in Hyundai and Tata Motors as well. So this is what we have on auto sales preview for January.
All right, Rucha, thank you so much for breaking those numbers down for us. Neeraj, M&M and TVS Motors too will be in focus and are expected to have the highest growth. What do you make of this?
I think these two companies have also been showing a good price movement, and they have been giving good reward to the investors. I think that will continue. Mahindra and Mahindra, even whatever launches they do in the last quarter or 2 quarters, so they also been very successful. TVS Motor has been showing good growth, and I think these two companies are definitely top picks as far as the 2-wheeler and the 4-wheeler space is concerned.
Quick take with regard to IndusInd will declare numbers today. When I was reading into some preview reports that analysts are penciling in terms of numbers, of course stock doing very well in trade today, but when I was reading into some preview reports, it suggested that credit cost will continue to remain elevated. What's your reading? They did do a provision of around 500 odd crore in the last quarter, which they were going to utilize for some part of this year. But what's your sense? Will credit costs continue to remain elevated even despite that provision?
I think it's priced in because after the provision they made and they did they must have done a fair, a fair judgment as how much is required. So I don't think it'll now rise too much from these levels. So I think they have taken the provision that they've considered all that, and the stock had also corrected because of that. Whatever stress was there because of MFI portfolio that they have, I think that's already priced into the stock prices, I think. And after the provision that they've done, and they were even selling some of those loans, so I think it would have become better. Though let's see how the numbers are, but I think that's already been taken care of.
Okay, all right. So that's the view coming in. Neeraj, very aware that you need to leave early, so we'll let you go on that note. Thanks so much for joining us this afternoon and giving us all of those views. Kunal, let me come to you with regard to top BTST ideas. We're 6.5 minutes from close, and tomorrow is going to be budget trade.
Yeah, I think overall, if we look at the budget perspective, the BTST call, where already there the stocks up by almost 4 to 5%. So I'll be finding certain stocks which are still not started to move and could move into tomorrow's trading session. So over here, my pick would be from the oil and gas space, and that is Hindustan Petroleum. Stock has given a consolidation breakout in today's trading session. The last 4 days highs has been taken out, and I can expect the stock to test its 20-day moving average on the upside, which is placed at 366. So 357, 358 is where it is currently trading. One can keep a stop loss of 353 and look for targets of 364 to 368 on the upside.
Okay, and Kunal, also your view with regard to an IndusInd stock spiking in trade today?
So I think IndusInd Bank, you can see that the correction has been very sharp. So whatever the bad news has to be come out on the result perspective, that is factored in the price. Any positive trigger would be a good up move in the stock. So I'll be a buyer in this. We can expect the stock to at least go towards the mark of 1025 to 1050 on the side.
Right, a quick preview on IndusInd, Harsh, you would want to take before we start market
yeah,
close?
so I did mention that, in fact. So net interest income expected to be flat YOY, slight bit of a fall QOQ, seeing operating profit around the 3600 crore number. Margins will likely be under pressure even in this quarter as they continue to tone down on the higher yielding book, and growth largely being penciled in is in the less risky book, and therefore will yield lower, and therefore will likely impact margins as well. Credit cost expected to remain quite elevated. In fact, our provisions number stands at around 1700 crore being the estimate versus the 1820 crore number in the last quarter, and profit after tax expected to grow healthily when you're looking at it on a sequential basis. But overall it's a lower base sequentially, and therefore you might well see some bit of pressure when it comes to the overall numbers. Anything above 1.5% on ROA I would be happy with, is what I feel. But that apart, let's quickly also wind down. We're 3.5 minutes away from the close today. Kunal, any of the life insurers on your radar? None of them buzzing today, but there's plenty of buzz. We have the segment Heard on the Street where Somit highlights a couple of stocks, and he suggested that life insurers could well be in focus for tomorrow.
Yeah, I think over here, one company very attractive to me is LIC. Already the stock has seen a correction from the high level, trading in deep oversold territories. On the technical chart, there is a double bottom formation which is visible. So any positive trigger could lead to a good rally on the stock on the higher end. So LIC is what I'll be focusing on. The immediate target, short-term target, what I see is 880, and post that if the rally continues, it can even go towards 940 on the upside. So LIC has a good risk to reward ratio even from the current level.
Kunal, any consumption, a lot of them have come out with their earnings now. It's time to probably sum those up. We're seeing, few counters doing fairly well, few counters under pressure. But budget is something where consumption as a space will be watched out for. If there are changes in income tax, consumption is going to see a huge boost. Any names from those players to be watched out for tomorrow or on your list?
Yeah, I think on my list over here is the Nifty FMCG pack. I think firstly, FMCG looks attractive to me. Early signs of the index showing some signs of at least a pullback towards the 200 DMA. So out here, my positive view would be on Hindustan Unilever. Already the stock has corrected sharply from the high levels. At least a pullback can be expected towards the mark of the 200 DMA and the 100 DMA, which stays around the same mark. So 2540. 2550, this is the range what I'm expecting the pullback to go towards, currently trading at 2476. So this could be a good pullback play for from the current levels, at least 75 to 80 points on the high.
Okay, thanks so much Kunal for joining us this afternoon, giving us all of those views. Let's look at the intraday chart on the Nifty 50, see how we're closing up ahead of the budget. It's been a 5-day trading week already, and we're going to have a 6th day of trading tomorrow, so it's going to be an interesting one. But there you go, 1.25% higher on the Nifty. We're closing very close to the day's highs. The Bank Nifty yet again underperforming today, even though there have been lots of technical analysts coming on our shows and talking about how the Bank Nifty ought to outperform, but that's not happening yet. So let's pull up the Nifty 50 intraday chart, start looking at how the chart is shaped up for the day. We're closing at the high point. Let's look at contributors as well, if we can quickly pull those up. I'd be curious to know which ones are contributing. L&T, no surprise after the kind of order book that's been delivered. ITC on that list, Reliance and Infi. The losers far and few, frankly, nothing material on the losing side of it. So we've had a good day. Can we pull up the heat map? And likely that heat map looks quite good. There you go. 44 stocks in the green. And when you're looking at stocks gaining 1% plus, it's 30 stocks gaining 1% plus. So the breadth is extremely good, Mahima, as you can see.
ITC again, lower circuit.
Yes, ITC hotels on a lower circuit. Sorry, I missed this part of the screen.
I mean, it'll push the elimination of ITC hotels from the Nifty 50 counter till it's hitting the lower circuit. Yesterday also I believe it did hit lower circuit, and today also it's in lower circuit. So that re-rating continues. But look at some big movers. Tata Consumer. Who would have seen this, right? After the numbers that came through. Mahima, we spoke about this today morning. Trent 5% higher, and L&T to me is the standout of the day. Such strong numbers. IndusInd Bank 4%. Well, we'll look out for the numbers on that one as well. Hero Moto also up 4%. Let's quickly look at the breadth of the market, the advanced decline, and I'll hand it over to Mahima thereafter to take us through how broader markets are doing. Well, the breadth is extremely good today, and we hope that this sustains into tomorrow as well. Absolutely, continues till at least for now till 2025 ends, and hopefully the bullish run continues. Let's also look at the broader markets. The broader markets are also fairly doing well. There you go. The mid cap 150 is up about 1.9% and also at its day's highs. The small cap 250 is also at its day's highs, up by about 1.7%. And I believe that these trades are on the back of budget that is going to be announced tomorrow. Ahead of this budget, all of these broader markets and the benchmarks moving. Let's also put up the sectoral heat map and see which is the top gainer in terms of the sector today and the top loser as well. There you go. We've got no losers. Nifty Pharma with the lowest gains, that is 0.12%. But there you go. This Nifty Energy, which is leading the pack, 2.6. Consumer Durables 2.4. Nifty FMCG clearly stealing the show. We saw the heavyweights up by about 6 to 4%, and that's where we're seeing the gains coming from. So Nifty FMCG up by about 2%. Nifty Realty, circling back, kind of coming back to the growth area. It's up about 2%. There you go. There's Nifty Oil and Gas up about 2%. Nifty Small Auto is also, buzzing ahead of the auto sales numbers. Nifty Infra also up 1.5%, and of course infrastructure, we'll be expecting a lot of announcements tomorrow as well. So that is also buzzing on the back of, not on the back of, but ahead of budget. But so with that,
but I want to quickly mark out Realty for the week, if we can pull that up, because I'd be curious to know. We've had 2-3 days of phenomenal returns for the Realty index, no matter where the benchmark has gone or where broader markets have gone.
And this is because
higher.
pre-sales have improved for a lot of
8%
these
higher
companies.
this week, Realty Index. So we've gained 2% nearly every day. And I'd be curious to see as to how tomorrow's budget announcements impact this index in particular. Because there is some bit of zing expected from the budget on the realty front as well. But with that, from Mahima, myself, as well as Hirala and everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you. STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahuguna. Now viewers, let's get straight into the show. Now benchmarks rally ahead of Union budget tomorrow. The Nifty ends above 23,500 mark whereas the Sensex ends above 77,400 mark. Broader markets outperform benchmarks with sharp gains. The mid-cap index rallies with Kalyan Jewelers leading the charge. Meanwhile, the small-cap index gains 1.7% as railway stocks Jupiter Wagons and Ircon buzz ahead of Union budget. It was a sea of green on Dalal Street today. All sectoral indices rally to end higher. FMCG index gains the most. Tata Consumer tops the pack on strong Q3 results. Consumer durables, realty, auto and financials follow the gains. Viewers, the Finance Minister tables the economic survey in the Lok Sabha today. As per Economic Survey 2024-25, India's real gross domestic product, that is the GDP growth for FY26 is projected to be 6.3 to 6.8%. The forecast suggests economic conditions will remain sluggish next year. The Economic Survey further indicates that geopolitical risk remain elevated due to the ongoing conflicts and tensions. Focus on reforms and economic policy must now be on the systematic deregulation. The agriculture sector remains strong, whereas the industrial sector has found its footing above the pre-pandemic trajectory. Biocon shares see buying despite a bleak third quarter performance. The company's consolidated net profit plunged 96.2% to 25.1 crore rupees from 660 crore rupees. We spoke to Peter Baines, Group CEO and Biocon
and he was optimistic that market share for most of the products have gone up. The management expects higher margins for future products and EBITDA margin around 25%. Kalyan Jewelers reports a 44% growth in profit after tax, adjusting for the loss due to a reduction in the customs duty. Revenue from the Middle East grew over 23%, while Candere recorded a 90% growth. Though its losses widened to approximately 7 crore rupees, the company remains on track to launch 30 Kalyan showrooms and 15 Candere showrooms. Brokerage firm Citi maintains a buy on Kalyan Jewelers, cuts the target price to 650 rupees from 810 rupees. Growth and profitability of the company seems to be on track. Management says that demand remains strong despite rising gold prices. They've repaid 450 crore rupees debt in the last 1.5 years and aim to repay another 150 crore rupees in the Q4. The company plans to add 90 stores in FY26. Profit before tax growth is also expected to outpace revenue growth in FY26. State-owned lender Bank of Baroda will look at maintaining its net interest margin at 3 to 3.1%, lower than the previous guidance. Chief Executive Officer and Managing Director Devadatta Chand said in an interview with NDTV Profit, our earlier guidance for margins was 3.1 to 3.2%, and now we are saying that due to cost dynamics on the deposit market, we will operate at 3 to 3.1%. My 9-month NIM is at 3.08%. There is a cost pressure for all players in the industry. That's what Chand said. Now, luxury and branded hotels company Sami Hotels sees selling despite turning profitable in Q3. Lower employee cost aid in margin expansion. The company reports exceptional loss of 76.8 crore rupees. The company's management highlights growing share of upper and upscale hotels. Praj Industries shares fall after the release of its third quarter financial results for fiscal 2025, which fell short of analyst expectations. The company's consolidated net profit declined by 42% year-on-year to 41.10 crore rupees, missing the Bloomberg consensus estimate of 78 crore rupees. We spoke to Shishir Joshipura, MD and CEO of the company, and is positive on the order book growth. Says the company reported healthy gains over 9 months as international business revenue expands. Now, auto sector rooms ahead of union budget and January auto sales numbers tomorrow. Nomura expects January 25 registration data reflecting discount-driven sales in December 24. Jefferies expects M&M, Eicher Motors and TVS sales to outperform. Nestle India shares Zoom post Q3 results. Revenue climbs 3.9% year-on-year, hitting a 4,780 crore rupees compared to 4,600 crore rupees. EBITDA dips by 1%, settling at 1,085 crore rupees against the previous 1,095 crore rupees. The EBITDA margin slides to 22.7% from 23.8%. Net profit jumps 4.9% to 688 crore rupees, up from 656 crore rupees. The board greenlights a second interim dividend of 14.25 rupees per share. Waaree Energies stock charges after its Q3 earnings. The revenue of the company is up 2.2 times at 3,457 rupees versus 1,596 rupees. EBITDA is up 4.2 times. EBITDA margin is up 1,020 basis points. Net profit is up 3.4 times at 493 crore rupees versus 125 crore rupees. The current order book of the company is 26.5 gigawatt, having a value of 50,000 crore. This is against 20 gigawatt order book in the first half of FY25. The company has spent over 790 crore rupees to acquire 100% stake in NL Power India. This acquisition is expected to be completed in 3 months. Sun Pharma stock gained strength post its Q3 results. The consolidated net profit of the company is at 2,900 crore rupees versus estimate of 2,847 crore rupees. EBITDA is at 4,009 crore rupees against 3,686 crore rupees. India formulation sales at rise 14% to 43,004 million, driven by industry-leading volume growth. Tata Consumer surges more than 5%, reacting to a good set of numbers. Brokerage firm Jefferies also maintains a buy on Tata Consumer, but cuts the target price to 1,100 rupees from 1,130 rupees. The company delivered growth but missed on the margins due to a sharp rise in tea prices, which impacted its Q3 performance. International and non-branded segments partially offset pressure. Recent acquisitions have stabilized with a focus now on growth. Jefferies cuts EPS forecast by 4 to 8%. Brokerages give a thumbs up to L&T earnings. Jefferies maintains a buy but cuts the target price to 4,500 rupees from 4,600 rupees, which was earlier, with an upside of 31.1%. Goldman Sachs maintains a buy on L&T and cuts the target price to 3,920 rupees from 3,960 rupees and an upside of 14%. The brokerage firm believes that the company will deliver healthy double-digit revenue growth over the medium term. Bernstein maintains an outperform with a target price of 3,922 rupees and 14% upside. MK reiterates buy with a target price of 4,450 with an upside of 32.5%. Now on to an NDTV Profit exclusive. Have you ever heard of a finance company relying on money lenders? Yes, that is exactly what has happened. That is allegedly, happened at AVM India Housing Finance, which is currently facing insolvency proceedings by the RBI. The lender allegedly borrows high-interest loans from the money lenders. Funds are used to repay lenders. In this process, home loans are extended to fictitious accounts. An audit is underway to determine the quantum of the fraudulent activities. The company has a debt of 1,400 crore rupees. In a significant relief for senior citizens, the Insurance Regulatory and Development Authority directs insurers to not revise premium for the elderly by more than 10% per annum. Insurers have been directed to consult the regulator in case the premium is more than 10% and if one wants to withdraw individual health insurance products. Zenix successfully completes a major phase 3 clinical trial, proving to be more effective than the current antibiotic meropenem. The trial focuses on complicated urinary tract infections, with Zenix curing 89% of patients in combined measures compared to meropenem's 68.4%. Zenix achieves a 96.8% clinical cure rate. Wockhardt DD plans to seek approval for Zenix from the US FDA and EMA. Prime Minister Narendra Modi addressed nation ahead of the union budget. He praised to Goddess Lakshmi to shower her blessings on the middle class. He says that the nation has given him the responsibility for the third time and highlights that this is the first full budget of their third term. The budget aims to boost India's confidence and energy to become a developed nation by 2047. The approach is reform, perform and transform, emphasizing innovation, inclusion and investment. Suspected cases of GBS rise to 130 in Maharashtra. 2 patients, a 56-year-old woman from Pune and a man from Solapur, have died so far. Of the total 130 suspected patients, 75 are diagnosed as confirmed GBS cases. The health department continues to monitor the situation closely. Air quality in Delhi NCR touches severe levels again. The Commission for Air Quality Management, which is the CAQM, reimposed Stage 3 of the Graded Response Action Plan GRAP from today. The AQI of Delhi, which was recorded at 276 on Tuesday, increased exponentially and was recorded at 365 today. US President Donald Trump issues a warning to BRICS nations, threatening 100% tariffs on their exports if they attempt to replace the US dollar as the dominant currency in the international trade. Trump has repeatedly expressed his stance against de-dollarization, warning that BRICS countries must maintain the US dollar's role in global trade or face the economic consequences. US President Donald Trump says he will announce tariffs on Canada and Mexico by as early as February 1st. But Trump adds that a decision about whether this would include oil from those countries had not yet been made. More than 100 Palestinian prisoners freed by Israel after chaotic hostage release in Gaza. They arrived into Ramallah in the occupied West Bank by bus and were met by a huge crowd who gathered to welcome their release. These recent releases mean that 15 hostages held by Hamas have been freed since the ceasefire came into effect on January 19th. 82 are still being held. Viewers, big setback ahead of the ICC Champions Trophy as reports suggest that the hosting country Pakistan has cancelled the opening ceremony of the ICC Champions Trophy. Reports that Pakistan has cancelled it because Rohit is not attending, the event, and Australia, and also. As per NDTV, the event was cancelled due to delayed arrival of the several teams. The report quoted ICC sources as saying England and Australia are arriving in Pakistan later than planned. England will reach Lahore on February 18, while Australia will arrive the next day. The Champions Trophy 2025 starts with a match between Pakistan and New Zealand. In such a scenario, as captain meet is not feasible, said the report. From the football world, Manchester United make their way to last 16 stage of the Europa League competition. The Red Devils beat Romanian team FC SB led by goals from wing-back Diogo Dalot and young stalwart Kobe Manu. Mark your calendar as Squid Game Season 3 is set to premiere on June 27, 2025. Filming for the third season began right after Season 2, so fans do not have to wait for a long time. The nerve-wracking series will be available on Netflix. Shahid Kapoor starrer Deva releases in theatres. The film might struggle to meet expectations on both financial and experience front. As per Sacklink, the movie has collected just 1.67 crore rupees via advance booking for its first day. And before the release, the film sold less than 1 lakh tickets nationwide. But given the expectations of better reaction in Tier 2 and Tier 3 cities, one will keep an eye out for the financial recovery. After the fourth season of Stranger Things ends on a cliffhanger, Netflix releases poster of season 5. But what catches attention is Eleven's disappearance. So excitement has doubled with curiosity rising on Millie Robbie's character as she was last seen walking on the sidewalk near Hawkins High School. Max Healthcare posted its Q3 earning. We spoke to Abhay Soy, Chairman and Managing Director, Max Healthcare, and asked him about the company's revenue growth plan going forward. Listen in.
I think, we've had a revenue growth of 35% and we've had an EBITDA growth of 32% for the quarter. If you take out the exceptional one-time item, which was essentially 74 crores that we had to pay to YEIDA, which is the Yamuna Expressway Development Authority, for transfer of shares to us with respect to the JP hospital acquisition transaction. And this is clearly a one-time item. X of that, we had a 15% growth in profit after tax. Of course, we had a net cash of 300 odd crores in the previous quarter. And in this quarter, we have about a 1,600 crores debt. And this debt, 1,600 crores, was essentially taken to fund the 1,850 crore JP transaction that we did in October this year.
Got it. So also, just, let us talk about EBITDA. Your EBITDA per bed on an annualized basis was at 73 lakhs. Now, if I compare this with Q3 FY24, it was 75 lakhs in Q3 FY24. Any reason for the decline? And most interesting part is the scale up expected in EBITDA per bed when it comes to your new units?
That's right. So we've done 3 acquisitions last year. Nagpur and Lucknow, which we acquired in 9 months ago. Obviously they would have lower ARPOBs and lower EBITDA per bed, which were expected to pull down the overall EBITDA per bed and ARPOB. But having said that, we have to look at it in terms of ROCE. What we've also been able to do as far as the performance is concerned, demonstrate very good efficiencies, because we've more than doubled the EBITDA emanating from these 2 acquisitions in less than 9 months. On top of that, we launched our Greenfield, which was in July, about 6 months ago. And I'm happy to sort of bring to your attention that we've broken even in less than 6 months. But obviously the EBITDA per bed is going to be 0 because we've just broken even. And, again, the ARPOB will be lower. But having said that, we've been able to do this in a record time of 6 months. Normally, the period for break-even on greenfields is anything between 18 months to 2 years.
Right. So this break-even EBITDA, I assume you're talking about Dwarka.
That's right.
So what are your plans there now? What is the target that you've set now, considering the unit has been EBITDA break-even?
So, well, it's been a very quick ramp up. It was supposed to be a 290, 280 bed hospital. We launched 140 beds that we've already achieved 76% occupancy. Now we are in the ramp up stage. We are already launching the balance beds. I think we'll be doing this within this month. Subsequently, and I see this perhaps same time next year being capacitied out entirely. So we need to plan for further expansions over there, which we are in the works right now. Because any expansion that we do is going to take us another 2 years, and we need to put it in works right now. So we're looking to expand it by another 200 to 300 beds going forward as well. So it's a very quick ramp up. We're expecting strong results from there, but it's been far better than what we anticipated internally as well.
Got it. And also, Mr. Sir, your ARPOB, if I were to see historically, if you see, that has grown almost 8 to 9%. Now, but this quarter, now quarter 2, I assume that it is lower when it comes to ARPOB, but quarter 3 is good when it comes to ARPOB. But your ARPOB did come down marginally. Is this because of the new units that has come online? And what is the sustainable ARPOB that you are expecting going forward?
So that's right. I think you need to look at it really on a Y-on-Y basis, year-on-year basis. And overall, whilst this may show a picture of a 1% reduction in ARPOB, the existing units, that is, X the new units, they've grown at 8%, which has been the growth in the past as well.
And also, your ARPOB in new hospitals, are they growing in double digit?
No, absolutely. I think our revenues have been growing in, almost 50 odd percent on a year-on-year basis. Our EBITDA, we've more than doubled. It's more than 100% growth in EBITDA since we acquired them.
Okay, and let's talk about the occupancy. In Q3, so normally you have a lower occupancy when it comes to Q3 versus Q2. This is just sequentially that I was talking about. But what is your target when it comes to occupancy? Because Nagpur occupancy has also gone down. I mean, I think in Q2 it was around 90 odd percent. Now it is in the range of 70 or 75 odd percent. So what is the peak occupancy that you are expecting at your existing units?
Again, occupancies are normally higher in Q2 and Q4. Q1 and Q3 particularly because of holidays, Diwali, New Year's, etc., doctors on leave, as well as patients tend to postpone their surgeries or prepone their surgeries. So we see that lower sort of occupancy impact. This year, having said that, we've had a lesser of impact as far as North India is concerned. Diwali time, typically our occupancy goes down to 70%, but this year it was 76%. On an overall basis, if you see at the consolidated level, on a year-on-year basis, our occupancy has grown by 5%. So it was 73% this last year. I think it's about 77, 78% this year.
STT. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
Real GDP growth in FY26 is expected to be between 6.3% to 6.8%. According to the 2024-25 Economic Survey 2024-25 tabled by Finance Minister Nirmala Sitharaman in the Parliament ahead of the Union Budget. Health tax proposed on brands promoting ultra-processed food, says CEA Nageshwaran, adds that misleading ads target consumer behavior and the business is built on hyper-palatability of food items. Nifty Sensex settled higher for fourth session ahead of the 2025 Union Budget. Benchmarks also snapped a 3-week declining streak. All sectoral indices ended in the green with FMCG and consumer durables leading the gains. India will be a developed nation by 2047 with a focus on inclusive development. This is what PM Modi had to say while addressing the media ahead of the first day of fourth session of the 18th Lok Sabha. tariffs on Canada and Mexico will be increased to 25% effective February 1st. This is what Donald Trump had to say, adding that those tariffs may or may not rise with time. Hello and welcome. This is Profit 360 on NDTV Profit, and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So viewers, Union Finance Minister Nirmala Sitharaman presented the Economic Survey 2024-25 in the Parliament today, providing a detailed analysis of the country's economic performance and the challenges ahead. My colleague Pallavi Nahata is here to discuss the key takeaways from that report.
GDP growth is estimated to come in the range of 6.3 to 6.8% for FY26. That's according to the economic survey that was tabled in both houses of the Parliament today. Now, let's remember that this would mean sub 7% growth for the second straight year for the Indian economy. The report also did highlight that geopolitical risks remain elevated due to the ongoing conflicts and tensions, and they continue to pose significant risks to the global outlook as well as in case of India. However, the CA does believe that India remains economically resilient, with most sectors continuing to perform better than they were before the pandemic. What else the economic survey also had to say was it did throw some light on India's the emotional, physical and mental health of Indians and how that's important and needs to be nurtured. He spoke about scientific evidence showing that ultra-processed foods can be a big factor in undermining physical as well as mental health. Now, the report also spoke about the importance of capitalizing on the infancy of AI. India has the opportunity to prepare its labor force for a future defined by the collaboration between humans and machine intelligence. This is also one of the takeaways from today's economic survey. It also spoke about the importance of deregulation. Lowering the cost of business through deregulation will make a significant contribution to accelerating economic growth and employment amidst unprecedented global challenges. So that was also something that the economic survey spoke about.
Right, thanks Pallavi for that. And rightly said, Chief Economic Advisor V. Anantha Nageswaran has highlighted that ultra-processed foods is a business built on hyper-palatability of food items and is associated with diseases. He's also advocated for factors which deteriorate mental health. Listen in.
Ultra-processed foods. It is a 2.5 lakh crore business built on hyper-palatability of food items. Misleading advertisements, celebrity endorsements, and missing and obscure labeling on packages targeting consumer behavior. Ultra-processed foods are directly associated with exposure to cancer, respiratory, cardiovascular, and gastrointestinal health outcomes. Those who rarely use smartphones, those who are close to their friends and relatives, and those who basically have social connect and physical activity and who consume healthy foods, they have a very high mental score. But if your consumption of ultra-processed foods is frequent, and if your family closeness is not much, and nor do you have enough free time for yourself out in the open, and if you rarely exercise, then your mental well-being score is very low. It is not a theoretical construct, it is an empirical finding across the world, including in India. And lower mental health naturally has a direct correlation with the number of working days and overall productivity as well. So in general, workplace culture, private sector's attitude towards ultra-processed foods, prioritizing medium term over short term, all these considerations will eventually determine whether India's wanted demographic dividend actually materializes or not.
Viewers, with budget just around the corner, NDTV Profit brings your wish list from various sectors. And our focus today is renewable energy and infrastructure sectors. Mihika and Anushi brings us more on this.
The government of India's focus on renewable energy stands very strong, and our country has set some ambitious target of 500 gigawatts for 2030. Our shift to clean energy is no longer just a trend, but the transition cannot happen overnight, and it certainly won't be smooth without strong government support. We need a comprehensive energy transition policy to accelerate the transition while also making energy security of the country strong. So with the Union Budget 2025 just around the corner, here is what the analysts believe and industry wants for the renewable energy sector. Let's first start with 5 key expectations. This is spread across various sub-segments of renewable or clean energy. The first key expectation is higher capital allocation for the PM Surya Ghar Bijli Yojana scheme in FY26. The current allocation stands at 75,021 crores in order to install 1 crore household rooftop installations. More support for this program can benefit players like Tata Power, Waaree Renewable Tech and Adani Green Energy. Next, Jeffries awaits tweets on duties on solar modules and cells. Positive policies in this area could benefit Waaree Energies and Premier Energies. The third key expectation is for higher budgetary support for offshore wind energy. Carriage ratings note that incentives for project cost funding, larger turbines as well as mandatory sourcing from distribution companies could help the space. The need comes due to low developer interest in offshore wind despite the 6,853 crore viability gap funding scheme announced last year. The major driver for the low interest is the 2.5 times higher setup cost for offshore wind projects when compared to onshore projects. The fourth key expectation is for battery energy storage, an ecosystem that is key for 24/7 power supply. Nuvama expects the government to take measures for energy storage technologies. Carriage Ratings, on the other hand, notes that how domestic battery energy storage ecosystem can benefit from initial subsidy support via a PLI or viability gap funding schemes. The rating agency also adds how tax for crucial raw material imports can help adoption. Furthermore, it is key to note that media reports have noted a budget proposal which has been sent to the Finance Ministry, and this proposal includes a mandate for developers to establish battery storage facilities. The fifth expectation is for higher fund allocation for green hydrogen over and above the SIDE program. Current production costs for green hydrogen are not comparable despite government efforts, and this needs to be addressed. Nuvama also expects mandates for the use of green hydrogen, ammonia in key sectors like steel, refineries, fertilizers, and more. The government could also implement blending green methanol with petrol in transportation and other sectors by providing incentives for producers. This would help consumers adopt the fuel. And lastly, we also spoke to different companies operating in the space, so here's the industry wish list. As per Waaree Energies CFO, expansion of rooftop solar programs to increase adoption remains key. The company also mentioned how anti-dumping duties for solar modules and cells is critical to diversify and indigenize the supply chain and mitigate any short-term price fluctuations. Waaree Energies also notes how an increase of export subsidies on renewables from 1% to 5% will be a significant boost to the sector. Apollo Green Energy notes how the budget should address the need for modernizing infrastructure as the current grid stands outdated and ill-equipped to handle growing demands. Renew Power states that the budget needs to introduce focused funding for green skilling to ensure that India's workforce is prepared for the clean energy transition. And lastly, manager of O2 Power, which was recently acquired by JSW Energy, states how extending the conventional 15% tax rate under Section 115 BAB by 5 years would be a significant boost for the sector. The company's CFO also noted how the industry needs long-term financing challenges which have to be addressed. Well, that was what analysts expect from the budget 2025 for the renewable sector and what the industry wants. Stay tuned to NDTV Profit.
The Union Budget 2025 is anticipated to prioritize infrastructure-led sectors, particularly roads. While the Ministry of Road Transport and Highways has shown significant growth in recent years, certain challenges remain this year, such as project delay on revised cost of the Bharatmala project and capex shortfalls. Let's delve into the key expectations from this Union Budget 2025 and recent developments that one should keep a track of. The government's capex target for FY25 was rupees 11.1 lakh crore as per ICRA's expectations. The FY25 number would stand at rupees 9.7 lakh crore, missing this year's target by 13% and clocking in a growth of 2.4% on a year-on-year basis. The view, therefore, is that FY26 capital expenditure target will be set at rupees 11 lakh crore, similar to the FY25 target, which would thus lead to a 12 to 13% of an expansion over the previous year. With this growth case scenario in mind, the expectation is for a higher allocation towards infrastructure-led sectors like roads and highways. Do note that the road sector capex in the FY25 budget was up 3% to rupees 2.72 lakh crore as compared to previous three fiscals in which we had witnessed a whopping 29 to 82% of a growth. In fact, of this budgetary support for NHAI, that's National Highways Authority of India, registered merely a 0.65% growth in the last budget as compared to 18% and 148% growth in the previous two fiscals. This again reinforces the government's stance of a more cautious approach on not intending to increase NHAI's debt. It is to be noted that the NHAI could not award any projects in the first quarter due to the restrictions on awarding imposed in the wake of the Model Code of Conduct ahead of the general elections. The NHAI hence started awarding projects only July 24 onwards. Thus, higher allocation is something we need to closely track for this upcoming budget. Higher focus on developing individual corridors is the second expectation we can track. In FY25, the Cabinet approved 8 high-speed road corridor projects spanning 936 km with a total capital cost of 50,655 crore. The length of national high-speed corridors has increased from 93 km in 2014 to 2,474 km at present. According to media reports, government plans 5 to 6% hike in highway budget for FY26, aiming to reboot infrastructure development after subdued performance in FY25. Now, coming to the key highlights of not just this year, but past decade, let's see what has happened. National highway network length rose 60% from 91,287 km in March 2014 versus 1.46 lakh km. 4-lane and above NH network expanded from 18,278 km in 2014 to 45,947 km. Length of national high-speed corridors increased from 93 km in 2014 to 2,474 km. On to performance in FY25 and other key highlights. Road awarding has remained tepid in FY25 owing to delays in approval for revised cost of the Bharatmala project. Construction of NHAI stood at 5,853 km till December 24 versus 12,349 km in FY24. Construction stood at 21.28 km per day till December 24 versus 33.83 km per day in FY24. Awarding stood at 3,100 km versus 8,581 km in FY24. At present, works in about 12,500 km NH length are under construction under national highways. This also includes Bharatmala projects under which 26,425 km has been awarded and 18,926 km has been completed till November 24. So that was the roundup on the infrastructure sector. Let's wait and watch if these expectations turn out to be a reality in the upcoming budget.
Viewers, we also talked to Pavitra Shankar, MD of Brigade Enterprises, about what is their budget wish list. Listen in to what she had to say.
See, the real estate industry keeps asking for a few things. Typically, the industry status for the sector, which would help in terms of lower, interest costs and single window clearance and faster approvals and streamlining of a lot of the regulations. I think while it's not necessarily part of the union budget, GST is something that really has to be rationalized, not just for real estate, but also related sectors like, the GST rate on cement, which is, say, 28%, extremely high. Definitely some more incentives for home buyers. Interest rates are good, but it would certainly help if interest rates were also lowered and some kind of tax benefit reintroduced on affordable housing. Affordable housing is something that I think should be on the government's radar, just because we are seeing a dramatic ramp up in pricing, and at some point affordable needs to be a priority again. So whether it is in terms of bringing back something like the Section 80IB benefit, maybe lowering GST on input costs for the affordable housing segment, even relooking at what should be considered affordable housing. Today it is still 45 lakhs, which is considered as the ticket size limit for affordable housing, which where customers can avail of a 1% GST for those kind of products. That's been the same since 2016 or 17, whenever the regulation was first introduced. So I think all of those things would really help if we could make a kind request.
Viewers, indices end higher for the fourth consecutive session, with Nifty above 23,500 levels amid buying ahead of union budget. All sectors closed in green, with FMCG, realty, PSU banks emerging as drivers of the gains. Harsh joins in to explain how the markets fare today.
Well, markets advance, and it's a positive day that we've closed in at, and we've closed at the day's highs. Not only on the Nifty 50, where we gained 1.1 odd percent, we've breached 23,500 now, but we've also done very, very well where the broader markets are concerned. And if you see the breadth, well in the green. Let's pull up the breadth of the market as well. While the Nifty Bank underperformed 0.5% lower, the breadth was strong. And we also saw the Nifty mid-cap as well as small-cap indices do fairly well in trade, 1.7% higher on the Nifty mid-cap, and the Nifty small-cap also up 1.5% plus higher. And if you look at the intraday charts on both of them closed at the day's highs, and that really stood out for me. Now, in terms of the Nifty 50, let's pull up the heat map. Zoom in, because FMCG was in focus today. On the back of all of the numbers coming through, we saw FMCG names dominate the market today, 2+% higher on the Nifty FMCG index. Realty has had a phenomenal run this week, 8% higher this week on realty. No sectors in the decline, and that's the one big positive. The other big positive is India VIX went down by around 6.5%, and that's the other big positive. So some bit of volatility taken off the table. The Nifty Bank, as I did mention, and the IT index underperformed the Nifty 50, and despite that we did well. L&T was one of the top gainers, along with Tata Consumer, both coming out with very, very solid set of numbers. Tata Consumer not as impressive, but L&T's future prospects looking good with regard to that order book. Now, in terms of quickly on to sectors one more time, I want to mark out the Nifty Realty Index for the week gone by. When you're looking at it for the week gone by, the Nifty Realty Index is up 8%. So from all of that's happened with regard to the Nifty Realty, or rather 5% plus higher this week on the Nifty Realty Index. You still have a day to go, and we'll obviously have the budget session tomorrow. Going to be very interesting.
Absolutely, Harsh. Now, the fiscal deficit data for April to December period of FY25 has just come out, and it has reached 56.7% of the full year's target. Pallavi joins in with the details. Pallavi, over to you.
Right, fiscal deficit has come in at about 56.7% of the full fiscal year's target. That's compared to about 55%. That's where we were at during the same period an year ago. And we're currently looking at a figure of about 9.14 lakh crore rupees. Now, let's look at some of the finer details in terms of the total expenditure. We're at about 67% of the full year's target, with the capex figure at about 6.85 lakh crore, which means that's at about 61.7% of the full year target. This is compared to 67.3% where we were at during the same period an year ago. This further points to the fact that we are very likely to miss the full year target for capex, which is budgeted for 11.11 lakh crore rupees. In terms of revenue expenditure, we're at 0.7% of the full year target. That's broadly in line with where we were at an year ago. Also in terms of revenue receipts as well as the non-debt capital receipts, we're almost at similar levels to where we were at an year ago. Revenue receipts currently at about 73.2% of the full year target, whereas non-debt capital receipts is at about 35% of the full year target.
Pallavi, thanks for taking us through those numbers there. Now, India will be a developed nation by 2047 with a focus on inclusive development. This is what PM Modi had to say while addressing the media ahead of the first day of the fourth session of 18th Lok Sabha. Listen in from his address.
और मैं विश्वास से कह सकता हूं कि 2047 जब आजादी के 100 साल होंगे, विकसित भारत का जो संकल्प देश ने लिया है, ये बजट सत्र, ये बजट एक नया विश्वास पैदा करेगा, नई ऊर्जा देगा कि देश जब आजादी के 100 साल मनाएगा तब विकसित होकर रहेगा। 140 करोड़ देशवासी अपने सामूहिक प्रयास से इस संकल्प को परिपूर्ण करेंगे।
Viewers, tariffs on Canada and Mexico will be increased effective February 1st. This is what Donald Trump had to say about imposing 25% tariffs on these countries. Listen in to that announcement.
So we'll be announcing the tariffs on Canada and Mexico for a number of reasons. Number one is the people that have poured into our country so horribly and so much. Number two are the drugs, fentanyl, and everything else that have come into the country. And number three are the massive subsidies that we're giving to Canada and to Mexico in the form of deficits. And I'll be putting the tariff of 25% on Canada and separately 25% on Mexico. And we will really have to do that because we have very big deficits with those countries. Those tariffs may or may not rise with time.
Canada and Mexico, 25%. That's coming on Saturday?
That's coming on the 1st, Saturday.
But no oil tariff, no oil tariffs.
No, I don't. Well, I didn't say that. You said that. No.
Well, I don't want to misinterpret.
No, we may or may not. We're going to make that determination probably tonight on oil. Yeah, because they send us oil, we'll see. It depends on what the price is. If the oil is properly priced, if they treat us properly, which they don't. Look, Mexico and Canada have never been good to us on trade. They've treated us very unfairly on trade. And we will be able to make that up very quickly because we don't need the products that they have. We have all the oil you need.
Well, it seems like US President is not stopping at Canada and Mexico. In fact, he has threatened tariffs on BRICS countries as well. He stated if BRICS countries take any step towards cutting the use of the dollar in global trade, there would be consequences in a post shared on social media platform Truth Social. Trump declared that United States would not stand idly while BRICS pursues the development of an alternative currency. Earlier, the BRICS nations expressed an interest in reducing reliance on the US dollar in global transactions. This has raised speculations that BRICS may consider establishing a shared currency or promoting the use of national currencies in bilateral trade. Such developments have the potential to diminish the US dollar status as the world's primary reserve currency. Viewers, for more insights on how the budget can tackle Trump's tariff threats, tune into Big Question at 6 p.m. today. And with that, it's a wrap on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
STT. STT definitely needs to change.
Old tax regime.
1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure because of the iconic 1991 budget speech.
STT. STT definitely needs to change because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022 where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean, the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time, but as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policy makers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that has seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024 because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now in having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every day. Today, we are talking about Indigene Limited. Now, while this is a company from the healthcare space, it's a unique one. What this company does is it, in fact, aids other pharmaceutical companies in carrying out, well, trials and tests, and eventually helps them market these products. But let me tell you a little bit more about Indigene and why we're talking about it. Of course, we've had the earnings from the company, but in general, it's a digital-first healthcare and technology company. That's what we're looking at. Besides that, it assists life sciences companies with drug development and clinical trials, as well as regulatory submissions, and eventually taking some of these drugs into the market for their respective clients. In terms of the revenue breakup for FY24, to give you a better idea of where it gets a majority of its revenues from, well, the company essentially gets enterprises commercial solutions is what contributes to nearly 59%, followed by enterprise medical solutions. That contributes another 23%, as you can see. The balance will come from omni-channels and others, but the long stay as far as these two segments are concerned. Even in terms of your clientele will split, well, it gets mostly majority of its revenues from biopharma, followed by medical devices, emerging biotech, as well as others. Now, as usual, what we tend to usually do is, well, we talk about the various parameters that we judge the company on. So we talk about the income statement, the balance sheet. We talk about the return ratios based on those two financial statements. And of course, we also talk about the cash flow. And we move beyond the financial statements when we take a look at the shareholding. We take a look at street credentials, street coverage, as well as the outlook for the company as well. And we rate the company. We give you a total rating of the company. To help me do this and take us through some of these aspects, well, I have with me my colleague Varsha, who is also going to take us through some of them. So let me bring in Varsha and let's talk about, the top line, the profitability in terms of margins, and the bottom line. Varsha, welcome to the show and thanks for joining in. What can you tell us about this particular aspect?
Thank you, Agam. So, if I were to see the last 3AGR growth for Indigene and FY24 numbers, in FY24 the revenue was 2,590 crore, while EBITDA margin was 20%, net profit was 337, and if you see the 3-year CAGR growth, its revenue has grown 39%, EBITDA 30%, and net profit 32%. Well, this seems good when it comes to last 3 years, but the problem here lies if you see Q1 FY25, Q2 FY25 and the recent numbers Q3 FY25, the numbers are not that good. If you see, the revenue growth has been like 7 to 8%. So overall this looks good from FY24 basis, but when it comes to the recent numbers, the numbers are not that good, and the margins have also gone down. So the margins have gone down to 17 to 18%, wherein in March 24 the margin were 22%. So yes, overall we would give a thumbs up, but we need to keep a watch on what lies ahead in Q4 as well as in FY26.
Right, so that's as far as the balance sheet is concerned, and pardon me, that's as far as the income statement is concerned. So I'm going to talk about the balance sheet as well. As of now, it does look like it does have a strong balance sheet. It has no debt, negligible debt, which is as good as zero debt, but as against shareholders' equity worth around 2,400 crores, nearly 2,400 crores, and this is as on September 2024. Again, it has a significantly higher cash in bank worth around 550 crores, and this is higher in comparison to its gross debt, that is its lease liability essentially. So it's, well, on a net basis, it's debt free, and it does have a significant amount of reserves. We must also remember that the company is coming out of a very strong growth phase. Obviously a lot of that has come and contributed towards the balance sheet as well of late, which is why we're looking at such a strong balance sheet. So it's going to be a thumbs up as far as the balance sheet is concerned as well. Varsha, what about the return ratios? These also look pretty good.
Actually, yes. they are good when it comes to, FY24 numbers. So you have return on equity of 28%, 27% in 24 and 28% in 23. And ROC numbers are actually very good when it comes to 23 at 33% and 24 at 29%. But this, because considering the, net profit decrease or considering the subdued numbers that the company has seen in the last few quarters, we need to see what FY25, return ratios look like. But overall, considering this 2 years, yes, good, very good return of ratios. Now also, we need to consider that company doesn't have to do much capex, because they're not into kind of manufacturing drugs or manufacturing any kind of products. They give services to the pharma companies which bring products, which they help pharma companies products to bring into the market. So not lot of capex is actually required, and this is also reason we are seeing the good return ratios for the company.
No, fair enough. I think it comes down to what these return ratios will eventually look like. But as far as the past is concerned, well, it does look good. I'm going to also talk about the cash flows. And again, when it comes to cash flows from operations, it's a pretty steady state at the moment. Well, what we're looking at is about, 508 odd crores coming in from cash flows from operations, and on a net cash flow basis also, it's a positive number. So overall, that's how things are, as far as cash flows are concerned. Just want to point one thing out, that while we have seen steady growth, the management at this point in time is indicating a slightly closer to double-digit growth. And while we may or may not see double-digit growth for the upcoming, few years, the management is suggesting that they will beat the sector. That's as far as financial statements are concerned. Let's, look beyond and talk about the shareholding too. The reason why I want to address shareholding is because it's a bit peculiar. So firstly, it does not have promoters. It does have institutional holding, but institutional holding is relatively low. Sure, you might argue that you've actually seen an increase in FII holding and an increase in DII holding over the course of the last 9 months, the last 6 months. But overall institutional holding for a company that does not have a promoter is, fairly low, as I mentioned. It does, however, have two marquee investors. The first one, of course, is a Singapore-based venture capital company. That's Nadartha Far East, which owns about 22% in the company. And the other relatively large investor is CA Dawn Investments. This is a Carlyle unit. So that they own about 10% in the company. While we do have significant ownership by these two marquee investors, the question really is that what about the balance? This just adds up to about, 32%. So the balance is out there, and as I mentioned, the institutional holding in the company is not significant just yet. If you move that on the side, we do consider the shareholding as a little bit of a weak spot as far as the company is concerned. But Varsha, what can you tell us about how the company's price has done since its IPO?
Well, yes, Agam. So if you see since listing, so this company got listed in around May 24. Since listing, they've gained 30% on IPO issue price. Now, this looks good, but from listing day close, the stock is up only 5%. Now, Indigene being a small cap company, the investors, the expectations of investor from this company would be at least a double-digit growth in stock price that they must be interesting. And now, but the stock price is up only 5%. Now, company needs to prove when it comes to their financial numbers, so that the valuation premium the market can give to this company. And also, if I were to talk about that street view, so they have 3 buys, 2 holds and 1 sell, but the upside potential for this company lies at 14%. And actually, recently, a lot of analysts are interested into this company, maybe considering the future prospects that the company has. But overall, from a street cred or from a returns point of view, we would give a neutral stand to that.
Okay, so Varsha, I'm going to come back to you on the outlook for the company, but I do want to make a point with respect to the upcoming growth. And I've made a point on this, but I'm going to emphasize a little bit more on this one. So firstly, when it comes to growth going forward, and outlook again will be something of importance, because the management is saying that while they have grown, 35% over the past few years, we're not going to see the growth anywhere close to those numbers here on. It will be, maybe somewhere close to the double-digit growth, but it may not be. They are saying that they will grow faster than their peers and faster than the sector. But in general, it will not be. Of course, the management, or rather the company, is also growing at, or has grown over a smaller base so far, and now the base has become slightly larger, and here on, it does seem like growth may not be, as exponential as what we've seen so far. So that's one of those areas that may be of a little bit of a concern. But what about the other factors in terms of the outlook here, Rasha?
Yes, Agam. So one thing is that company is actively, scouting for M&A acquisitions. So basically here the simple point is the company is going to expand through inorganic acquisition, number one. Number two is now they want to increase their client base, and especially increasing the $1 million client. Now this is very important. One is what additions of clients you have taken and what is the size of that client. This is the second important thing which they are actually concentrating on, and they want to have EBITDA margin to stabilize at 20% in near term. Now, in Q2 and Q3, the margins were 17 to 18%. They want to take overall margins to 20 to 22%, with medium term exceeding 24%. Now, we need to see what strategies have laid down management to have this 22 to 24% of EBITDA margin that they are expecting. So overall, a good kind of outlook, but management needs to prove themselves that what they are saying, they need to, walk the talk management we need to have.
All right, fair enough. So that's as far as how the outlook is concerned. We're going to give it a neutral outlook at the moment because of some uncertainties and also a slowdown in growth. Where does that bring us when it comes to your overall rating after considering all the parameters that we've spoken about right now? So certainly so far in terms of the financial statements, the company looks at a very strong footing. So we've given thumbs up on all the major statements. But let's move on and talk about the other factors. So it's a thumbs down for shareholding, neutral otherwise on street credentials. That is the kind of returns that the company has seen, street coverage as to what the street is making of it, and the outlook, of course, also remains neutral. And given the fact that we give a thumbs up, 1 point, about half a point for a neutral, and no points for, a thumbs down, the total score at the moment comes to about 5.5 out of 8. The outlook at this point in time is something that's going to be at the forefront of every shareholder's mind at the moment. But speaking of that, let's get in the management. Well, I spoke to the CFO of the company, Suhas Prabhu. This is what he had to say. Listen in.
As you rightly observed, a good quarter from a sequential growth perspective, strong 4.9% revenue growth with strong margin growth. We crossed the 700 mark in revenue for the first time, and also 150 crores in EBITDA and 100 crores plus in PAT at a healthy 15.2%. We strive to maintain this level of performance with also stable to growing margins going forward. And given our pipeline and new wins, we feel confident that we are on the right path going forward as well.
Okay, but can you give us some sort of a view, because over the past few years, you guys have shown revenue growth of around 30-35%, and at the moment we're looking at somewhere near double digits. But the question really is that what can we expect in the top line for FY26?
Sure. Well, I'll refrain from giving a forward guidance specifically, but if you look at a slightly longer and medium-term perspective, dialing back, while as you rightly pointed out, a couple of years of 30% plus growth was there. What we believe is that over a longer period, we should deliver growth which is higher than what the industry is growing at, which is at 5 to 6%, and outsourcing in this industry growing at a 9 9 to 12%. And we will strive to actually beat that and go beyond. And that's our ambition. Now, there'll be periods where it'll be slightly slower, and there'll be periods where it is very high, like the 25-30%. But over a medium term, we'll strive to beat what the industry and the outsourcing trends are.
Okay, so not at the same clip as what we are used to, but still beating the industry. That's what we gather. Suhas, also a word on margins at the moment. What are the challenges? Because the indications and the expectations are about 20 to 22%. But we've actually seen margins come off just a tad bit sequentially. So where do we head from here? What are the current challenges, and what is the company doing to overcome some of these?
Actually, margins at a EBITDA level have come in strong sequentially. We've grown EBITDA margins by 240 basis points to 20.8% sequentially, which is in the range, north of 20% that we have delivered in the past. Even on a YTD basis, we are in the vicinity. We are just short of 20% at 19.7, 19.8%. And given that the inflation and, more importantly, the wage bill hike is behind us, we believe that the performance will be stronger going forward on the margins also, such that on a full year basis, we should be in the range that are the expectations based on our past performance.
Okay. So Suhas, let's talk about business and, particularly enterprise commercial solutions, which forms a very large chunk of your revenues. What's in store as we move into FY26? What are the areas that this particular segment will focus in?
Yes. So enterprise commercial solutions, the largest part of our business, is where we transform our customers' commercial operations and help them effectively engage with the market. And this is an area where we see significant changes, one coming from the regulatory side, pricing pressures and a changing product profile with the new innovator products hitting the market, needing the industry to transform the way they engage with the market, while new technology and personalization requirements also bringing up new requirements. And confluence of all of this, we believe we are very well poised. Having said that, we are also having a strong pipeline. We've seen progress many of our customers, where we continue to do more and more and add more value in this process, and we have remained very bullish on this segment.
Okay. Can you also give us an idea about the same when it comes to your enterprise medical solutions?
Enterprise medical solutions has seen a strong growth. One with increasing regulatory complexity, right? There's a natural requirement to enhance, what our customers are doing, which impacts us positively in this segment. And the other thing that we have capitalized in the recent future on is we saw increased outsourcing trend in some of our customers, especially outside the top 20 globally ranked pharma, doing more outsourcing in this segment, coming out of newer requirements, higher requirements coming from the regulator. And that has resulted in this growth. And we see that continuing in the future as well.
Okay, so Suhas, if we look at your business maybe 2 or 3 years down the line, I'm assuming that a very large chunk of your revenues will still come from commercial solutions and medical solutions. The question is the mix likely to change, or will that depend from year to year based on what the demand from your own clients will be?
Yes, you rightly mentioned that again, we're not seeing a major shift in the proportions. There might be interim changes where there'll be a small variation, 2 to 3% between the segments. But in the longer term, we don't see the proportions changing drastically between these segments, even as we scale from the current levels of revenue.
Okay. Suhas, can you tell me about the kind of clients that you've seen in terms of addition for the quarter gone by, and what is the size of these clients?
Sure. One of the things that we are proud of is the fact that we work with pretty much all the top 20 global pharma for a very long time. And therefore, naturally, that means that my client addition, my logo addition, is going beyond the top 20 pharma. Now, when I say going beyond the top 20 pharma, these are still very large enterprises ranging anywhere between $2 billion in revenue to maybe $5-10 billion in revenue, my customer revenue sizes. And they also have all the requirements, of course, at a slightly different scale than the top 20 pharma, but the requirements remain constant. We see that there is significant revenue potential with these customers also. So while we strive to get our top 20 globally ranked pharma to a $50 million, $75 million, $100 million customer for us, the next tier customers could very well be a $25, $35, $50 million customer for us. And that's the potential we are excited to tap into.
Okay, so Suhas Prabhu telling us about what's in store. So firstly, we've spoken about growth, where they said that while the sector can likely see growth of around 6-7%, Indigene is most likely expected to beat that particular growth. But it's going to be closer to double digit and not anywhere close to what we have seen in the past few years. In terms of margins, they are, well, looking forward, eventually they will hit the 20% margins. Right now, we've seen those margins come in at around 18-19%. And, moving in as far as their strategy with respect to the current clientele is concerned, firstly, they are going to look to grow with the growth in their respective clients. They're going to look to consolidate. The concentration risk at the moment is not considerable. Sure, they do get about 83% of their, or rather well over 80%, or rather well over the 4/5 of their revenues from their top 20 clients. That's a good one, but they're looking to consolidate there. And of course, in the meantime, as and when they get to see for newer additions in clients, that will also be a part of the process. That's what we have in terms of KYC in today's edition. And that is all that we have, but lots more lined up on the other side. Stay tuned to NDTV Profit, and we'll keep bringing you more.
This is the day that shapes the future of a billion dreams.
From the fields of agriculture to the backbone of defense.
From ambitious infrastructure projects to everyday tax policies.
Every decision counts.
How will this budget balance growth and fiscal prudence?
What will it mean for jobs, and what will it mean for your portfolio?
Join us for the most comprehensive coverage of Budget 2025
as we decipher the impact
of this budget on you.
I present the budget for a historic
STT definitely needs to change.
Old tax regime.
The 1991 budget was truly a game changer.
I mean, the rest is history.
Union budget.
Budgets.
General elections.
Union budget.
Two more, Yashwant Sinha and P. Chidambaram.
Arun Jaitley.
Arun Jaitley, I'd have to say.
I think Manmohan Singh for sure, because of the iconic 1991 budget speech.
STT definitely needs to change, because now if returns are not that good, it'll start pinching people.
Income tax.
I think income tax, because that's what matters to me.
Old tax regime.
Depends. Old tax regime currently.
I would say healthcare and education.
I'd believe infra.
Oh, certainly more allocation towards infrastructure. That's what's keeping the wheels turning right now.
Game changer, but not in a positive way, was the budget when farm loans were waived off.
There are a couple of them actually. 1991, Manmohan Singh, that was the budget which opened up the economy. Then 97, Chidambaram, who reduced the tax rate from 40% to 30%. In 2001, I think, if I'm not wrong, Yashwant Sinha, who reduced all the duties on customs that led to the computer age or the IT age taking off in India.
I think the budget in 2022, where capex was done in a very big fashion.
There were several actually. 1991 was something that stands out, and I mean the rest is history.
As I said earlier, Manmohan Singh's 1991 budget, I was a very young child at that point in time. But as far as I understand from reading about it and watching a lot of commentary from experts about it, 1991 budget was truly a game changer.
Well, the union budget is right around the corner. It's a very interesting time leading up to the budget as well for the policy makers as well as, us as shareholders, because we see a lot of movement in the Nifty as well as speculations are rife with what could be some of the measures that are announced in this particular budget as well as has been in each one going into the same. We look at some of the key moves that have seen in the Nifty before as well as after the budget, and get you some of the biggest measures that were announced in these budgets and what could have led to the strong Nifty reactions. Let's first look at 2024, because we had two budgets announced in this particular year. One was post the elections as well, and we did see a 1.5% move in just a week after, and that momentum was continued in the month as well. Leading into this budget, there were a lot of speculation, so we saw a downward reaction of the Nifty in the past week, and we did see some of the measures such as the standard deduction being increased to 75,000 for salaried employees from 50,000 earlier, as well as the new tax regime now and having tax-free status for up to 3 lakh rupees per annum for the investors as well. Apart from that, we saw custom duty reductions on mobile phones, gold as well as chargers as well. And these were some of the key moves in this particular budget. Leading up to the election, we had, the 2024 budget in February as well. Let's see some of the reactions as you can see in this particular time frame as well. One of the key moves was increasing the budget for capital expenditures to 11 lakh crores, the first and a very huge budget as well compared to the last decade. And we did see one of the positive reactions in the week and the month after as well. For 2023, it was a very budget going into this particular budget. Speculations were rife. We did see a negative 2% reaction just in the week before leading up to the budget as well. While the momentum wasn't very strong, and in this particular budget, we did see the new tax regime increasing the rebate to 7 lakhs. But apart from that, there were some continuations of policy measures, but nothing big to report as for. For 2022, it was a very interesting budget because we did see a strong reaction going into the budget just a week before by roughly about 2.5% on the positive side. But in the next week as well as the month after, we saw a sharp reaction on negative 5% of the Nifty reactions. Some of the key measures were like they had involved rupees 2 lakh crores as additional credit to MSME firms. Apart from that, we also saw roughly 48,000 being allocated for building 80 lakh houses. But none of these measures could give the big positive boost, and this was the first such non-pandemic budget, so as to say, because of the other measures were involved as well. In 2021, we saw a very sharp reaction a week after, and that was because the allocation to the health sector was increased by almost 35,000, and that was led by the one of the needs of the pandemic as well. Apart from that, we also saw 20,000 rupee fund infusion in public sector banks, and saw thus a sharp reaction as well in 2021. In 2020, just before the pandemic hit in March, we had the
Hello and welcome
Welcome to the special pre-budget show on emerging cities. I'm coming from Nagpur, state of Maharashtra, and I'm at the Indian Institute of Management in Nagpur, which is one of the prestigious institutes in the country. Today we explore how cities like Nagpur have reshaped India's economic story, how Nagpur